So our very first topic for this advanced basics seminar, before we go further into depth knowledge to an advanced learning level, I want to talk about the catalyst of all changes, which is the psychology and right mindset. Before you are able to become a very profitable trader and having a consistent result from the market, you have to change your mind to what the market prefers, not according to what you are believing, nor your own opinion. You must have a better trading and investing psychology, and having the right success trading mindset is one of the requirements for you guys to be profitable in the market. Why we want to talk about psychology and mindset? It is very crucial for you because of as many gurus, motivational gurus or a breakthrough gurus in the world has done the research and found that psychology consists of 80% of your success equation and 20% is the mechanics, which is the strategies on how you achieve your goals. By meaning, you also need the experience and enhance your trading skill from time to time to be better at getting in the market and getting out the market when the signs are shown. Psychology is about feeding the right knowledge into your mind and put it into action immediately. It's all the foundation for an individual to successful trading and giving enough reason for you to keep going to achieve what you want in your life. On our road to success trader, it's not gonna be a very smooth path, and it's not a straight line as what most people think. Behind all success, there is challenges, barriers, and your job is to be bigger than these challenges and barriers. Your job is to possess the right information and skills to overcome these challenges. This course has been designed specifically for you to have an advanced learning or advanced basic. That's for me actually the most important knowledge before you implement real trade or having experience in the market and proceed to an advanced stage of learning. This course has been designed to equip you with the right psychology and mindset because it is so important. That is what keep you going in the future. It is only reason that inspire you to keep taking actions and having enough reason to success. For example, finding your why in trading is very crucial because it what make you want to keep trading and improving yourself. Do not carry away about the slogan, retire young and thinking doing nothing in your life. That's just a myth. People are usually succeed is the one who obsess in what they do. That's why we could see people become really successful in trading because they're being obsessed with trading financial equities. Trading is a career. You have to respect it as like any other career. It is not easy money unless you want to improve yourself and do whatever it takes to succeed. It is real that trading and investing able to generate passive income that does not require working sweat at all. But in order to achieve a high level in trading skills and having consistent profit results, it's all about getting the right knowledge and put it into practice. Subsequently, you will make some mistakes because you are not used to it. Keep improving yourself from time to time. Possess and implement the right skill, so in the end, you will find success and you'll be able to keep it as a habit. Trading have a very competitive advantage method if compared to other money-making strategies because everyone can trade in the market without any restriction. The liquidity is really high that you can cash in and out anytime. You can make money in matter of seconds, minutes, hour, daily or more. Making money in the market only involves you to make some buy and selling decisions and dealing with probability of winning and losing trades. You also need to determine how much you are willing to invest in one trade. What are the right amount of money you have to put into a particular trade. This process is what we call position sizing. I will explain more on this later in special course on risk management. So the first thing you really want to aware about mindset is that so many people do not achieve wealth and the things that they want in their life is because of mental barrier. One of the strong mental barrier is their own wrong belief about wealth and money. Many people believe wealth is the root of all evil, and these things make them very hard to achieve financial wealth, either they're realizing this matter or not. They believe financial wealth will lead them to the wrong path of life because of the money itself. You have to focus on the good things, such as the more money you have, the more you are able to help poor people. For example, helping more people by charity and have more ability to improve other people's life. And you have to notice that money is just an item that magnify the real who you are. So this is something that you need to aware of, and this is something that you need to prepare yourself before you achieve more and more wealth in your life. Educate yourself along the way on how to have more money in your life so that you can do a lot of wonderful things in life. Focus on the better result. If you get stuck in trust in all belief pattern, then it would be very hard for you to gain more wealth. This cause would be result in resisting to have more profits in trading because you see small profit is enough. That is why you could see people making little profit in the market because of their mental barrier. Does it make sense? One way to improve your psychology is to attend self-development seminars. It was because by attending seminars, which many could be free, you could be exposed to reality and opportunities available to you outside. Many people just stuck in their life because of having no clue and no idea what to do. So in order to expand yourself, you need to get exposed. So that's how you can find something that you love doing and pursue it. Be good at it and excel in the area of your interest. You are also able to seek various potential vehicles that you can use to achieve your financial wealth, including the effective ways to doubling, tripling your income. Although having job is okay, but do not just get stuck with your 8 to 5 job every day and in the weekend having no ideas what to do. Start going outside, expanding your belief about wealth and opportunities will appear to you. Believe me, there is abundance of opportunities that you can ever imagine, and wonderful things happen to one life outside every day. Consistently, go find your miracle and work your ass off to get it. Believe in yourself in figuring things out along the way. Next, having goals and massive vision and make it 100%. Make it a vision so that you have crystal clear in mind of what you want to achieve. You get a mental picture and numbers of what you are pursuing. So it would be a lot of easier if compare having no vision at all. When you have specific goals, then it is easier for you to pursue it, so that all your daily activities would be around this achieving the goals, bringing you one step closer every day to the life that you want. If you do not have vision, you will easily get distracted and doing something that is unproductive, that's not in line with your life goal. Next, knowing your why is very crucial in order for you to keep you going throughout the journey. Why you start it in the first place. You have to realize that the bigger the why, the bigger and more reasons you want to achieve what you want, including trading in the market for big profits, easier the process to achieve it. Believe me, you will realize that you will do anything to go through all the difficulties with ease. Your reason to success might be because of your family, your wife, your kids, your loved one, and most important for your future that you want to take control of. For whatever reason it is, the stronger the reason, the easier the process. When you trade, you will encounter some difficulties along the way to be highly skilled and having consistent profitable in the market. If you know your why, you have a solid standoff of what you are pursuing. From my experience, sometimes when I want to trade, I have to stay all night in order to trade different market, staying up all night just to learn and getting the experience on many different market. Some people having difficulties although in just even starting and kicking off trading because they do not have enough why. They should be learning and getting profitable in the market. From my experience, it is not just matter about money, but what values do you seek for while pursuing the career itself. For myself, trading in the market is fascinating because one of the reasons I learned that human patterns keep repeating over and over again. I found out that there is interesting in everything. Nothing in this world has changed. Everything has been occur again and again, from past until now, and that sparked an interest for me to learn about the stock market and learn further technical analysis. This is an important concept that brings back for me that everything is easy as long as you want to learn what rules govern by a career. For example, if you want to succeed in trading and investing, you want to learn what rules that govern leading to trading success. To make money consistently in the market is not new. As long as you want to discover from the past and other people's experience, you will succeed. The other reason why I want to trade is for my love in economics. Everything in this world is related. So you can see everything is a sign that leads to something else occur. If you can see that, my fascinating to trade and invest is not driven by solely money, although it is constitute a major part of it, but rather my interest in those sections. I love what I am doing, I get paid for it. Search for what you like, get expert at it and get paid for it. This is the same as trading. You have to spark your interest in trading and investing, find your why, both your interest and money, and you will get success through it. This is the essential basic you must have in order to have an excellent kickstart in trading. Trading in the market does not require many other skills. You're just one click away of making money or not. You are solely dealing with greatly improving yourself along the way. You have to adapt yourself to market movement that is dynamic. You will find out that holding to your self-opinion and ego will destroy you. If you are too ego and holding to your self-opinion too much, you might want to change it when you be a trader. It is not an overnight changes, but rather sometimes it takes days, months or even years. There is time, especially when you are a beginner, you try to hold on to your ego and opinion about the company or stock price that will go up, but the price go down instead. This is very important to know that you have no absolute control over the big market or any stock that you buy. But for experienced trader, they knew that this actually is an advantage because making money in the market is just passive and you do not need to hold on to your ego and let the profit run or the stock to be profitable by itself without you to have cling onto any trades that you hold. The other reason why do I trade is of course making passive income in the market. As I know, one day later I will have to get expert on it to expand my wealth. As simple as that. As what learning that we will covering in later topic, you will get to learn the 5 pillars of wealth on how to diversify to accumulate your wealth in our life. And how does trading and investing come into this building wealth equation? Information that you receive by learning from various sources is a potential power. It is not power unless you put it into action. When you put it into action, then it will have an impact. In reality, you have to face many failures. That is a part of your ladder to success. You can't afford not to fail. success comes after many attempts. If you are fear of failure, then the chances of you winning is small. People who are always fail, never give up, and always seeking for the missing ingredient to their success will win. This same goes to trading. When you trade and learn from this video or any class, seminars and coaching, put anything that you learn into action immediately. Do you think that you can do it immediately? Most people can't do it. Until they made some mistakes, they will not change. They will not realize what the mistake is. If you have a good knowledge and implement it accordingly, the chances of your success is really high. Now you know success is not new. There is a lot of people who had done numerous things in this world. There is a lot of people who has been achieved on what you want to achieve. These success guys leaving some blueprint. So your job is to find this success blueprint so that you can emulate the process and be success in trading too. After taking massive action, you will find the strategy might not working. So try to fix your approach. Always learning until you find what strategies are working and suit you the most. In order for you to be success, look for anyone that have the same interests as you. This enables you to share information on each other. Make sure you find a quality partner that you can improve and help each other. You can't be a lonely wolf. You need strong partners that support you in line with your passion until you find success. So hi there guys. So we will continue our learning regarding on having the right psychology and mindset. On our road to achieve abundance of financial wealth, so the question arises, how does trading and investing come into this equation? How can we get and have a lot of money in our life? Before we go further to trading and investing in details throughout this course, let we learn a few other vehicles that have potentials to get to your financial destination. It portrays in a concept figure that called the 5 pillars of wealth. And plus, you will learn how does trading and investing come into this equation. And in this section, we will go through 5 components briefly one by one. We start with the first pillar of the 5. As far as we know, by being a common source of income is by having a job or a specific career in a company. And you might think about this, how can this lead someone to have a lot of money in their life? Well, a certain career might have a very luxury paid, especially the more experience you got on some certain positions, or you are on your way rising up to a career ladder in an organization. Many high positions in an organization might be as well being high paid. We take an example of high-ranking executive as well as specialists in a company. So we can say that in the end, you might end up having a good financial wealth and also have the possibility to be a millionaire. The question is just either you doing something you like or you do not like. But that is another issue. Do not rushing in quitting your job. If you find that the job is satisfying, in addition it is very well paid, then it might be a good career for you. Then we go into the second pillar, which is owning your own business. By having a business means that you have a product or services that you are able to sell the products to the customer or client. Therefore, you get paid for this. As a result, when you are able to reach a lot of people and make a lot of sales, then you are able to get a massive return of profit. This is a common vehicle that people use to generate a lot of money in their life. Then you continue to make sales and go large scale of it. The next classic way of making high capital gain is in property. By having a house or high-rise apartment, you definitely can sell it for a higher price in the future. Even from having properties, shops, sublets, you can get the cash flow from renting. But having property is quite tedious because you need to take care of the property itself. It needs maintenance, and if it's not having demand on the market, then you might get stuck with the property without getting any income from it. Furthermore, it is not liquid, as the property buying depends on current interest of buyer that is quite slow compared to buying and selling activities of shares in the stock market or any financial equities. This makes stock market more preferable and have a competitive advantage in terms of capital gain. You can convert and get your cash in hand anytime you want. But sure, property sure does have its own advantages. The fourth way of making abundance of financial wealth and why we are here is through trading and investing of shares of companies in the stock market. It has been proven that the stock market has been a very good way to earn passive income and have a massive wealth through compounding our wealth. Using the right proven successful techniques that I'm gonna share is necessary to produce high results. Among of that, trading in the stock market is really an individual game, and one need to improve their trading psychology from time to time in order to be profitable in the market and have a consistent result. Making money in the stock market from my experience is seriously an easy money and passive. Once you acquire the right knowledge and techniques on how to gain profit in the market, you will get it for the entire of your life. Imagine making money without working sweat at all. The last pillar is the newcomer of the 21st century, that is the internet marketing. Nowadays, people are using the internet to generate income from multiple techniques. Some of them are having various products, either it would be physical or digital information product, and sell it online. They also provide their unique talent services and reach people through the internet. Imagine your potential customer is the whole world. Many millionaires has been created through internet marketing. So guys, what this is all 5 pillars are about. The idea of these 5 pillars is an advantage in conclusion to educate you so that you should not rely on just single source of income. You should diversify your wealth from one source to another sources of income from time to time. This is what make people rich and what make rich people even wealthier. People who make money from the stock market sometimes want to liquidate their cash into properties. This is the practicing of the multi-millionaire. So in conclusion, you want to expand your wealth into these 5 methods from time to time to have a lot of money in your life. We can see that through this development of 5 pillars, psychology and mindset is the foundation of everything. By having the right psychology and mindset as the foundation, you have a solid base on creating those 5 pillars of wealth. By learning on how to trade and invest profitably, you can compound your wealth faster than any other methods, as this has been proven over the past many years. So this is how trading and investing come into equation on building your financial wealth. From earlier learning, we realized that success consists of 80% psychology and the balance 20% is the mechanics. How bad you want significantly change your life somehow determine how fast the result is. If you could provide a very strong basis and reasons why you desire to be success, the easier the process is. If you have a good psychology in place, it is easier to overcome any challenges ahead. If you want to be success, you need to have an open mind to learning, or else how you gonna grow? Unable to have an open mind, usually what holding people from learning the skill that they needed to be success. It was because they are unable to expand their knowledge to becoming big. They are in the circle of I know that. These are the three most dangerous words. And because of this skepticism that they think they know everything, they trap and sadly unable to grow. When you are not growing, you are dying. So get rid of any skepticism in your life and have an open mind to learning new knowledge. Join up any self-development seminars to get exposed and meet up new friends. Believe me, there is a lot of interesting knowledge for us to learn. So have an open mind so that you will be able to grow and spark to change your life. So throughout this course, I want you guys to put all your negative thoughts and put it into a small box and place it outside. The learning steps and information in this seminar could easily cost you thousands worth of money, but I make it affordable so that you guys could have a useful transformational foundation knowledge. Please do listen carefully and learn. All the things that I am gonna share with you guys are from several years of my and other people's experience learning about the stock market behavior and human psychology, plus what it takes to succeed in the niche. This seminar consists a lot of very essential information that an individual, especially the beginners, need in order to have a solid foundation before they're pursuing further deeper knowledge, trading in the stock market or any financial equities. Getting the right concept of trading is important so that you have a smooth path ahead and prevent any major mistake, as what most people did in the beginning of their trading career. Throughout this course, try to learn and absorb as much as possible knowledge as you could. What you need to do is just to hear what I am sharing and finish all the courses. This course has been a difference because it is not only focusing only about money creation, but it involves in building a great foundation for you to build your financial wealth. You can either choose to have so much reason to succeed or too much blames for failing. It is all in your hand. It's not the question of who is right or wrong, but the important thing is you learn and always striving for the better in your life. The decision to be happy, sad, rich and poor is all in your hand. In our life, there is some word that be able to determine our wealth status. Some people normally do not realize that they have unconscious level that they have a term of excess money in their life. We take for an example, if a person normally have 50,000 in their bank and that 50,000 is their limit of access. So any value over this limit, even slightest extra 100 or 500, he will spend it. It was because 50,000 is his or her financial limit. So a person has to increase their financial limit in order to have more money in their life. The ability to save is basic to financial wealth. If you spend more from what you earned, it doesn't even matter. If you have more income throughout the time, you will be the same broke all time. You will never have enough money in your life. This is one of the psychological barriers that hinder a person from accumulating a big wealth in their life. You have to change your mindset to focus on what you need in order for you to achieve financial wealth. Always practice a good spending habit so that you have a better life and be able to achieve financial freedom by retiring early in your life. Why achieving your goal or retire early for you is a must. It can be a reason so that you can focus on the thing that you like doing for the entire of your life. You can pursue your passion and be more successful in what you like doing. If anything that you want to achieve changing from want to must having, it would become on a stronger basis. If you are stronger psychologically, it is easier for you to achieve what you want and overcome any barriers and challenges ahead. That is why when we trade, we need to have the passion along with us, not only because of the money, but also the value behind. Learn, discover more about yourself while you are striving on getting the necessary experience in the market. Prevent from making any huge mistake by implementing and taking care of your capital by using the right risk management technique according to your preference. In the latter course in risk management topic, I will share with you guys a risk management technique that has been used by successful professionals and bankers all around the world so that you have a good capital taken care of. The knowledge that I am sharing throughout the course is the same technique that I had been using from the past until I got very profitable in the market. Please do appreciate it. Learn slowly. You do not have to be rushed, but implement the method correctly and have the experience from the market. Do not let hope, fear, or greed overrule you while you are trading. Taking fat profits in the market is very crucial, and not making big mistakes along the way is important for you if you want to make big money in the stock market. One most important strength a person must have to success is commitment. Commitment can be defined as the willingness to do whatever it takes to achieve your success. You will do what the average persons and mediocre individuals don't, even you are uncomfortable or afraid. You will always take the necessary risks, understanding that the result of your hard work will bring you closer to your ultimate goal. In simple layman terms, commitment can be derived as doing the thing that you said you would do long after the feeling in which you said it has gone. By this it means that you still have the same interests doing what you are into, although the first time you said it has been past long time ago. When you are still hustling and still doing the thing after you said it for the first time has been passed a long time ago, it has higher chance that it is your passion, and the more you give commitment to it, the higher chance for you to achieve success in the field. So in your learning curve, it is essential for you to have commitment, spending your time, money and energy and do whatever it takes to succeed so that you will be able to gain massive success, creating a lot of money in the market. Everyone has their own experience in their journey to be a profitable trader, and most of the journey usually not a quite easy and a straight line. Many people started their trading career being not well prepared by not investing in themselves on having the right knowledge. In this topic, you will learn a few sneak peeks and tips when you started the trading journey. Most people trade and invest in hoping that the stock price gonna go up and they strike a fortune in the stock market. This is actually the act of pure gambling, and they seek stock market as some way to have fun, and they treat it like a casino. This kind of people actually does not invest, but they are gambling their hard-earned money without knowing they will be in major losses. Personally, in the early days, I invested my money in education before I got into the stock market. This has significantly reduced my risk in the market, and I can continuously be able to sharpen my knowledge and skill until I become really profitable. I am sure, like any other career, the journey to be a profitable trader is not a straight line. It is not gonna be like you attended a seminar and then got instantly the holy grail technique to succeed. It's not likely to be the case. Success research has proven that it took several years in average for one to succeed in their career. Research has shown that it took 10,000 hours to be specialized in what you are doing and get expert at it. When I just started my trading career, I had attended a class, and I believed that by attending that one class, I would get instantly profitable in the market. But after a few months real-life trading, I realized that I need to learn more in order to make consistent passive income from the market. In the early days, I had learned about trade risk control that protect me from any big losses in the market. Without proper real experience and high probability success trading technique, you just seek for survival in the market. I had started my trading journey with a strong technical background. Technical involved in analyzing of chart pattern, price action of company shares of any financial equities. Technical analysis has enabled me in identifying either the stock of a company is suitable for buying or not. Is it the lowest and the best price to buy? Is it the share price is in an uptrend? So technical analysis is a very powerful analysis that you need in order to be profitable and maximize your profits in the market. You can predict future movement of the trend and ride along when it goes up, but relying solely on technical would not be reliable. One have to equip themselves with some fundamental skill analysis to confirm that the stock is a good company to buy. You can also possibly realize that the uptrend is fake or real. It helps you in your buying decision based on a good healthy company that are not into trouble or even worse, filing for bankruptcy. There is a lot of ways and strategies in making money in the market. There is short, medium and long-term strategies. The skills and psychology that needed for each strategy differ from each other. So throughout the course, by the end of advanced basic course, I will explain to you several common ways of making money in the market. It was the common way to make money trading and investing in the stock market. It is very useful as the information needed to help you having a good mental picture and part of the plan before you trade financial equity and expect any outcome from it. Normally, when you just started a trading career, discover the world of trading and investing in a year or two. Discover several ways of making money in the market. Then decide which technique that you are most prefer. Which one is the most suited to you, your lifestyle, profit potential capability of each ways making money, and how much time you need to spend on analyzing the stock or equities. Get an experience over the equities that you are traded in, their profile, what are the patterns that most common appear in the market. By learning the market movement, it is easy for you to make money in the future because the market is repetitive. You can even predict the aggressiveness of buyer and seller in the stock price because you are used to it. Are you a value investor that do not care about the technical? Just relying on the fundamental of the company and only would like to know the stock price the next few years. These usually people who trade in large amount who do not want to know in either short or medium term results. They would like to know what happened to their investment in a year or few years later, and making 10 to 20% is sufficient for them. There is also a type of trader and investor that we call as a mechanical trader. For mechanical trader, they trade based on the average calculation of price of the stock in the past. They heavily use the buy and sell indicator to determine how many people are buying and selling the equities in the past and use the information to predict next movement. I will share more with you on how to use several common indicators that being commonly used by trader in the next course. There is also a real chartist that determine the aggressiveness of buying and selling and use the chart pattern in the past to trade. For me, this method has shown to be a very reliable method and being used by a lot of professionals to make buying and selling decisions in the market. In the advanced chartist section, I will reveal to you on how a simple method on chartist change the way you see the chart pattern and use it to be profitable in the market. It is a really an effective way to gain profit in the market. In the advanced chartist course, you will learn an advanced course that have more than 70% accuracy. It can be higher if you have passion and implement it for long term. Stick to the rules and you will be making a lot of money in the market. I believe by combining technical and fundamental analysis would lead to a great company selection. You have higher probability to success and the stock going in your favor. According to success mentor around the world, normally it takes 3 to 5 years for a person to specialize and succeed in what they are doing. This same goes to trading. With the right mentor, the path of education would be easier for you to achieve success. In this topic, we will go through some normal growth strategies when trading in the stock market. This diagram shows you some capital growth strategies that include short, medium, and long-term strategies in trading and investing financial equities. Growth strategy number 1. Buying the general market include buying and selling exchange-traded fund is a strategy that being used by certain trader to gain money in the market consistently. An ETF is a pool investment vehicle similar to a mutual fund that offers investors a proportionate share in a pool of stocks, bonds, commodities, and other assets. The key distinguishing feature of an ETF is that it trades throughout the day on an exchange at a market-determined price just like a stock. Many exchange-traded funds like Dow Jones or any main market in all around the world have registered phenomenal growth since the introduction. Because of this steady exponential growth, it always been an option for investor as well as trader all around the world to include ETF in their portfolio. Trading and investing in the general market is considered to be safe, less volatile, and give an expected steady return every year. From the past data, one can expect an average return of 10 to 12% steadily investing in the index every year. Next, we move on to a second strategy, which is value investing. Value investing is the strategy of selecting stocks that trade for less than their intrinsic values. Value investors actively seeking stocks of companies that they believe the market has undervalued. The investor looks for stocks with strong fundamentals, including earnings, dividends, book value, and cash flow that are selling at a bargain price given their quality. Value investing always emphasizes on a mentality that sees a stock as the vehicle by which the person becomes an owner of a company. To a value investor, profits are made by investing in quality companies, not by trading. This is a long-term growth strategy as the same as growth strategy number 1. They are seeking around 15 to 25% steady return on investing in the market with good companies without having care about any short-term effect that may affect the company's stock price. Momentum investing is an investment strategy that aims to capitalize on the continuance of existing trends in the market. To participate in momentum investing, a trader takes a long position in an asset that has shown an upward trending price, or the trader short sells a security that has been in a downtrend. The basic idea is that once a trend is established, it is more likely to continue in that direction than to move against the trend. Momentum investing seeks to take advantage of market volatility by taking short-term positions in stocks that are going up and selling them as soon as they show signs of going down, then moving the capital to a new position. Momentum investing can be very profitable. For example, if you buy a growth stock that rallies from $10 to $15 on some glowing analyst reports and get out before the correction, you will earn a profit of 50%. This is not the annualized return, but the return from a position that may have been only a week or a month old. The speed at which an investor could potentially make a pile of money is staggering. Momentum investing usually seeking at least 25% to 70% return within 1 to 3 months holding. It can be longer if the stock is still showing that it has potential to go further upward in the long run. They are a derivative because the price of an option is intrinsically linked to the price of something else. Specifically, options are contracts that grant the right, but not the obligation to buy or sell an underlying asset at a set price on or before a certain date. Before stock investors might make 10% or 20% return on a stock, aggressive options investors could potentially make 100 or 1000 return in the same amount of time. Any investing carries a certain amount of risk. With more return potential, options investing assumes greater risk, so you should make sure you understand the pros and cons of any strategies you are considering before you start actively trading. Anyone who invests in options or any leverage vehicle are advised to realize the risk involved. It is usually not for beginners, as trading options is really risky if the price going against you. It is advisable that you gain your experience and getting expert at normal share price before going into further aggressive vehicle like options for leveraging. As you can see in the diagram, growth strategy number 1 requires less financial intelligence and perhaps a safer vehicle with lower return. As you go along each strategies to the bottom, the higher the financial intelligence needed in order for you truly success in the higher return financial vehicle. Thus, when you just started trading, it is advisable for you to go at least strategy number 3 in normal stocks and shares before you go further to growth strategy number 4. Not many knows that there are a lot of financial equities that we are able to trade. There are a few instruments that people are common and also not familiar with when trading in a financial market. They are stock or the share price of a company, options, futures, bonds, mutual fund, and exchange traded fund. In this video, we will go through briefly one by one. Beside normal share that we are commonly trade, there is options and warrant. An option is a financial derivative that represents a contract sold by one party, which is the option writer, to another party, which is the option holder. The contract offers the buyer the right, but not the obligation, to buy or sell a security or other financial asset at an agreed upon price during a certain period of time on a specific date. Options is an alternative of investment of the share price themselves. The name is almost identical to the mother share, but it sells at a cheaper price. This makes options really attractive as it has a cheaper price and has the ability to move faster compared to its mother share. This allows traders to use options as their leverage, by meaning that it can move faster than the mother share itself and subsequently give more profit potential in a short time frame to the holder. It has also enabled investors with low capital to invest through this vehicle. But everyone has to know that options has its maturity date, by meaning anyone who invests in those equity must check the expiry date to avoid any total loss. Option or warrants is not the share price of the company, thus it is not entitled any dividend or bonus unless a person buys the share of the company. Beside option and warrant, we have a financial equity that called futures. Futures are financial contracts obligating the buyer to purchase an asset or the seller to sell an asset, such as a physical commodity or financial instrument, at a predetermined future date and price. Futures contracts detail the quality and quantity of the underlying asset. They are standardized to facilitate trading on a futures exchange. Some futures contracts may call for physical delivery of the asset, while others are settled in cash. As almost the same as option and warrant, it provides people to leveraging an asset that is normally commodity such as corn, palm oil, gold, or an index. This instrument involves higher risk but at the same time for a greater profit potential in a short time frame. People can rely heavily on technical analysis on buying and selling futures. It is too liquid and high in volume that people are able to trade even in hours or minutes. A bond is a debt investment in which an investor loans money to an entity, which is typically corporate or government, which borrows the funds for a defined period of time at a variable or fixed interest rate. Bonds are used by companies, municipalities, states, and sovereign governments to raise money and finance for a variety of projects and activities. The fixed interest rate can be like about 6% per year for an agreement minimum of 3 years. It can be lasted more than that depending on the contract agreement. Because the entire project is sometimes very big, only really high net worth individual that's seeking fixed return income for every year opt to choose this vehicle. Bond is considered to be slow but safe, yet everyone does not guarantee their investment in the future. When you invest in the stock market, there is a type of investor that only specialize on some certain financial vehicle, for example like the exchange traded fund. In the US, the ETF would be US Dow Jones, S&P 500 or Nasdaq. Traders opt to invest at the index ETF because it is less volatile and predicted if compared with individual share price of a company. This yields a safe and reliable predicted return sum of profit every year. In addition, there is an option traded in the index. Under exchange traded fund, there is individual companies that make the index. For example, there is 500 big influential companies under S&P 500. Each performance of the stock market may affect the performance of the index. At the bad market movement, overall movement of individual companies' share price will tend to move down too, and vice versa. All investing in every financial equities may result in different return profit potential. Your ability as a trader is to define your risk before getting in any financial equities so that it is safe for you to invest and having consistent profit in the long run. In the risk management section, I will share with you on how to take care of your risk management. Before we make a decision to buy and sell a financial equities, there are two main analyses that we have to make, which is the technical and fundamental analysis of the company that we desire to buy. Technical analysis is involved in price action analysis of the share companies. This involves the analyzing of the past movement of the share price and use this data to predict its future movement. This includes the usage of repeated pattern and price movement of the financial equities. Fundamental analysis involved in the process of determining the value of the company compared to its current share price. Either it is a good business that the share price is undervalued for buying opportunity, or either it is overvalued for selling. These analyses are the analysis of the fundamental of the company. For example, either it has a great future profit growth, a great income statement, that it is promising enough that it is able to attract investors to invest in the company in the long run. A trader and investor can use solely technical, no fundamental, when they make a decision to buy a share price. They also can use both in order to make the decision even solid and stronger. It is depend on the trader and investor which method did they prefer. At the end of the basic advanced course, I will reveal to you guys a certain level of trader and investor in the market. This is beneficial for you as this information will help you in making decisions and refine so that you know that there are different kind of trader and investor in the market, and you can make use of this information in making a good plan before entering any trade. A trader and investor might want to have a short-term, medium or long-term holding companies. Many stock gurus will say that they solely believe in fundamental because they believe technical has been proven wrong to them before, and some mention you only have to learn the technical analysis to succeed in spite of using fundamental analysis. Both analysis is actually needed for one to make a wise decision in the market. It is because you want to buy the equity at the bottom share price as possible and trade and invest in companies that having good fundamental and business. When you have both solid reason to buy the company, it will be good for you as the share price has the potential to gain more than 50% in medium term and maybe more than 100% in the long run. In the stock market, this phenomena is usually occur if you are able to choose a good stock to buy. Despite having a good psychology, one should have an extensive knowledge in the market, either in technical and fundamental. In this course, we will cover the basic knowledge of fundamental and technical analysis. Having knowledge on the company business and its fundamental is essential to ensure that the stock that we are buying is a good healthy company. Throughout all companies traded in the exchange, there is companies that making money and going to the downfall. So before we invest in any company, you have to ensure that the company you are interested in is consistently profitable and it's not possible filing for any bankruptcy. This is because so many traders, especially beginners, lure to the cheap share price that it seems to be really attractive without considering the fundamental of the company. Most successful traders always consider the fundamental analysis as an important element on having a positive portfolio in the market in the long run, not neglected the important implementation of highly successful techniques of technical analysis. There are a lot of criteria that we look upon in a good fundamental of a company. All fundamental of a company consists from having the impressive income statement to all intrinsic value of the company itself. For example, the staff, especially the high top ranking management. Has the company been appointed the right person to run the business? A company that possesses an extraordinary management and staff not only will record impressive growth but rise and shine through the tides and difficulties. When it comes to fundamental, that's mean you are seeking the real value of the company compared to its current share price. The first basic principle rule is you should invest within your circle of competence. This is the core principle of fundamental. Never trade in companies that you did not have any knowledge about the details. For example, the company financial standings, the sector performance, and even the management of the company. One easy way to understand fundamental and value investing is that you can use common business sense to analyze a good company that runs based on a good business. Economic mode is a good fundamental criteria that we look into a company that enable the company to survive and having a fast growth in the future. An economic mode is criteria that make a company a leader in its competition. There are 5 key of economic mode. In this preview, I will explain 2 of it. One of the economic mode is economies of scale. Some companies is big enough that it is able to price its production at a lower price with equally good quality compared to its competitor. Its costs become very low that people can buy bulk with supplier for huge distribution network. For example, companies like DHL and FedEx. There is also an economic mode called brand loyalty. For example, like sports, brand Nike and Adidas have a huge brand loyalty that they has loyal customer for any products launch. This allowing the business to continue generating huge profits in many few years. We want to ensure that with a good fundamental, you would invest profitably in the long run. Investing in fundamental is a long-term approach. It involves your circle of competence about a certain sector or company. You want to know the result in coming at least 1 year and above. Buying a company with only fundamental without technical approach might result in you buying a share price at the top. This result in reduce your profit potential. So in order to buy at a very low price, you need to apply successful technical analysis strategy in your trade. Buying a good fundamental will ensure that the stock won't crash in the future. Beside fundamental, there is technical analysis. Technical analysis roots down to the analysis of supply and demand of the share price in the market to determine where the price trend is headed. In other words, technical analysis attempts to understand the market sentiment behind the price trends rather than analyzing a security's fundamental attributes. If you understand the benefit of technical analysis, it can give you a new set of tools or skill that will enable you to be a better trader or investor over the long period of time. Technical analysis involves in chart reading of the share price. Technical analysis is needed because even the share price of a good company could possibly go down temporarily. Thus, technical analysis is the answer for the trader to identify when the best time to buy a share price. Technical analysis gives signal when the share price hit price bottom and start to move upward. Without technical chart analysis, you could possibly buy at the top price. Then, when the market go downward, you subsequently be lost in position. This happen even the company possess a good fundamental background. The series of price action movement in the chart enable a person to identify market trend, subsequently enable one to trade and invest profitably either in short, medium or long term. There are various technical indicators that help a trader and investor to make decisions in the market. Technical indicators look to analyze past price levels or simply the general price direction of a security by looking at past data. Examples of common technical indicators that being built in the system include relative strength index, money flow index, stochastic, MACD, and Bollinger Bands. Technical indicators, collectively called technicals, are distinguished by the fact that they do not analyze any part of the fundamental business, like earnings and revenue. Technical indicators are used most extensively by active traders in the market, and as they are designed primarily for analyzing short-term price movement. It can also be adjusted to see long-term price movement. In the advanced learning of chartists, which is the learning of chart reading that include in the advanced chartist package, we will learn the high probability of chart movement prediction. With a high probability strategy, technical analysis can be a stand-alone strategy. It has been used by professional and successful traders to gain money from the market in really short and medium time frame. But bear in mind that solely dependent on technical analysis in short-term period may not be reliable when the general market is downtrend. It lost its probability of success in terms of the accuracy of solely using technical analysis in a bad market. It is because they might make a fake breakout during the bad days and reverse downwards. In a good market, one could rely solely on technical analysis because of higher chance that the share price would rise in the future. That is why fundamental and technical analysis is important in order for us to gain profit in the market immediately. In this topic, we will cover some of the most important fundamental criteria that we look upon in a company. Fundamental analysis is needed to help investor choosing a good healthy company to invest in. It includes briefly description of income statement, revenue, earning per share, shareholder equity, and good cash assets. We look upon some important fundamental criteria that affect the fundamental performance of a company. Let me go to criteria number 1, which is the income statement. The income statement is one of the major financial statements used by accountants and business owners to see a company performance. The income statement is sometimes referred to as the profit and loss statement, statement of operations, or statement of income. We will use income statement throughout this explanation. The income statement is important because it shows the profitability of a company during the time interval specified in its heading. We will go through among the most important components of income statements, which are the revenue, earning per share, shareholder equity, and good cash in hand. The number 1 component included in the income statement is the revenue. Revenue is the amount of money that is brought into a company by its business activities. Revenue is known as the top line because it is displayed first on a company's income statement. Expenses are then deducted from revenue in order to obtain net income or profit. Investors will often consider a company revenue and net income separately to determine the health of a business. The one information that a great company possesses is its revenue and net income are hugely increasing from quarter to quarter. This resulted in the tremendously increased interest in the share price of a company in the near future. Trading and investing in a huge profitable company almost guaranteed a positive net flow in the long run. It also helps stabilize the emotion of the trader and investor by knowing that they are trading and investing in a growing company that will reflect their share price moving higher in the future. Earning per share, also called net income per share, is a company prospect ratio that measures the amount of net income earned per share of stock outstanding. In other words, this is the amount of money each share of stock would receive if all the profits were distributed to the outstanding shares at the end of the year. Earnings per share is also a calculation that shows how profitable a company is on a shareholder basis. So a larger company's profit per share can be compared to a small company's profit per share. Obviously, this calculation is heavily influenced on how many shares are outstanding. Thus, a larger company will have to split its earning amongst many more shares of stock compared to a smaller company. Earning per share is the same as any profitability or market prospect ratio. Higher earnings per share is always better than a lower ratio because this means that the company is more profitable and the company has more profits to distribute to its shareholder. Shareholders' equity is equal to a firm's total assets minus its total liabilities and is one of the most common financial metrics employed by analysts to determine the financial health of a company. Shareholders' equity represents the net value of a company, or the amount that would be returned to shareholders if all the company's assets were liquidated and all its debt repaid. Shareholders' equity can be either negative or positive. If the figure is positive, it means the company has more than enough asset value to cover its liabilities. If the figure is negative, the company has debts that outweigh its assets. In general, a company with negative shareholders' equity is not considered a safe investment choice because either its asset total is too low or its liability total is too high. Good net cash per share is a company's total cash divided by its shares outstanding. Cash per share is the percentage of a firm's share price that is immediately accessible for spending. When a firm has high levels of cash per share, it is holding a significant percentage of its asset in a very liquid form. This decision can indicate economic uncertainty and an unwillingness by firms to invest given the current economic climate. High levels of cash per share can indicate that a firm is performing well with positive earnings and cash flow. These are the most important fundamental criteria when you look over a company financial income statement. The increased among all of these criteria indicate that the stock of the company is reliable and indicate the company is doing very well in terms of its financial current standing and have a very big potential to grow faster in the future. Congratulations, you had made the learning until now. Now in this learning, you will learn on the basic of chart reading that consists of analyzing the price action of a company's share price or any financial equities. This basic consists of the learning on how to read bar chart and candlestick chart. Technical analysts and chartists use charts to analyze a wide array of securities and forecast future price movements. It boils down to an analysis of supply and demand in the market to determine where the price trend is headed. In other words, technical analysis attempts to understand the market sentiment behind price trends rather than analyzing a security's fundamental attributes. A price chart is a sequence of prices plotted over a specific time frame. Charts provide an easy-to-read graphical representation of a security's price movement over a specific period of time. As far as we can see in the chart, the y-axis, which is the vertical axis, represents the price scale, and the x-axis, which is the horizontal axis, represents the time scale. Prices are plotted from left to right across the x-axis, with the most recent plot being the furthest right. In this chart, we can see the example of bar chart. Bar charts are among popular trading chart types. We will look over on how to read bar chart. Bar charts consist of an opening foot that is facing left. It indicates the first price traded during the day, a vertical line, which is the direction the price has moved, and a closing foot that is facing right, which is the last price traded for the day. In this example, you can see the price increase over the bar time period. This increase in price is called a bull bar chart, and it always indicates by green in color. For bear bar chart, it opened higher and closed lower at the end of the day. It always colored by red to indicate price decreasing over the period. As you can see, each bar chart includes the open, close price, high and low that occur during a specific interval. The high is the highest price traded during the day and is indicated by the top of the vertical bar, and the low is the lowest price traded during the bar and is indicated by the bottom of the vertical bar. According to Nielsen candlestick, candlestick charting first appeared sometime after 1850. Much of the credit for candlestick development and charting goes to a legendary rice trader named Homer from the town of Sakata. Candlestick accurately reflect current price with candle form that indicate the domination of buyer or seller in a specific time period. It is in a candle form of image and usually used to identify potential reversal or continuation price of a financial equities. Candlestick charts are read and interpreted as follows. The open is the first price traded during the candlestick and is indicated by either at the top or bottom of the body. The close is the last price traded during the candlestick and is indicated by either the top or bottom of the body. The real body is a price traded between the open and close trading price. A shadow, wick or tail is a line found on a candle in a candlestick chart that is used to indicate where the price of a stock has fluctuated relative to the opening and closing price. Essentially, these shadows illustrate the highest and lowest prices at which a security has traded over a specific time. The high is the highest price traded during the candlestick and is indicated by the top of the tail that occurs above the body, called the upper tail. If the open was the highest price during the time frame, then there will be no upper tail. The low is the lowest price traded during the candlestick and is indicated by the tail that occurs below the body, which is called the lower tail. The trading range of the day include the price range in between the highest and lowest of the day. While a candle is forming, which is not yet completed during trading hours, the candle will constantly change as the price move. The open stays the same, but until the candle completes, the high, low and close could all change. The color may also change while a candlestick is forming. It may go from green to red, for example, if the price is above the open price but then drops below it. When the time frame for the candle ends, the last price is the closing price, and then the candle can no longer change. A new bar forms to show how the price moves over the next time segment. As you can see, a bullish candle happens when the green candle appears with the price has increased over the time period. This same goes to when the market is downward and forming a bearish pattern. You can see that the open is higher and it closed lower during the end of the day. So this is an example of candlestick in the chart. Bar and candlestick charts are used by technical analysts in the study of supply and demand for a security or commodity in a marketplace. Bar charts use of bars, while candlestick charts shows the use of candles, which also represent the trading range of a security or commodity for a given period. It can give a deeper insight into price action because they are visual and give the user a clear view of relationship between the open, high, low and close of the candle. Candlestick chart reflect quickly the buyer and seller sentiment on a specific time frame. So during the day, we can see buyer and sell dominant in each day. A certain candlestick formation be able to give clue to trader what formation or trend will be in the next few candlestick formation. This helps trader or technical analysts identify price reversal and price continuation. It gives a signal on buyer and seller sentiment change and at the same time signs of precaution and warning on the possibility on the next market movements. Thus, it helps trader and investor to be psychologically prepared on any probability price movement that move against them. This is essential so that you are not panicked and make irrelevant decision in the market when unexpected event occur. Many traders consider candlestick charts more visually appealing and easier to interpret. It makes candlestick a perfect indicator to determine reversal point of support, resistance, or any rebound. Each candle formation at the support and resistance help you to determine possibility of market sentiment has changed from seller to buyer or vice versa. So we move next on what candlestick does not show us. Candlestick do not reflect the sequence of events between the open and close. It is only the relationship between the open and the close. The high and low are clear and obvious graphically, but candlestick no bar charts cannot tell us which come first. With a long white candlestick, the assumption is that the prices advance most of the session. However, based on high-low sequence, the session could have been more volatile. The first candle is a candle that forming a 4-hour time frame. It depicts in only a single candle of 4 hours. We could say the most that the price advanced in price at the session. But this situation depicts a more volatile event on the second figure of 1 hour candle. It can give us more information on the price movement on what happened during the day. With the same event, we know that the price goes down initially on the first candle and going upward to the highest price, then close on the closing price. Although candlestick has limitation of what it can do, but it still offers valuable information on the relative positions of the open, high, low, and close. In chart reading, support and a resistance line is a psychological line of a stock price. The line indicates the price of buyer and seller dominance that changing hand in the market. Support and resistance line is a basic and really important technical knowledge for you to have a good chart reading skill. Everyone needs to know that determining support and resistance line is very crucial component in your success equation in making money in the market. Before we go further to chart drawing, you have to know the definition of each support and resistance. A support line is where the share price is resist to move below a certain price level. The demand of the stock usually high when it hit the support, while for resistance line, it is where the price is resist to move above a certain price level. The demand of the stock usually low that lead to oversupply that subsequently leads to a price decline, either temporarily or can be even drop lower after it hit resistance line. The movement of a stock price is random and it's resulted in various movements that create patterns. One of the movements shown in the diagram. This movement is not either in an uptrend nor downtrend. It has no direction, and as you can see, it fluctuates in between the same trading range. This is what we call as a sideways movement. In this chart figure, you can see that two bounces occur at the bottom and two bounces occur at the top. After connecting these two bounces, it creates two lines. The one that at the bottom is called support, and the one that at the resistance is called the resistance line. When the stock price fluctuates in a trading range, you can take advantage of the sideways movement to get buy opportunity at the third bounce on the support in hoping that it will be an uptrend in the next move. Support and resistance line is very important in affecting the price movement of a company or any financial equities. Price might fluctuate around any strong support or resistance line before continue to move up or down from previous movement. Initially, a stock price may fluctuate on a certain trading range. After some moment, it began to break out its current resistance and retrace to a price which is its previous resistance. But now the line is no longer its resistance but its support. Thus the process repeated again. It fluctuates in its new trading range of its new resistance and support line. Then again after some moment it starts to break out again to reach a new high and making a new resistance line. After a while fluctuate, it hits its support and began to move lower than its support, thus now become its new resistance line. This is basic movement of any financial equities. From this knowledge, we learn that support and resistance line is important for us to determine the psychological and probability of aggressive buyer and seller changing hands. Now you start to learn on how to make a right support and resistance line in the market. Before we go into real chart, these are some rules on making support and resistance line. When you streaming a chart, start from the bounce furthest to the right and draw a line joining up to the bounces on the left. Normally, we can start from any side. In this example, we use from the farthest right because it's most recently priced. The second one, draw a line that touches as many bounces as possible. And the strongest lines are the horizontal lines and have the most bounces, which is the more the better. We take an example, the chart of Microsoft Corporation. This is an example of the price movement of an equity in a real chart. It is random, and without technical analysis, it is impossible to recognize the market movement of where it's headed. So now how to draw its support and resistance line. To draw a support or resistance line, we seek the point that has the most probability of bounces. In this case, we could see several bounces on the support and resistance. We can see that through this chart, there is a line that we can make in order to form its support and resistance. The line can be drawn by connecting all the point and consequences bounces. So we got this line for its resistance. The similar process we make in order to draw its support, connecting all by using a line of all its bounces at its support. Thus, by doing this, we can get its support lines. Now we can see with clear that the trend is an uptrend together with its support and resistance. Now the same process goes with this chart of Vonaldo Realty Trust. To form its resistance, connect all the bounces on the peak by drawing a line. The process same goes to draw its support lines. We connect all its bounces at its low to form its support. Thus, we get its support line. The price at the support usually a low price that we can buy at a cheap price to maximize our profit in the market. And at the resistance, we might see that it is the probability of selling opportunity when the market reverse downtrend. And for last example of Apple Incorporation chart, through our observation, we might noticing that there is few bounces that connecting the support and resistance line. By using line drawing on any chart drawing services, we can connect the bounces to form its support and resistance line. At the recently price action, we can see that price break out from previous resistance, and consequently its previous resistance now become its new support, as we explained in the previous learning. This movement is what we call a sideways up. Patterns and movement of an individual share price differ from each other. They are unique and usually portray their own movement and character, but in general, they gone through the same cycle and the same process of uptrend, downtrend and sideways. Patterns and behavior of people trading in the market has never been changed since. This has been result in repeated and predicted patterns of movement has been occur again and again. Before we review on various patterns of the stock market, you should know the basic of market movement. Stock market move in a zigzag pattern. There is no share price or any financial equities move in either straight up or down. After some moment, a stock price may break out to achieve higher high compared to previous price. After it has gone through some aggressive buying, there will be seller to create a pullback or retracement of a stock price. This result in the share price going down temporarily. Then if there is a lot of interest from buyer again, it will resume its movement upward and set for another rally. We go through a chart to see an example of natural movement of a financial equity. In this chart, we can see it is a chart of gold futures 15 minutes time frame. We start from the left where initially the price goes up. It starts moving upward because there is interest from buyer over the financial equity. Then it goes down for selling pressure or the profit taking point. After some moment, the seller becomes less aggressive and the buyer comes back into the market. It goes up, down, until at the end the buyer becomes less aggressive and there is possibility of market reversal. The same goes to this Bitcoin USD chart. As you can see, the price goes up and then down again, and next it goes up again and then down again, and then it continues to go up. As you can see in this chart, the Bitcoin USD is in a rally mode and is in an uptrend. Now for another example, you can see the Apple Incorporation chart, which is this is a daily chart. Initially, the same process goes on. It goes up and then it goes down, then it goes up again, and then the selling pressure takes place. It goes down again temporarily and it goes up again. From all chart, we can conclude that every financial equity move in a zigzag pattern. There is no financial equity up or down in a straight line. Thus, this knowledge is important so that you initially understand the market movement. This will help you on doing the advanced analysis in the later course. It's also very important so that you did not panic in any temporary selling pressure or temporary buying. It will stabilize your decision on not rushingly sell your equities if it goes up or down in time. In a major scale movement, basically there are two types of market movement. Number one is the main movement. Every share price move in a zigzag pattern. This comes to the basic knowledge that in every market condition, there is buyer and seller changing hands. But in every new trend movement, the aggressiveness of buyer and seller changes. Next, in every main movement, there is counter move or the retracement. This counter move or retracement move against the main movement. Any financial equities move in major either upward or downward. First, we see the definition of an uptrend movement. An uptrend movement happened when the market making higher high and higher low than previous. When the major movement is in an uptrend, we can see that the movement making higher low and higher high than previous. In this movement, we can conclude that the main movement is upward, which is the bull market take place. If the movement making lower high and lower low, then we can conclude that the market movement is downward. Thus, the main movement is downward, and the counter move is upward as in the figure. Now we will do some exercise on trading psychology. This exercise requires you to hear some simple instruction and be honest on yourself. Now close your eyes while hearing to the instruction. Imagine you are a deer hunter. Close your eyes. You shoot deer and sell it at the deer market. The bullet that you are using are gold bullets and are almost expensive as the profit you get for selling the deer. You have to shoot it in the butt to get the best money, and because it is easier to get your bullet out of the fleshy part of its butt. In a cabin with just enough room for your deer rifle, and you have a limited view. Please raise your right hand if you are going to shoot. Suddenly, you hear a noise. Do you shoot? A zebra comes into view. Do you shoot? Something that looks like a deer comes into view. Do you shoot? And a deer comes into view. Do you shoot? And lastly, a deer comes into view, and it's turned its back to you, and its butt is right in front of you. Do you shoot? Now wait, what has just happened? From the instruction earlier, you are required to shoot the deer at the butt to get the best money out of the hunting activity. Now let me share some of my experiences. A lot of people will majority shoot when they see a deer into view without considering that they have to wait for the deer to turn its back and shoot at its butt. Thus, from this activity, we can see that there is a lot of distraction that lure us from being disciplined on our rule. So when we trade, we have to be very disciplined and follow our rules exactly in order to be success. That is why before we invest in any financial equities, we have to determine and define our strategy so that we are not easily distracted or confused in the market. Refine our strategy from time to time, expand our knowledge so that we are getting better in making decisions of buying and selling equities in the market. Hope from this simple exercise, you learn something, especially being disciplined on following our rule when trading in the capital market. One of the important character one must have to be a successful trader is they never trade tips blindly. They usually rely on their own analysis and do their own analysis beforehand and never trade based on other people's opinions or tips. In the stock market, one easily get influence from other people's advice. Do not easily believe in anyone, even your stock recommendations from your own dealer or stock broker. You have to remember that no matter how good and attractive a stock is, Never trade by just hearing other people's advice without doing your homework, which is your own analysis. By the end of the day, as a trader and investor, you are the one who has to take all the risks from all the decisions that you had made. A stock that being highlighted can be at the top of its cycle and get ready to flung down. When you are doing your own analysis, good things will come in handy. You have all your knowledge about the stock, where its current standing. You decide what its stop loss in case of the stock price going down. In this picture, we can see that a flow why we should not buy any stock based on our hearing and other people's recommendation. It is a normal day on what happened in a financial institution. We can see that the first person on the left said that I found a stock that could really excel. And at the end of the line, people misheard the word excel as sell proposition. At the end, one might lose opportunity of a rally stock. And the other picture below, the people on the left propose a sell in a panic downfall situation, but it has misheard along the line as a buy proposition because one of the investor might say goodbye to the down falling stock. You definitely could be misleading by being the people on the last row to hear the information. Remember that when you trade any financial equity, there is no other way than getting yourself educated about the investment beforehand and doing your own analysis. In this topic, we go through some tips and the foundation on being financially wealthy. The basics are simple: earn money, spend less than what you earn, save, invest, and repeat the process. This sounds like a simple set of instructions, and on paper it is. But a simple concept doesn't mean it is always easy to practice. A tiny changes in your lifestyle can have a lasting and a meaningful impact in the future if you stick with them. Let's look at some ways you can get ahead in the game. It starts spending less than what you earn. Spending less than what you earn is one of the most important financial concepts to understand. If you spend more than what you earn, you will never get ahead financially. Spending less than what you earn may take some initial life changes, but when you do it consistently, it will become your habit. The process includes analyzing your financial habits and subsequently make a budget. If you can't lower down your expenses and it keeps growing and growing as in line of your income, you will never be financially free. The life cycle keeps rolling and you will never feel enough. When you spend less than what you earn, you are no longer playing catch up and living a paycheck to paycheck existence. The stress that comes from living paycheck to paycheck and worrying about bouncing checks or making late payments can be paralyzing. You owe it to yourself to live as stress-free as possible so you can enjoy life. Spending less than what you earn is a great way to reduce your money worries. It also allows you to save and invest for your future. There is a huge difference between two persons that have the same income, but by having a different investment habit, they may end up in totally different financial level in the next couple of years. Let we take an example: a person keep hugely increasing their lifestyle and debt amount by buying expensive watch and cars, but the other person keep save and invest his savings. In the next few years, we can notice that the both person may end up in a total different financial destination. The one that better at save and invest ended up having more wealth and be able to retire early and do what he likes, if compared to the person that is lavishly spending. We can see one of the example of the most richest men on earth that are into stock market, which is Warren Buffett. Quoted by the Business Insider, despite his roughly billions net worth, the wealthiest man in the world enjoys a life with simple taste, frugal living, and generous philanthropy. What would Warren do? Is a question to ask yourself when modeling your lifestyle after Buffett's. The billionaire doesn't describe himself as frugal, just a man with a simple taste. He said, "I buy everything I want in life," he told People magazine recently. Would 10 homes make me more happy? Possessions possess you at a point. Warren Buffett lived in the same house he bought in 1958. Buffett drives the same car for years. Buffett treats his friend well, but not extravagantly. Reinvest your profit when you have generating profit from your investment. Do not rush in spending your profits, especially in the beginning of your early trades. It is suggested for one to reinvest the profit in order to have more profit potential in the future. All financial equities are designed to help one to significantly compound your wealth in time. One of the reasons to reinvest your profit is to reach a critical mass of money where you can use a low-risk strategies to create a passive income you desire. By having low-risk and high-probability strategy as being taught in the advanced course, you will have an edge in winning the stock market or any financial equities game to create a massive passive income consistently. Most people realize that they should change, and they want to change. There is no question about that. But why do they keep on in the same old path, beginning with initial enthusiasm, then it tapers off? And why? Because there must be something that keeping us in that pattern of consciousness, and that something is our company and our environment. Greater than willpower is the power of company and environment. Greater than your willpower, your company and your environment has more influence upon you than your will. Willpower itself is really great, but it cannot operate due to hold which environment and company has upon one consciousness, and that applies to each one of us. And so, environment is a very great influence in our life. If you are good, in addition to your environment is good, you will have peace and happiness. If your environment is not good, there's only one thing that can result, and that is restlessness of your mind, which is not conducive to spiritual advancement. We should mix with those people whose consciousness and magnetism does not depress us, but rather lift us up. Some people, when you come into their consciousness and presence, and they depress you terrifically. But we should mix with those people who lift us, who give us enthusiasm, who bring out the power and inner strength within us. This is really important for us so that we will be able to achieve our goal that we are never been achieved before. By watching out our environment, by meaning our company, we do have choice to choose whoever we want to mix with, although the person is our close friends, family or relative. If you change your environment, we are more close to our inner self, so that you have more chance to do positive deeds and getting close to your goals every day. Everything that you try to achieve has been achieved by someone else before. There is nothing new in this world. This same goes to trading in the market. Every successful trader goes by the same journey to success in trading. As long as you play within the rules, you are safe and in the right path to making money abundantly and passively in the stock market. The success trader blueprint has been identified under these 4 rules. This regards as the most 4 important rules that you need in order to be a successful trader. The first rule and component to success trading is your psychology. It comes to the basic root on your ability to improve from time to time to equip yourself with the right trading psychology. It's regarded as the most important tool to success in trading. Although we have to treat trading like any other businesses, but the truth is it is not work like any other businesses at all. Although the work to success in trading like mastering any other skills and it takes time, trading does not involve in any human interaction. The income that you get from trading is totally a passive income that works specifically for you without any single hard work. Although throughout the journey to be a successful trader, you need to improve on your technical and fundamental skill, there is one analysis that you need to work on, and that is your mental analysis. Mental analysis has been mentioned in the book Trading in the Zone by Mark Douglas on trading psychology, and it is one of the analyses that you need to improve from time to time in order to be consistently profitable in trading. Mental analysis consists of the process in improving one's self-psychology, behavior, and mindset in order to be successful in the stock market. Although you had learned all the knowledge required to be successful, it's not gonna guarantee you to be success in trading. It is because it's not matter how much you know, but truthfully how good you are at the implementation part of it. Usually when we talk about psychology, it's all about number 1, the discipline for you to take action what you had learned. Many people have high ego that they want the stock market to move as what their prediction is. But in real situation, it is not gonna be happen every time. The market will move against them, but because they still cling on the trades, they suffer a major loss. They may buy any stock as what they like, and adhere to tips and recommendation blindly, as they should supposed to take responsibility of their trades on doing their own analysis that required instead. One could overcome this behavior as long as they want to make self-improvement on themselves from time to time to suit themselves to stock market behavior. Stock market does not recognize who you are, and once you put your trades, you have to realize that the game is totally biased to the stock market. You have totally no power over the movement of the price. A really good psychology is needed in order to be successful in trading. The number 2 is self-confidence in executing trades. Being in the trades, a good trader must plan and firm in his decision. Yet, by doing all this, they have to be reactive to what market tell them, as the stock market is dynamic. Share does not stagnate at any one price. It always keep changing from time to time. Your job as a trader is to recognize the signs being shown by the market and act upon it, no matter how good your analysis, prediction, and plan is. You have to remember that once you put your trades, it's totally biased to the market. I do suggest you to read several books on trading psychology that is available through the link in the course. One of the biggest hedge fund company manager in the world, Ray Dalio of Bridgewater Associates, tell that trading and investing is all about managing risks between the financial equities. Risk has to be balanced between equities and need to be minimized according to its risk profile. Risk management is one of the important components when it comes to getting success in trading. not many aware regarding the knowledge of the topic, and also not many be able to implement risk management successfully. So what is risk management all about? So risk management generally a technique to control your risk in the market and to protect your total account from any major downfall. This subsequently enable you to stay in the game for the long period of time, by meaning your success in trading being measured by how long you stay in the market. As far as we know, trading and investing involve risk that has potential to damage your account majorly in a single trade if it is not being managed properly. Few ways to risk diligently when you trade is to plan your trade, which include position sizing, which is a measurement on how much you have to invest in one particular trade. It is a specific amount that you are willing to risk, and also the technique to set your stop loss accordingly, as well as take profit point. Now, the wonderful things about trading is that a successful trader always have plan in mind, ready before they enter any trade. They know how the game of the stock market, that is the game of possibility between winners and losers. They always want to have a big profit and small losses. So risk management provide the answer on how to trade safe and making consistent profit in the market in the long run. In the topic on risk management, we will go through further detailed explanation on risk management technique that being used by professional and successful bankers that help them to stay profitable in the industry for many years. The third and fourth rules to success trading is the answer to question of what company share and when to buy. A trader should decide the strategy is or her preference and what certain rules that he want his analysis govern from. This allow him or her to decide what company that has potential to go on bull on the next rally. This may come from current company that has potential to go up for a short period of time in terms of current price in earning ratio, or a company that has big potential based on its future profit growth. When you buy an equity, you want to buy as low as possible so that you can sell it at a higher price for a bigger profit as much as you can. This enables you to maximize your profit potential. When it comes to what company and when the cheapest price to buy, the technical and fundamental analysis provide the solution for this problem. Technical analysis will show you through chart reading either the stock price is a good price to buy now or not, or even when it comes to suitable time to sell the equities for profit taking. That is why technical analysis is an important knowledge one need to have in order to success in trading. Hi guys, I would like to have this opportunity to have a little bit recap on our charting services, and I would pretty recommend for you guys to use TradingView as your charting service. And if you are interested, please click the link below, or that you can see. This is a very good charting services. I've been using this for about 3 years, and you can use a lot of things. You can for example, like it meets my minimum requirement. Of course, it meets the minimum requirement, and it is far beyond what I need. Right, it's far beyond what I need to analyze the market movement, and it has all the tools, required tools for us to analyze, and even you can share and publish your ideas in the market. So you just want to see that your analysis is done correctly, being reviewed by other experienced traders. And believe me, if you using this TradingView chart setting services, I believe that is very easy for you because it's not that expensive. Right, I subscribed for about, I think, around $100, right? Around $90 to $100 for 1 year, right? 1 year. And you can, but actually the price of your local stocks is separately, so you, but it's just an addition of $1 or $2, right? So what I mean is, you get this one charting services, and if you want US market or any market around the world, you have to make an extra purchase, which is, it will be an extra cost of $1 or $2 per month, right? And this is a very good. If you are in this, if you've not yet, please do register. You can register free. You just click at the website link below, and at that link, there is a link. You can click it and you can register for TradingView for free. Right? If you are decided to get serious into chart analyzing, you can subscribe for yearly or even more, even monthly or yearly subscription. Right? And this is pretty nice because you can share it around. And if you do share, if you, it's happened that you guys has subscribed, right? Please do add me as your friends, or you can follow me, Advanced Chartist, right? Advanced Chartist. So you find me with this name here, and you can add me and we can discuss. If you are posting any chart analysis based on our analysis, based on our strategy, you can tag me around and can ask me either you are doing the correct, or all right, you want to improve yourself in your analysis. You can tag me, and I love to discuss, and we can share ideas together. All right, and maybe you can learn, you can um, fast track your learning and practical session. Right. You can publish your idea, right? You can publish your idea here, right? You can see what is the idea title, and can say what your idea is all about, and you can tag people around, and you have to set your categories. Either it is trend, harmonic, chart patterns. Usually I just put trend analysis, chart patterns, and wave analysis. That's what my analysis is all about. But in this, before you publish your idea, you have to click at least 3 of this box in this category, and this is optional. Either you want to tag right, this is optional. This is quite optional. If you want to, right, it's all quite optional. All right, box. Either you want to get into this either you want to get like you have done an analysis before and you want to take a new analysis and get that new idea tag to the old idea. You can use this, right? But it's not that important. You can always pause, publish a new idea, and if you put publish public idea, it's all live and people can see your ideas, all right, on technical analysis. Right, thank you. In this topic, we will go through Japanese candlestick chart, and I will go through my words, Microsoft Words document, the material on the Japanese candlestick chart, which is available on the resources. So you can download there. And in these videos, exclusively, I will go through to you what are the contents, and especially the details on various candlestick charts thoroughly, and we will discuss what is the function of candlestick chart and even the weakness of the candlestick chart, right? So this document called Japanese Candlestick Chart Simplify. So this is copyrights of Advanced Chartist Academy, and in this Word document or maybe PDF document, I will give it to you guys. This is I will explain on the introduction and a little bit history of candlestick and how to read again candlestick reading. Actually, this has been we had gone through this from our previous videos, but we just go through fast and you know, just recap what we had learned from the previous video. And now we will see the various types of candle. Now we will see various candlestick and what it is, what the results of its forming, and what are the sentiment it makes in the market. All right, and I will share with you various candlestick strategy that people use to determine market trends a little bit, yeah, using candlestick on determine market trend. And also, last but not least, I will cover on the weakness of candlestick, right? Many people regards candlestick as the master of all learning, right? Master of all secrets in trading, but actually it is not, all right? It is not. Now, later I will explain to you. In a moment, I will explain to you on what is the real function of candlestick and what it is used for and what are its limit, all right? And history of candlestick is actually originated from Japan. It used in rice trading in 1600, as you can see, right? And right, it is in form of a candle, and that's why it is called Japanese candlestick, because it's originated from Japan, all right? And it's originated from 1600 to trade rice contracts, all right? And the Japanese candlestick charts, as far as we know, that it is very easy, and at that time it is become very popular due to the level of ease reading and understanding the graph, all right? The Japanese rice traders also found that the resulting charts would provide a fairly reliable tool to predict future demand, all right? And actually prediction, not much in candlestick, but I believe that it is not reflect the future demand, but actually it's reflect a little bit on price movement, right? Price movement that you can see, and I believe that people can see trends on the commodity back then, all right, because of the candlestick chart. And a person named Homa Munihisa, all right, a rice trader from Sakata, Japan, he is the one who organized the Japanese wisdom, developed and used candlestick charting use candlestick charting, and he is the one who he is acknowledged as the leading authority on the subject, right? And he is the one who developed candlestick up until now, and the one who is responsible to get this candlestick chart from the Japanese, all right, to the introduce it to the Western world is a person named Steve Nissen, right? He is still in the US right now, so you can Google his name and you find Steve Nissen, which is the founder of Japanese candlestick chart.
techniques. All right, he is the one who bring candlestick chart from Japanese to the West. Right, and I think he made some improvement on the Japanese candlestick chart strategy. Right, and this is the person named Homa Muniesa. He is the one who developed Japanese candlestick, and this is Steve Nissen, right? He is the one who introduced candlestick to the West. Now, Japanese candlestick chart, all right, allows a quick read on changes in supply and demand by analyzing the daily movement of an issue using candlestick, all right? A trader is able to confirm evidence of trend reversal very early on. All right, by analyzing the daily price movement, actually it is not only daily. In any time frame, 5 minutes, 15 minutes, there is candlestick chart, even monthly, even yearly. There is candlestick chart people can use to analyze trend in the markets. And actually, candlestick chart is very important to identify price reversal. All right, it is most useful to identify price reversal or a momentum. All right, depend on candlestick. All right, and this is a very strong indication or signs to trader. Either the buyer are coming in at the first hand, or the seller are coming in aggressively in the market and resulting in the market to be bearish, right? And candlestick chart are able to do this, all right, give these signs by using solely on candlestick chart alone. But actually it is not only depend on one candlestick, but it also depends on the whole major structure of a trend, a whole major structure of a chart. So if you want to see a strong reversal, all right, strong reversal in the next bullish trend, all right. So for example, like if you see Marubozu, a certain kind of candlestick pattern appear on the first candle of bullish, so it's indicate of a very strong momentum upward. All right, so this is the way that people use and use candlestick, and surprisingly it is very, very effective and accurate. All right, and it is very reliable, right? But candlestick cannot be used solely by its own candle. All right, it has to be used with others analysis. For example, like support and resistance, you have to identify which point the price gonna reverse, and you has to anticipate that the reversal is going on in that particular area, for example. All right, and actually candlestick at the price reversal, it is always used to confirm that market reverse, but actually it cannot be used to analyze. It cannot be used to analyze either the trend gonna go in a very strong upward or downward. All right, so candlestick draw an inductive as opposed to deductive view of markets. The facts are presented graphically. Actually, it is easy to see and easy to understand market movements. All right, and candlestick graph is comprised of both red and black for bearish and green and white for bullish. All right, and sometimes there is wicks at both ends. Right, as you can see here, the black candle, the green candle is usually indicate a bullish sentiment is coming in, and the red candle is usually the bearish, right? It's the bearish. So it's also a white candle also indicate bullish, and the black candle is usually referred to bearish. If this is the first time that you see that, right? Bullish candlestick, a single green white candlestick body highlights that opening price was at bottom of the body of candlestick, right? Easy to say. if you see a bullish candle, it is open low and it's closed higher in the right, and the real is this will resulted the real body to be green on white, and you can see that this is weak, between weak on above and below of this real body, which indicate that during that day the 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 price move along this price. All right, this is about the trading range during the day, and this is the high and this is the low. And for bearish candle, all right, for bearish candle, you can see that this is the same, but actually is open higher and close lower, and it is in red or black in color in candle form, right? So all right, we go to the various types of candlestick. We can find this is number one is Marubozu, which is, you can see regarding on Marubozu, there is no wicks, right? There's no wicks and there is only solid body. There is only solid body, and a candlestick with no shadow extend from its body either at open, close, or both. All right, there is no wicks up, down, and the sentiment is for black candles, sentiment is bearish. For white candle is bullish, right? But it's depend on the position in the market. Now in Marubozu secret, all right, you will discover a secret on Marubozu positioning in a trend, and it's pretty reliable for you to use it to analyze your trading. All right, and this is Harami. So you can see that this is you can see Harami, the first candle will be black, and the second candle, all right, the second candle, the white candle is inside the body of, whole of the body of a white candle is inside the body of the black candle. So this saying that the bullish sentiment is coming in. All right, so you can see the previous trend is downtrend, so maybe at the support it shows this bullish Harami and change its direction for a while, right? So the same goes to bearish Harami, but the difference is open at the higher part of a trend. So you can see initially the trend is going up, and at the resistance, this bullish Harami, the second black candle appear, and within this white body, candle body, and this indicate a bearish sentiment. All right, in a bearish sentiment. So if you see this, so this is indicating the price maybe temporarily will reverse or permanently will reverse downward. All right, this is a very strong indicator. So right, we can use that, but it cannot be used to as far as I say to you guys, candle cannot be used to predict either it is permanent or temporary going down. Either it is permanent or temporary reversal, right? But at some certain point, at some certain price, we are anticipate that reversal are coming in, and this is piercing. All right, as you can see that this piercing candle, all right, this second candle close higher than the first candle more than 50% of its body, and it's cover more than 50% of its body. All right, and for the opening, it opened gap down, and yet the buyer coming in is close higher more than 50% of the first black candle, and this resulting in a bullish sentiment of the market. All right, bullish sentiment are coming in, and the reversal of price will occur. And okay, this is the doji. And as far you can see that for the doji, you can see the open and close at the same price, and it's resulted in this one flat area. There is no real body, so the sentiment is actually natural. We can't predict what happens. Sometimes it's usually a certain support and resistance to indicate a price reversal, but sometimes we have to confirm it by seeing which the next candle of doji. All right, either it is going up or down. All right, so if the next candle close up, then this doji, this neutral line, so it means the next candle would be, the next sentiment would be bullish, and vice versa. If it closed below this neutral lines, or the next would be the black candle, and it is strongly indicate that the price gonna be reversed downward. All right, so next is bullish engulfing. So as far as you can see that the long white candle cover all the previous black candle, so this is what we call a bullish engulfing, and that it is how this pattern get its names from the second candle engulf the first black candle. All right, so this is what we call a bullish engulfing, right? And when we see this, we know that sentiment is bullish, right? The sentiment is from seller to buyer are coming into the market. And for bearish engulfing, it is mirroring the bullish engulfing, where you can see the second candle or the black candle engulf the first white candle. All right, and this indicate a bearish sentiment in the market, so the market are going down. And abundant baby, what is this? All right, and as you can see that when we make our analysis, all right, when we saying this, Marubozu is a single candle. All right, it's a single candle. But for Harami onwards, we can see that we need at least two candles to work together in order for us to recognize what is the sentiment of the market, all right, in the next candle. So you can see that we need at least two here, at least two here. All right, for doji, we need one, and to confirm, we need another more one candle. All right, to confirm either it would be an uptrend or downtrend. Bullish engulfing, we need two, and bearish engulfing, we need two, and for abundant baby, right, this is quite different because we need three candle in order for abundant baby to form. All right, so you can see that for this abundant baby, you can see the previous is black or white candle, but actually it is followed by a doji, which is this doji gap down from the first candle, right, from the first candle, and the third candle, the last candle gap to the opposite direction. This indicate a reversal in process. All right, the third candle shows the real direction. For example, in this trend, as you can see that this black candle, after this black candle occur, the doji are formed, and the next, the white candle are forming, and hence actually this market at this point, the market has reversed upward, right? And this for hammer, right, this is a single candle, right? And for hammer is actually, you can see that the requirement for a hammer to happen is that this wick is 3 times longer than the real body, right? You can see this real body is 3 times shorter than the wick. So if this happening, so we can say that a hammer is performing, and this hammer usually appear at the trend reversal point. And this is quite similar to abundant baby, but the difference is, right, this is the same. The second candle gap down, and you can see that the second candle here is indecisive formation, all right, and the third candle is white and should close at least halfway of the black candle, all right. So you can see that this candle at least covering the first candle at least 50% of the first candle, all right, and we can conclude that the morning star pattern, candlestick pattern, has appeared. And the evening star is vice versa of the morning star. It is usually occur at the top of a trend and is indicate a bearish sentiment in the market. And for shooting star, all right, one candle pattern appearing in an uptrend, the shadow or tail should be at least 2 times of the length of the body, right? We can conclude that we can say a hammer is happening at the top, all right. A hammer occurring at the top, which indicate the price reversal. And you can see that the color of the body is not important, although a black body has slightly more bearish indications, all right. And the sentiment is bearish, or the sentiment is changed. So now the interesting part is that a bullish kicker, all right, this is a strong sentiment change indicator, where if there is a strong massive sales, all right, a massive sales of the day before and today, and the next day it's gap up to form a really long white candle, we can conclude that the bullish kicker is forming, right? And what this bullish kicker indicate is that it's indicate extremely bullish signage, all right, to traders. That the sentiment is changing from seller to buyer, all right. And this is a really crucial signal, because it's also really pretty reliable at some certain price point, all right. And because of it's easy, right, it's easy because of the previous day, the first day, it's really bearish, and suddenly it's gap up, all right. It's gap up is another one thing, and it's forming a white candle, a good long white candle. This saying that the sentiment is totally changed, all right. And aside of bullish kicker, there is also a bearish kicker that is opposite candle formation from this bullish kicker. And the next is dark cloud cover. So actually the dark cloud cover is I believe that it is the reverse of piercing candle, right? It's the reverse of piercing candle, where this dark cloud cover is happening at the top of a trend and is indicate a bearish sentiment of the trend, right? This is all, we know that this is all candlestick that indicate a reversal, right? Reversal price point. But for this candle continuations, all right, this indicate a continuation, is not used for price reversal. If after a price reversal occur, when this 3 white soldier are forming, so it's indicate that the market are still in bullish, and maybe we don't want to take profits, or maybe we optional to let our profit run. Now the importance of candlestick, right? The importance of candlestick upon several years in the market is actually candlestick is used mainly for price reversal indicator, all right? The price reversal indicator at anticipate point. Actually, you already know that usually we already analyze that at some certain points the price gonna be reversed, and candlestick would would confirm that will happen. All right. And for example, like it's going down, it's going up. So we anticipate from this sideways movement, there is a price reversal candlestick occur at this place and at this place. All right. So now this is one extra knowledge on how people use candlestick, all right, as an important signal. For example, like this doji, as one I tell you is that doji could produce, although it is in an indecision between buyer and seller, it also can indicate you that the price reversal are coming in. And how did we use and how did we analyze that price reversal is it has its own rules. All right. For example, like only after a long trend at anticipate price point, we can anticipate reversal would occur, and this doji is valid, right? For example, like if there is a resistance line at this this point, and there is a doji appear, so this doji would be likely indicate that the price reversal are coming in, right? For example, like this three candle would be a white candle and suddenly a doji appear, and there is chance that market gonna be reversed. All right, and this doji does not really well used for middle trading range. All right, this is end of range, this is doji at the middle range. For example, like you can see here, if it's in this box range, this doji is not really reliable to depend on this doji because it is on the middle of the box range. We have to see the signal at the support and resistance of a trend line, so we can estimate the price reversal gonna be occur. But you have to remember this is that after a doji performing, the next candle would be very crucial in determining the real direction of trend. And this is some techniques that forex trader, other financial trader use to analyze the market. All right. And this is what we call a candle trending method, where you can, all right, this is what we call a candle grouping, and this is single candle. So if the last candle, for example, like this first box, you can see that the second and the third candle engulf in the body of the first candle. So actually this is one candle. All right. And all right, if it's the candle break out from the highest candle, so we calculate it a new number. So what is this what this brings is that after 4, right, there will be 8 and there will be 12 candle, right? So you can a little bit predict trend. For example, like if 1, 2 happening, it's likely that 3, 4 are performing because it has to satisfy this rule. And if 5 is forming, it's likely to go to 8. All right. If 9 are forming, it is likely to go to 12 candle. All right. This is how did they use candlestick to predict trending. All right, to predict trending. And this is how also you can let your profit run. So if you seeing this, right, that is happening, 1, 2, 3, and 4 and 5 are forming, is likely to go to 8. All right, it's likely to go to 8. that is the best. This is the best way you can use candle to predict trend. All right. In other methods, you can't predict the trend of the market. So what is the weakness of the candlestick? Right? What is the weakness of the candlestick? Now, this is the major loophole of the candlestick, right? Where people are using candlestick everywhere, and they think that candlestick is the secret, and right, give them all answers about the movement of candle or movement about the market, but actually it is not, right? It is not. There is another reliable method that people use for prediction or price target that is pretty accurate. For example, like Fibonacci, right? Fibonacci has been proven to be really, really effective in and really, really reliable in analyze profit target. That you will learn about Fibonacci in Fibonacci topic, right? In this course. Right. When it is not give you price target, actually a price, for example, like a price reversal is actually unreliable method. All right, it's unreliable method because you can't say either the bigger trend, the strong trend is going to be upward or downward. So we are interested in let our profit run, and if we want to let our profit run, we have to see in a bigger picture either it's going upward or downward. But if we cannot predict downward or upward or downwards, we might get trapped in a market movement. All right, if because we actually do not want to trade only for 1 or 2 days. Actually, we want to maximize our profit and let our profit run as big as possible. This is the job of a trader, and many traders and investors become really, really rich because of they let their profit run. Right? They doesn't really get involved in their trades. All right, there is no attachment, emotional attachment to their trades. So, in terms of predictions, a long prediction candlestick cannot provide you the answer. You have to learn Fibonacci, for example, in order for you to predict accurately the price target. And one more thing about Fibonacci, you have to use it correctly. If you do not use it correctly, you do not get a good result. Right? You will get inaccurate results. So we don't want inaccurate result. We want an accurate result and high reliable strategy to give us options and to give us extra advantage in analyzing in predicting the big movement, right? And usually candlestick has been used with other technical analysis, so it can't rely on its own. So for example, like it can be used with moving averages in order to confirm that the trend reversal is going on upward in the future. All right. For example, like moving average is lag indicator. Candlestick is more earlier indicator to for us to see the signs either the market going to be reversed or not. Actually, EMA is a lagging indicator, so it's actually used to confirm that market trend is reversed. All right, but this is the secret. It's not really reliable, so you have to rely on a method that is pretty reliable, that involve in prediction not only at that moment, not only in a small short period of time frame, but actually for days or weeks. All right, and the maximum days that people, or the maximum candle that people can rely on candlestick is around 4 candles. All right, And after that, you can't really use candlestick to predict, right? It's only you can be used for predict in a short period of time frame. That's why when you talk about candlestick, it's only short time frame movement. Many scalper or very short uh, day trader using candlestick candlestick to analyze to include candlestick in their analysis because of it's only for short term, right? If you want to predict for a very long period of time, you can't use candlestick, right? I hope you learned something here. See you in the next section.
So in this topic, we will recap on various market movement. So this various market movement is essential for us to make a decision in the market because we want to make decisions. We want to buy in equities that is goes along with the big major trend. All right. So basically, what we will cover in this topic is that we will learn and discover a few market trends that exist in the market, right? And for trend number one, right? Right. This is what we call, all right, an uptrend movement, right? So how did an uptrend can exist? Is that all right? So we take this as a low point, and this is the high point, and when a stocks move, all right, and when the stock price move, it move up, it move down, it move up, it move down, and it move up again. So when the market make this kind of movement, all right, for example, like this is low, this is high, and this is the new low, which is what we call as the uh, high low, all right, and this is what we call as high, all right. And when the stock move again high low and subsequently move to high, and this is what we call, all right, an uptrend movement. when when the stock make this kind of movement, all right, uh, when the stock price move high and high low, right, it means the market is in uptrend, right? So what we want to do in market when the market going uptrend is that we want to buy low and sell high, right? What it means by this is that you want to buy at this price or this price or this price and sell at the higher price, all right? So why this is because why we want to buy low and sell high is that because when the market move in uptrend again, most of the time the the market is in uptrend movement, all right, if compare to downward movement. If we invest, we want to buy low and sell high during a downtrend movement, so we might see that our position would be negative, all right, because of the probability of the stock going up is low compared to an uptrend movement. So So number two is we will discover on a downtrend movement, right? On downtrend movement. So how did this downtrend movement, right, created? Is from, right? It's a mirroring from an uptrend movement, right? So this is low, this is lower high, and this is lower low, this is lower high, and subsequently making a new low. All right. So when a market, right, when a stock price move in move lower high and lower low, it means the market is move in downtrend. All right. So what we're gonna do is we want to short a position in this market condition, or all right, rather we stay aside. All right. If we are looking forward to buy low and sell high during this market condition, which is downtrend movement, so we want to stay away from the market. All right. So why is this? Is because vice versa of an uptrend movement, most of the time the stock price is going downwards compared to upwards, right? So if we try to buy low and sell high during a downtrend market, so we might find that most of the time the stock price is red, all right, or negative, all right, if we invest in a downtrend movement. Okay, so that's why we don't want to invest during a downtrend movement. So the next movement is what we call a sideways movement. Now this sideways is pretty special, right? It's kind of a little bit different from uptrend and downtrend, where in uptrend and downtrend we have a direction, all right? Either it is going upwards or downwards. So if compared to sideways market, all right, for the first, for sideways market, all right, so what you can see here is that, all right, this is the first high and this is the first low, and this is in the next high it's making lower high, and the next low is making high low, and the next again subsequently making low high and it's making high low. So in this market conditions, right, you can see that the market is moving in sideways. All right, when the market move in, right, lower high and high low, it means that the market move in the market move in, right, the market move in sideways. Okay, so what you can see here the stock price contracting into a wedge, right? Forming a wedge. So what you can see here is that from this price to this price, it ends up meeting to each other, right? This line to this line, and it's end up meeting each other. So it's contracting. Upon time, it becomes contracting. So in this sideways market, we again saying that this sideways market does not have direction, right? Is this is usually happens when the markets in corrections, right? Correction periods for sentiment change, right? Now, this is the first sideway, all right? So next, we want to see the other sideway which exists in the market is that, right? So what you can see here, all right? Assume that this is our first low as usual, and this is our low. This is high, and this is making lower high. And subsequently, the movement making high. So at this stage, right, at this stage, when the markets move in high and the low making lower low, right? This is supposed to be uh, right, supposed to be lower low, right? Making lower low. It means the market is moved in sideways, right? Why does it move in sideways? When we talk about sideways market, again, it has no real direction. Either it move upwards or downwards, right? Again, this usually happens in a correction period, right, of stock price. So what I mean by correction is that it's in a process of determining either it will goes up, it will continue to goes upwards, or changing directions downward. Right? So this is what we call as a sideways market. And as you can see, the difference between these two sideways market is that the first one is contracting, all right, and the second one is diverging, all right. This diverge. Okay. So at this time, we will say that this movement is in sideways market. So what we can do in sideways market is usually, all right, it is an opportunity for us to, right? It's an opportunity for us to speculate, right, in the sideway market. Right. So when you goes long, or we want to buy low and sell high, you are looking forward to an uptrend market before you invest, right, in the market. So this is very important knowledge because this is a very essential. This is quite pretty basics, but it helps you a lot in making a profitable trades in the future. Thank you. Okay, guys. So today we're gonna recap on a topic from my experience for a few years in the market. We're gonna discuss on a topic: what makes a good strategy for stock trading. Okay, in this brief presentations, I will help you to discover on what makes a strategy a good strategy to rely on. Okay, because this is always a problem for beginners because they do not have guidance, they do not know what strategies are available and what are the strategies that works in the market, right? Most the strategies that um, beginners start off, it's always not a good strategy to rely on. That's why it's called a beginner strategy. All right. So in this presentation, I will share with you on my experience on what makes a good strategy, and we can rely on that strategy. All right. And right, the best trading strategy is a strategy that be able to predict. All right, a good strategy enable us to predict market trends, right, precisely. All right, most of the strategy that we learned that beginners use, uh, that are mostly rely on the technical indicators, are not a good strategy to rely on, or are not a good method or tools that I find not really useful. All right. So if you want to learn a good strategy that be able to predict the markets, uh, you have to see and learn what the materials that I'm sharing with you guys in this course, right? In this course, I will be able to share with you multiple strategies that allow you to predict market trends. Right? Why beginner strategy, mostly the technical indicators, is not a good prediction method? It is because most of them are lagging indicators where it works based on the previous information, all right, based on averaging previous information for current standing, right? It yield a uh, current value that is based on previous numbers, previous information. So usually this is not a very good strategy because this strategy is not unable to predict the market. All right. The longest term that they are able to predict is maybe like 1 to 4 days period. All right. In or precisely 1 to 4 candle. All right. And it is not being useful to predict long trend. All right, and either because we want to predict a huge market trend, so that most of the time we are in profits and we are able to let profit run. All right, to let profit run, or in short term, we knows that the market gonna
goes up, all right, based on the strategy that able for us to predict the market. And most of these strategy that are unable to predict markets, all right, or have low predictions probability is mostly the technical indicators such as the EMA, RSI, MACD, and other technical indicators. Although this is quite good indicators that help you to make predictions, all right, this all of these indicators uh, are unable to help you to predict major trend. The next, the second point that makes a strategy is a best trading strategy, all right, it helps you to be clear and concise on your trading plan, all right. It's although we the plan had made beforehand, all right, a good skill and strategy enable you to change and adapt to market changes. All right, although you have planned everything beforehand, before you get into the market, before you get to buy the equities, the next thing that you need to do is you have to be flexible on what the market, all right, what the market shows you. So you cannot fight the market. So what you have to do, you have to be flexible, you have to be dynamics according to market changes so that you are not getting trapped when the market goes against you and you are able to take profits from time to time, all right. And most importantly, it helps you to be clear and concise on the market behavior, all right, on market behavior. And the third one is instill confidence in taking your action. If you have a best trading strategy, right, uh, you have the courage to take action, all right, because you know that at some certain moments the market goes into your direction against your directions, and hence most of the people they make big losses in the market because they are panic, all right, when the market goes against their directions, their predictions, and they are unable to take actions, and hence uh, the market goes down even further, and they are unable to realize their stop loss. All right, when you do not have a good trading strategy, you do not have confidence in taking your action. But when you have a good trading strategy, all right, it comes in all package that you are more confident in taking actions, either taking your profits out or prevent major losses in the market. Right? Believe me, all of these criteria makes a good trading strategy, and it helps you a lot in uh, in your in your trading career. Hopes benefited. Thank you.
Right, hi there, guys. We will start our learning on this first topic, which is regarding on supply and demand. Uh, Actually, this is the most fundamental concept, and for me, it is a very important concept for a chartist to learn, for a technical chartist to understand, so that because this is the very basic, right? This is we come to very basic. This is a very fundamental of how did we doing our analysis, all right? And before we go further into the very technical part and deeper knowledge in learning our technical analysis that include forecasting and prediction, you must understand what is supply and demand, all right? You must understand what we are doing here, all right? We are doing later on, so that you have the basis of what's going on, all right? What we are doing into, and so that you understand, all right, the concept of people investing in the market, all right? And it is very crucial knowledge and to make a high accuracy and produce an accurate probability trading results. All right, when we talk about supply and demand, actually we are talking about doing the technical analysis. All right, you have to understand and you have to master and really understand supply and demand concept. And in this topic, you will learn on how to draw supply and demand line in the practical session, but in this session you will learn on the theoretical knowledge about supply and demand. And I could promise you, if you understand supply and demand, but it is not really that hard, yeah, you will be in a good hand in the future. All right, now one of the supply and demand is one of the fundamental concept in trading in any financial equities. Why? It is because actually any product, any financial equities has its own supply and demand. We look upon many other commodities, yeah, for example like gold, all right, Bitcoin, all right. In any traded instrument, financial instrument, there is supply and demand of that equity. So that's why we need to understand supply and demand. And even in even traded shares, stocks, forex, it has its own supply demand chart. When we talk about supply and demand, we are talking about the technical analysis. All right, technical analysis. And you know, common sense that if you realize this, is that all people in the world that trade a particular stocks, all right, looking at the same charts information as you do. All right, when trading, even for many guys, right, saying that they do not believe in technical analysis. All right, they are always doing the fundamental, and some of them are not a believer in the technical analysis. All right, they might not even understand what is technical analysis. All right, they might not believe it because they do not understand what's going on. All right, and like I'm saying, that everyone are looking at into the same charts when they are trading. All right, and we are not only focusing on the technical. All right, along with company financial background is actually the price movement, which is the supply and demand, is an very important criteria to be profitable, right? To maximize your profits, because it gives you an accurate entry and an accurate selling point, because it be able to say so to you. And if you are looking forward to trade in a very short period of time, then you might want to learn an effective supply, demand, or technical analysis strategy. All right, and that's why actually we need this analysis. We need this knowledge in order for us to be successful in the market. All right, because when we try to get entry into the market, we want a good sweet spot that is the lowest price as possible. And right, and this technical analysis are also be able to tell you, right, what stock would be in the rally in the next term. All right, by knowing supply and demand lines, you will be able to identify this kind of stock, all right, this kind of shares. All right, and this is the beauty of technical analysis. All right, and many traders, all right, either short, medium term traders, use supply and demand knowledge to trade. All right, they use supply and demand knowledge to trade. All right, it is because when you talk about supply and demand, we are talking about the shares itself basically, and we are not talking about the fundamental. All right, we are not talking about fundamental, although fundamental is an important criteria to be inserted in our analysis. But when you talk about technical analysis, we are talking about the supply, demand, which is we want to identify the aggressiveness of buyer and seller in the market. All right, because we are taking into a perspective that shares or stocks itself is a product. All right, is a product that we want to know what is the sentiment behind, and we want to know what happened to the price now. All right, either it is overvalue, either it is either it's very high or very low. All right, or it's an opportunity to buy. All right, that's why technical analysis give you a knowledge or information about what is the price now. Right, what is the price now? Either it is suitable for entry, or is it suitable for selling, or it is not suitable for buying. All right, so this supply and demand knowledge, all right, many successful techniques, all right, has been developed from supply and demand knowledge. All right, you would see a lot of people are coming out and introducing a lot of new strategies, either short term, medium term, or even long term. This is all from supply and demand knowledge. All right, and you must understand supply and demand. Then this would be very, very advantage for you, because you know the basis root of many successful strategies. And from this course, all right, you will discover a number of successful strategies or simple patterns that you can see, observe, and implement. Take action by getting in the market when you see the patterns, and be profitable right away in the market. Right. And again, this supply and demand it has been created because of repetitive of human behavior in investing. All right, and people are recreating, rebranding a lot of new strategies, a lot of supply and demand knowledge, and they recreate rebranding as a new product and strategy. All right, if you understand about supply and demand, this is not a new strategy. All right, this is not a new strategy. This knowledge, supply and demand, has been introduced to people a long time ago, since it has been created since the 1900. All right, and this is actually an important knowledge for you to master. And we start with identifying the supply and demand line in the market in this course. All right, and the supply and demand knowledge, or by learning the technical analysis, we would able to sign a pretty accurate sign of entry, and seeing if there is any reversal point that we at that point we want to take to be in cash and protect ourselves from the downside market, or any potential movements that move against us. All right. Now, when we talk about supply and demand, all right, before we talk about supply and demand, right, I want to talk about this one thing regarding on these two knowledge. Actually, this is when we go to any courses or any stock market learnings, a successful trading and investing strategy in any financial instrument involved in these two aspects. All right, and we want to talk a little bit about these two aspects, which is the fundamental and the technical aspect, which is the technical analysis of any equities, by meaning supply and demand. All right, first, these two criteria, these two elements affected, all right, affected the stock price in a very big way. All right, a very big way. It's affected the stock price very big, right? And that's something we already know about, right? And first, we want to talk about the fundamental. The fundamental of a company, which include all the criteria in its fundamental financial income statement, which might be include earning per share, which is regarded among the most important ratio in fundamental analysis, along with other fundamental criteria that also very important, like other earning ratio. And people say what most important is future profit growth of a company, and even the simple revenue profits, and also the business common sense of a company. All right, is very important of analysis that we had to make in order to have a very successful career or successful stocks and shares. All right, and fundamental is actually a bottom approach. All right, it's actually a bottom approach of buying shares of a company. What we mean by a bottom approach? All right, a bottom approach is a process of identifying a company background. All right, is a bottom approach that we want to evaluate a company, and we want to see either the company has a strong business, either the company has a very good fundamental in any area that could attract a large amount of investors for a very long-term period of time. And actually, this fundamental is a long-term strategy, and a lot of investors like these fundamental strategies, because it's considered to be safe, it's considered to be not aggressive, and some of the high income high net worth individuals or company really don't like too much volatility. All right, they like a steadily growth, and they like a company that doing the real business, and they do not like any speculation or of shares and stocks. All right, and what they want to identify from this fundamental analysis, all right, they want to identify, and in the end they want to identify either this company is undervalued. All right, it's undervalued from their valuation, and if it is undervalued, they will find that this is the price where it is an opportunity for them to buy, and they believe that the price will go up in the future, and or it is a overvalued price. All right, compared to its current price. When it's overvalued, they are maybe looking forward to sell, or they are maybe looking not interested into this particular stock, right? If it is overvalued. So what they want to do is they want to evaluate a company in terms of its business valuations. All right, and then they want to see either the company is really good stock to buy or not. All right, it's this simple. And again, it is a long-term approach. And what do you think that what make it is a long-term approach? All right, and why is this happen? Because of if you see in terms of fundamental, they had to do research, and they had to do financial analysis. All right, financial analysis from the financial income statement. Now we can see that income statement being introduced, being provided for investor in a quarterly manner, all right, in a quarterly time frame. All right, so actually in a year there is only 4 quarters where a company compulsory to give this quarterly report about regarding on their financial standings. And because of this quarterly results that is quite slow, all right, where the information is quite slow compared to the technical analysis, where we can see people behavior, trading and investing in the market at any particular time frame, the fundamentalists have to depend on the quarterly report. So they cannot do anything unless they see something happen in the company during the quarterly report being introduced to them. So that's why sometimes this had made it is a very long-term approach, all right, and they don't want right, and they do not want volatility, and they do not want any not stability of stock price. All right, they want a stable stock price with a good financial with a company that is having a good financial standings. All right, and while technical analysis, all right, in the technical aspect, let's say that all right, why this technical aspect has been introduced and has been a reliable method for a person or individual. Is not a compulsory, but is an optional for people who doing trading and investing to look at the technical aspect. When we say about the technical aspect, all right, the basis and root of this or this analysis is actually stocks and shares is actually a product itself. All right, it's a product itself. They do not consider that this shares or stocks is a company, although it is related. But actually, when you're doing analysis of in terms of the technical aspects, you will know that this shares and stocks is a product itself. All right, it's a product itself. All right, it's being open to people for buying and selling. It's open for people in the auction marketplace, for people to quote the ask and bid price, and actually it is in trader and investor sentiment of how many people are desire in buying the stocks and how many people are desire to sell the stocks. And this, because of this, all right, sentiment between buyer and seller, it affected the share price in a very big way. All right, just like the fundamental. All right, if that's why you can see if a stock, all right, if a stock has a very good valuation, has a very good fundamental, but if there is no trader or investor, all right, does not, all right, have a desire or has been not interested to buy the shares or stocks, all right, you guess what will happen next? All right, the stock price gonna flunk, all right, the share price gonna go down aggressively, even there is a very good fundamental behind the company. All right, it has a lot of contracts awarded, but if there is no people are buying into interested into the shares price of that specific company, the share price gonna go down. All right, because the share price itself is a product. All right, it's a product that people buy and sell. All right, I hope you understand, because this is a very good understanding after several years of my experience in the market, and I'm looking forward. I'm always try to search for an answer for this, both this criteria. How does it impacted, or how does it affected the share price, right? And actually, when we talk about the technical aspect, all right, and it's actually it's actually a kind of behavior of people invest in a particular stock. All right, it's a behavior of people investing in the market, and this behavior is actually has been repetitive over and over again. It has been repeated over and over again. So that's why you can see this behavior has translated into patterns, all right, into patterns that is easily recognizable, and we can see that the progress of this pattern in the stock market, all right, in any shares, all right, in any shares, we be able to see the progression of this stock and shares, all right, stock and shares, and use this to predict what will happen next. And surprisingly, all right, surprisingly, this is quite accurate, all right. It yield a very accurate result, and it yield a very good information about what will happen next on the price, all right. And most of people on the technical analysis use this information to ride the wave, to ride the swing, in order to get profitable in a very short period of time. Unlike for fundamental, all right, they does not care about either the price goes up or goes down. They are looking forward into a very long period of time, and they doesn't care about either the share price goes up, goes down, goes up, goes down, either it is sideways and it goes up again. They doesn't care about it, all right. What they want to know is after a few years later, and then they want to know what will happen to their stock price, all right. And for technical analysis or technical analysts, they try to ride in the wave. They try to, all right, to take advantage of the upswing movement and be profitable, make money from it, right. And that's we want to do, right. That is what we want to do. And throughout the course, you will learn how to be a good technical analyst by recognizing some simple yet very, very effective patterns that is happen again and again and again in the market, right. And this is people had been highly profitable because of this strategy, because it is not only reliable, it is very accurate, and it involved in prediction and good forecasting what will happen to the stocks in the next, all right, in the next movement. Now, all right, we can see that in terms of supply and demand, we can see that the market move up and move down, all right. As we had been discussing this earlier in the basic course, that a stock price move in a zigzag pattern, all right, in a zigzag pattern, all right. And then as far as we know, that there is no stock move in either straight up or straight line, all right, either, except that it is a speculation stock. But this is not normal, all right, this is not normal. And although the price goes up very quickly in a speculation stock, but it's also involve a very high risk, and if you do not have skill to get out from the stock, you might be trapped in and lost your money in the market, all right. And this is something that you don't want to do. This is something that you want to prevent yourself from. But after you learn some easy pattern that I'm gonna introduce in the whole course, please do subscribe again this whole course, because it is really effective, and it is really produce a good it is really enhance your skill and can help you making money in the market abundantly, and also protect yourself from any reverse or any major downward movement, all right. But of course, when you learn about all the skills, what you need next is that you must sharpen your skill over time, all right. You must sharpen your skill over time, all right. Again, this might take time, and then but if you learn the right knowledge throughout the course and implement it, all right, you may get instantly profitable in the market, all right. As far as we know that the stock market and price, all right, is not random, all right. It is not random. You can see in the end anticipated the next movement by analyze the supply and demand line. All right, and then this is very good. Is because that we can identify what is the trend now. What is the trend now? So we want to surf along with the trend. All right, we don't want to go against a trend. All right, now you must understand that in any particular time there is buyer and there is seller. All right, there is buyer and there is seller changing hand. So what you trying to do, what our job is that we want to analyze which one is more aggressive. All right, which one is more aggressive? Either the buyer are dominating the marketplace or the seller is dominating the marketplace. All right, if the buyer is dominating the marketplace, and this is the time where we want to get in the market and ride in the profit. All right, for the bullish trend, right, for the uptrend. Right, when we talk about the uptrend, right, we want to get into a majority. So if you are looking forward to get profitable in the market by buying low and sell at higher price, so you want to make sure that you ride along with the uptrend movement. All right, you are not looking forward to buy during a major downtrend movement. Right, you have to remember this, because of if you buy in an uptrend movement, it's easy for you. It is because majorly at the specific time frame that you buy the equity, most of the time of the candle, for example, it will majorly move in upward movement. All right, and supply and demand line also available and shown in any time frame. All right, it depends on what you are searching in the chart, and because of this availability of the price movement in minutes, hour, daily, weekly, and or even monthly time frame, you are able to take advantage of the movements. All right, according to your preference. All right, for example, if you would like to make money in minutes, so what you must do is actually you have to buy in you have to open up a minute time frames, and if there is a lot of high liquidity and frequent and high trading frequency of that particular stocks or shares, that is the time that you want to get into the trades and take advantage of the profits of the movement in minutes time frame. All right, it can be done in hourly time frame, daily, or even weekly. Usually when we talk about weekly and monthly, we are looking forward to a more longer time frame. All right, in a longer time frame. So demand, all right, supply and demand. Now we go into definition of a demand. Is actually demand refers to how much a product or service is desired by buyers. All right, the quantity demanded is the amount of a product people are willing to buy at a certain price. Right, now we can see that when demand is higher, all right, when a lot of people are desired to buy the stocks, for example, to buy a product. All right, if the supply is the supply going downwards, all right, it's going downward, or the supply is even fixed, does not change, and the desire of people want to buy, and what meaning by this is more people want to buy the equity, it will resulted the price going up. All right, going up higher in the future. Right, this is basic supply and demand knowledge. And all right, and what you want to do in the market is that you want to buy share price that is really high in demand. All right, really high in demand. When the buyer become more aggressive, that is time when you want to get in the market. All right, or if there is a lot of seller, all right, and the seller become less aggressive from time to time, that is when you want to get in the market, because you know that with a higher demand, the price will go up in the future. Now, right, what is supply? Right, supply is represents how much the market can offer. In this, when we are doing the technical chart, is actually we can refer to supply. We can refer supply to the seller. All right, the seller. All right, and then we can see that through this diagram, when the demand is when people are less desired in buying any particular product, any particular stocks. All right, when the supply or the seller become higher, right, the price go down. All right, the price go down because the seller become more dominant in the marketplace, and there is no demand of people desired or interest in the stocks. This will be resulted the price going down in the future. Right, we can say in a simple term that when there are more buyers demand in the market than sellers, it will make the price goes up, all right, in the future. All right, in the future. And when there is supply or the seller dominating the marketplace or the stock price, and then it will resulted the price going down in the future. All right. So the question is, why did we need to know about this supply and demand? All right, later on you will see on how we doing the analysis in charts, and how does this demand and supply manifest in technical charts. All right, and and why this is very important? It is because the price, all right, the price is the end result of the battle between the forces of supply and demand of a company's price, of a share's price. All right, and the price actually, if we are talking as a technical analyst, we are consider and we are what the price of the share price is what matter most for us. All right, which what matter most for us, because we want to get in as low as possible, and we want to sell it as high as possible for maximum profit in a very short time frame. All right, now when we talk about supply and demand, all right, before we talk further about continue about how does the supply and demand manifest in technical charts, let me talk about the technical analysis. All right, the historical movement of the price in any equities reflects in the chart. All right, that's why we need chart. All right, it reflects all right, it reflects the supply and demand of any share price, and through this chart we can see that the price movement in all time frame again. All right, we can see in terms of years, we can see in terms of monthly, and it is we can go as small as 1 minute time frame. And the analysis of this price movement in the chart is what we call as technical analysis. All right, and technical analysis is available in stocks, indices, commodities, futures, and any tradable instrument where the price is influenced by the forces of supply and demand. Now that is the theoretical of supply and demand concept in terms of definition. Now we will look over on how did supply and demand trend manifest in chart. Right, and when there are more buyers, all right, it resulted in higher demand of the share price. All right, this will affect the share price, all right, and resulted the share price to goes up in the future. All right, to goes up in the future, and vice versa. When there are more sellers or any sentiment change in the market from buyer to seller dominance, it will resulted in a lower demand and high supply of the share price. It will affected the price of the shares to go lower in the future. Right, as you can see here, right, when there is more buyer, all right, it's more buyer, right, and when there is, again, when the aggressiveness of buyer become higher rather compared to its seller at any particular time, it will result an increase of price over time. All right, if there is a seller aggressiveness become higher or higher than the buyer, then it will result the price to move down in the future. All right, in the next video we will learn and we will see in the real chart how did we draw this supply and demand, and how did demand and supply line manifest in a real technical chart.
So hi there guys. So we will continue our discovery on finding supply and demand lines in general. Okay, and actually this is very important because this is how we do our analysis. And supply and demand line can be dictate, or you can see the supply and demand lines in either up or down. Okay, there's no other way of supply and demand lines. There is only two line that we want to analyze. Now we can see this starting from this Tesla charts. So we can see that obviously from this part, from this part until this part, we can conclude that there is more demand than supply. All right, there's more demand and supply. And then from this part, which is this point is the peak, and we can see that this is the supply line. All right, this is the supply line. So you might be asking, how about the minor movement? Okay, actually in terms of the minor movement, okay, in terms of the minor movement, it is less significant. It is less significant if we see it in a bigger picture. Okay, but if we see in a small picture, we can see that, right, the stocks behavior is when there is demand, right, there is demand, there will be supply, right, there will be supply. And this is a normal situation for any financial equities portrayed in the chart. So you can see that there is demand lines which indicate the price going up, and the supply line indicate the price going down in small time frame. But in major time frame, we care less about what happened in minor. Rather, we want to see what happened in a bigger picture. Okay, so we can group all together from this point to this, from this lower peak to the upper peak. We can say that this is the demand line. Okay, and from this upper peak to lower peak, we can say this is as one straight supply line. Okay, where the majority of this movement is seller. All right, there's more seller compared to buyer within this supply line. This is what it means. So we can see that Subsequently, the next line, it is more buyer compared to the seller. So majority people in this market are people who has more desire to buy. They are more aggressive buyers in the lines rather than seller. So if you trade within this lines, demand line, so what you want to do is most of the time you want to buy low and sell higher. Okay. Same goes when it goes down here to the peak. Okay. So in these lines, what we care most is we want to sell the equities. Okay, because most of the time the market is going down rather upwards compared to upward movement. So the next line, you can see the movement is most going up rather than going downwards. So in the next subsequently, so we can see that in these lines, we can see there is major downtrend happening, and this is the point that we want to sell or short rather than buying. Or if you are not shorting, you want to stay away from the market at this period of time, because the majority, the market is in an uptrend because the seller dominated the place, so it is more bearish than bullish. So now you can see that price going back upwards, and the buyer are getting dominated the price within this area. So at this moment, this is where you want to buy rather than selling, because the buyer is more aggressive or the buyer is getting aggressive. Okay, now if you learn about support and resistance, we can see that we can draw a line of support and resistance here. This is an extra analysis. So you can join 2 points and you can see the resistance lines, for the current movement. For the current movement, this is the resistance lines, and what it's trying to do, the seller is not so aggressive, and if the buyer are coming into Tesla shares, it will be back out again. It will back out and the buyer will become aggressive again. So this is the place that we want to buy before it further goes up and break this resistance line. Okay. So we want to analyze supply and demand line in Facebook. Okay. So we can see that Facebook price movement is quite random, right? It is quite random, but when you see a random price, what you want to do is you want to see a bigger picture. Okay, you want to see a bigger picture because you care less about the minority. Okay? You care less about the minority. What you want to analyze at the first hand when you open a chart is actually you want to analyze stock price in majority. What is its majority movement? Okay. Alright, we are waiting for the charts to open up. So now we can see that the daily charts is quite random, although we can see there is movement upward here, majority, and here is minority. So to keep away this minority movement of what we call noise, we open up a bigger picture. Thus, we can see more clear picture where the market is, right? Where the market is. So now we analyze supply and demand. So we analyze the supply and demand lines. We can see that throughout these sections, throughout these left-hand side sections, you can see Facebook Incorporated company has been going up since 2013. Okay, since its breakout, the horizontal support here, it has been an uptrend movement for about 5 years now. 5 years now. And we could hardly seen any major retracement in the weekly chart until of what happened recently. We can see that Facebook are getting in process of retracement. So we can see a long Marubozu here that indicate that the market seller are trying to push down the price as low as possible, and it's indicate the maximum seller has been achieved in the market. Okay, and it will be changing hands either for a while or permanently. Okay, and the buyer coming in, thus the movement is going upwards. But in terms of our objective here, which is we want to identify the demand lines and supply lines, we can see that there's no significant retracement here, although actually there's some retracement going here and here, but we care much less about it. We can conclude that in these 5 years, Facebook has been rallying in major rallying these 5 years, and the demand line is impressive. Okay, and just about recently, the Facebook shares has been going down and retrace and going through a correction period. Yeah, you can see that the seller is kind of dominated over here. Yeah, and it's resulted in the price correction. Yeah, price correction. So different from minor movements, we can see that there is buyer, there is seller, there is buyer, there is seller, there is buyer, there is seller, there is buyer, there is seller. So what I'm trying to tell you is that the market move in a zigzag pattern. Okay, market move in a zigzag pattern in a minor time scale and also in a major time frame. Okay, it's all move in a zigzag patterns, right? And you can see that at this time, 5 years time of the price rallying, the buyer has been dominated the marketplace of Facebook. Okay, and about just recently is going down. Okay, the seller taking in. Yeah, so that's Facebook Incorporated. Then next we see Google stocks. Next we see a Google stocks. right? Actually, this is not Google, it's Alphabet, where you can see immediately, you can see it is in an uptrend. Okay, immediately you can see it is an uptrend. So it's not quite hard for you to see, and there is no major retracement up until now. Okay, this is the longest retracement until now. It's a major retracement that happened recently in a weekly chart. Okay, in a weekly chart. So what we can see here, the demand line for weekly, the buyer is still in possessions. The buyer is still aggressive compared to the seller. Just about recently, the seller coming in, maybe to neutralize, to balance off the buyer movements. So actually, when we analyze any market movements, every buyer there is must be seller. This is something that the market must required to do. Okay, after some buying, and then the price goes up for quite some time, there must be seller time when the price will be going downwards over time for a certain period of time. For example, like in this Alphabet Incorporated, that the price going through some corrections before it's continue to rallying up in the future. Alright, so I hope that you guys understand the demand and supply lines, because that is the basic thing that we need to do, that we need to learn, and we need to understand in order for us to do our analysis, and we go through a deeper learning and analysis of supply and demand in the future. Alright, thank you. So hi guys, so we will continue on our first topic and our first component in analyzing for advanced chartists. And for the first component, we call it price trends. So actually a price trend is an important element or component that we need in order for us to analyze the chart effectively and see either the trend is a strong trend upward or it is a strong trend for downward. And it also be able to recognize weak trend for uptrend and weak trend for downtrend when the times comes. Okay, and before we go further into the analyzing of in the analyzing of the chart in the practical session, so first we learn about the theoretical of the price trend component. Okay, for the price trend component, we require at least two lines that going in the same direction. That is involve the current and previous man movement. What we mean by the man movement is actually is that it is if the trend is in an uptrend, so we are interested in the lines, the demand lines, the most current demand lines, and we want to compare it to the previous demand line. Okay, we are talking about the big demand line. Yeah, we are talking about the big demand line. If it appears to be easy to be analyzed, so we are using the big demand line. All right, so we're gonna show you later what we mean by this, and we compare it to the previous demand line. Okay, it's not that complicated. We just at least the requirement need two lines in the same direction. Okay, For example, like we can see that this is the first demand line and it's retraced, and this is the second demand line. Alright, and we can see that y1 is the vertical distance of the demand line number 1, and y2 is the price change for demand line number 2. So what we try to examine is that we try to comparing the length of the two lines y1 and y2. Yeah, you have to remember this, that we are interested in comparing the lines in terms of vertical, which is by meaning we try to analyze the price change, not distance, not the length between the two lines. Okay, our main objective is to compare which one is longer, either y1 or y2 in terms of its vertical. Right? And we can see that from this picture, we can notice that y2 is longer than y1. Alright, what does it means? Okay, if y2 longer than y1, after y2 retrace, right? After y2 retrace, it has chance to go further upwards more than its previous high. Alright. What does we mean by this? Okay. So if y2 longer than y1, which is it's happening now, we can see that this y2 longer than y1. So after it retraces, alright, after it retraces, and rebounds, it has high chance to go further its previous high. This is its previous high. Right? Why it has high chance that it will go through its previous high? It is because if y2 are getting longer in terms of price change, that's meaning the buyer are becoming more aggressive compared to the previous line or event. Okay, it's that easy. And subsequently, because of this situation where the buyer are still or even more aggressive, we are able to predict after the retracement of the longer line, it will move further upwards. It has high chance to move further upwards. Alright? We doesn't say it will confirm that it will 100% move higher than previous high, but actually it has high chance, more than 60 to 70% that it will move further upwards. Why this price trend line is important? Okay, it is very important for traders to determine and follow the majority. What it means by when y2 are getting longer, that means the buyer become more aggressive in the market. So after the retracement occur, we seeing this as an opportunity for us to get into the trades and surf along the profits when it reverses upwards. Because remember that it is easy for us to follow majority rather than minority, because the majority now is in an uptrend movement. So when Y2, when the current line is longer than previous line, it means that the buyer become more aggressive, and after it comply to its rules that it has to undergo some correction for seller. When it reverse, it will go further upwards. So we want to get into this trades because we have high chance it will going further upward because we are following the majority. Why we need to follow the majority again? If the market are generally move upwards, if the market, all the market movements are moving upwards, most of the time the market reactions is going upward rather than upward. All right, you will see a lot of green candles compared to red candles. So it has high chance for you to see your trades to be profitable in the most of time when you get into the trades and surf along the profit when it is moving upward. Vice versa, if you are shorting when the market majority moving upwards, you will be in more riskier positions because you are in a minority movement. Thus, when you trade against the majority, we are not saying that you cannot trade against the majority, but if you trade against the majority, you must have more skill getting in, getting out, or even see the signs when the movement try to reverse against your position. So this is something that we want to know, something we want to analyze when we trade. Okay, we want to follow the majority. Now, why we are interested in the line Y2 and Y1? Okay, Y2 and Y1. When we analyze according to advanced chartists, we need two requirements at least in order for us to predict the future. Number one is we need an information of the past. All right, we need the information of the aggressiveness of buyer and seller in the past and compare it with currently situations. What is the buyer aggressiveness currently? And we want to compare this compare this with information in the past, and thus from this information we are able to predict the future. Right? Now, if majority more than minority, it means that the market have trend. What it means by this is that if the lines are getting longer, and we can see that the retracement is minor. So actually, when we see Y2 more than Y1 and the retracement along the line is the same, the minority is the same, so we can conclude that the market is generally moving upward or uptrend. So the market have trend, right? Now, how do we analyze this? We analyze this by including all shadow, the tail, the wick, and draw it from the lowest to the highest, okay? Or vice versa, from the highest to the lowest. So we are connecting a line from the most lowest point, the most lowest price point, and connect it to the highest price point. And when we have at least two major lines going into the same directions, which is the minimum requirement for Y trend, we can compare the two lines. And we can see either the trend, for example, either the uptrend is strong trend for uptrend, or the line is weak trend for uptrend. And how we are able to see this is that we are able to compare these two lines by just dragging Y1 and Y2 and just compare it directly. And you have to remember that we are interested in the vertical price change. We are not interested in which one is longer, all right, between the lines, but we are interested the vertical price change and compare between the two lines, right? So again, we can drag these two lines and impose these lines against each other, and subsequently we can see that which line is longer, right? Now let we see an example of how we analyze for P-trend component. Okay, now we go into the reverse condition, is that when Y1 more than Y2, so what does this meaning? What does this mean? All right. So it means the price change of P-trend component are getting smaller. So thus we cannot risk the money in the market. Okay. If Y1 more than Y2, so we want to see what does this mean. Okay. So when Y2 are shorter than Y1, we can say that the buyer are getting weaker and after some retracements, it cannot, when it rebound upward, it has lower chance getting higher than previous high, and thus the consequence action that we cannot risk our money in the market or buy any equities that shows this behavior. Okay, now we can see that most of people trying to buy in any market conditions for breakout. Okay, they like to enter the market during the breakout, and if they enter the market with Y1 more than Y2 or Y2 shorter than Y1, current are shorter than previous, that means they are entering the market for weak uptrend. And when they enter during breakout for weak trend for uptrend, the price subsequently will be going down. Now, when you say about this, we are talking about probabilities. Okay, we have to see the market as probabilities. We cannot say that it will 100% it will go down, because from our monitoring that in most conditions the market will go down. It has high percentage of going down. So this is the reasons of why did people are being trapped when a share or stock price making a false breakout in the upward movement. Okay, and vice versa, when Y2 are stronger than Y1, by meaning has stronger trend, price will commence up aggressively most of the time. Now we can see that from this graph, we can see that Y2 is longer than Y1. Now we have to remember that in most of the case, after Y2 commence, the market will be sideways. Okay, this is always be the case. Okay, after Y2 is indicate that it is longer than Y1, and it indicate a strong trend for uptrend. And you have to remember that after this sideway, right? After this sideway, after market goes sideway, it has high chance to move upward. Right? And these movements of going upwards are resulted because of Y2 are longer than Y1. And vice versa, we see the reverse conditions when Y2 are shorter than Y1, and this indicate a weak trend for uptrend is in commence. And after sideways, the price will go down. In most of the case, the price will go down. Right? You have to remember that when the market shows weak trend for uptrend, after sideways, it will goes down. So as far as we know, as far as we can see that we need past informations, we need present information, and by this information we are able to predict the future. Y1, or the price trend component number 1, is an information that occur in the past in Y2, which is event in the present. By getting these two information, we are able to predict the future. Okay. And this price trend can only apply when the market have trend. Okay, you have to remember that we have only two trends. Okay, we have only two trends, which is uptrend or downtrend. So when we analyze an equity, this price trend component cannot be applied when the market have no trend. So what it means by the market have no trend? Does anyone has any ideas? So what does it means by the market does not have trend? So obviously there is three market condition as far as we know, that there is an uptrend, there is an downtrend, and also there is a sideways movement. And sideways movement, it has two sideways movements. The one that we call as contracting, where you can see the support and resistance line diverge in time, and you can, and the other sideways is contracting. The other sideways is expanding. Okay, when generally market move in these two positions, we can say that the movement is in sideways movement. So in this contracting and expanding. So in these two market condition, which is in sideways movement, we cannot apply price trend component. Okay, price trend component does not valid in this market condition, which is the sideways condition. We need actually three lines, including the retracement, one retracement at the middle, but actually we need only two lines, and we are comparing the two lines, which one is longer vertically. Okay, and we want to check either the market is strong trend for uptrend or weak trend for uptrend, or strong trend for downtrend or weak trend for downtrend. Okay, we will see more exercise for this Y. We will see more exercise for this price trend component.
Alright, we will continue on our session in the practical session of determining the price trend. We will give you a few examples of the charts, selected charts that you will be able to see price trend in those charts. Alright, now, alright, you can see this is a Boeing company. This is a Boeing company of the US, and we will see the price trend of this chart, right? The price trend of this chart. Now when we analyze, we see that from this area, right, from this area, price goes down. Am I right? Price goes down. Then we continue to plot the graph, right? Continue to plot the graph accordingly, right? Accordingly. Now we can see that what do you notice about this Boeing company? What did you able to see? Alright, what are you able to see before it goes up aggressively? Now we can see that the bullish price trend is getting longer. Am I right? And you can see that at some certain parts the retracement become less and less aggressive, and less it become shorter in times. All right, for example, like you take this one, right? This is actually a sideways movement, both of these, and it begin its uptrend movement from this trend. All right, from this trend where it's making higher high and higher low. Right, it's making higher high and higher low. At this moment, we know that, all right, as we know that, as we can see, and we compare this line and this line, this is the longest line, all right, and this is the longest line, and this indicate that the buyer have become more aggressive, and seller become less aggressive. All right, and it is obvious that the seller become less aggressive at this part. In this part, you can see that it retraces less. It retraces just a little bit compared to the previous retracement. Am I right? And hence, after the retracement, it can goes higher than previous high. All right, that's what according to our analysis, price trend analysis. All right, after it the trend become longer and longer, after it retraces, it has high chance to go higher than previous high. And this part, and this Boeing company shown an example that it goes way up above. All right, it goes way up above, and we can see that the buyer become more aggressive. All right, it just takes, all right, since 2016 to 2018, it has moved around 300%. All right, 300%. Now in terms of technical analysis, we can see that the seller become less aggressive and the buyer become more aggressive in the market. So this is where we want to be in a position when we try when it's either it's reverse here or it's break out its small fluctuation here. There is one inclination support that you can take advantage of. All right, now when you want to buy this equity, all right, when you buy this equity, so one another options that you can do is you can analyze this trend. All right, and this trend is going up because of power. All right, in the next section you will learn about power, and the power is the first priority and more important than P trend. Right, more important than P trend. P trend is the second priority. All right, second priority, but you can notice, and it helps you a lot with when you seeing a longer P trend, that's mean it can goes up higher. All right, it can goes up higher, but remember it must be retraced first, and after that it can go higher. It can goes higher. now we see Twitter. All right, now you can see that. All right, first take this, all right, plot it, some plotting, make a lines. Now you will notice a certain pattern here at the reversal. This is a bottom reversal pattern, a pattern that you will learn in the next few sessions. So, right. So what you can see here is that it's actually the downward line become more aggressive here. All right, the seller become more aggressive, but hence before it goes up, the seller become less aggressive. All right, and you can see that the buyer become less aggressive, then suddenly it become more aggressive. All right, now according to the price trend that we had learned, we had covered. So after the retracement, all right, after the retracement, what should it supposed to do? Supposed to go up. All right, and we could notice that this is the bottom reversal. This is the most bottom part of the stock market, the stocks, which is the Twitter. And after it reverse, it has high potential to goes up. All right, it has high potential to goes up. So are these a good stock to buy? Definitely yes. All right, it start to reverse upwards, and it start the trend indicate it is become stronger trend for uptrend, and after complete retracement, it will go up. And this retracement and subsequently the reversal pattern is not only indicating a good trend but also power up. All right, this is what a type of stock that we want to buy. This is a type of an opportunity that we don't want to miss. All right, we don't want to miss. So Twitter Incorporated has high chance to go higher than previous high at least. All right, but actually this company is can go higher than that, because you can see that this is what we call as cup pattern in formation. Right, cup pattern in formation. So this is where you want to buy. All right, you want to buy. Now it's Lockheed Martin. So this is Nvidia. Now we can see that there's a lot of retracement, a few retracement. We can see it's happened here, it happened here, and happened here. So what did you notice about P trend? All right, what did you notice about the P trend? First, buy here. So as we draw the line, right? We draw the line. We see for the possible retracement and draw the line. Draw the line and okay. Now what we notice about the price trend. All right, the price trend is all right. Now it's obviously the last price trend is getting shorter, but now we want to measure this price trend, right? We want to measure this price trend. Oh yeah, it's getting longer, and yet after that it's getting shorter. So this is situation that we don't want to be. All right, we don't want in this situation the line getting shorter, and this is where at the point where we want to consider to sell if it's shown a very good a very strong reversal downward. All right, now from this price trends, I just want to show you that you'll be able to analyze the stock better, easier, and it's not that complicated, I guess. Right, it's not that complicated. What do you guys think about this? Yeah, it's not that complicated. You just have to pinpoint a right peak and low. Now later in one special sessions, I will share with you on how you can draw this line in a good accuracy, right? In the right way. And then after you'll be able to draw these lines, you'll be able to identify the price trends. Either it's getting stronger for uptrend, or it getting the trend getting weaker by time. All right. So for this Nvidia, we could see that for the last retracement, the last trend is getting weaker than previous. All right. Alright, hi guys, and we will continue to our second development, which we will discover on the second component, which we call power. Alright, power is the second component, but actually it is the most important, and it is the most the top priority of our analysis. Alright, of our analysis. And so what is power? Alright, previously we had learned about trending. Now power is more powerful, and it is more important and have a bigger impact on the chart that we analyze. All right. Now again, it is the first priority, but actually it come later than price trend. All right. Why is this happening? Is because actually for power, we need more information. That we need two loops for power. We need one demand, one supply, and another demand and supply, which is current and previous demand and supply. From this information, we will able to analyze, doing technical analysis, and analyze the chart behavior on power. All right. Now again, one loop is one move up and one moving down. This is simple. All right, this is simple. That's meaning that actually one loop is equal to one move down and one move up and one move down. All right, this is the demand line, and this is the supply line. All right, and for power, we need two loop. All right, at least two loop in order to identify power, in order to identify either the stock has potential to go up or not. All right, then actually when you by time you will be able to identify the power analysis by the observation. All right, by looking at it, you know, at a single click, you know that it has power or not. And to confirm what we are doing is right, we will see some calculations on how to determine a loop or double loop has power to go up or not. All right, now again, to recap, what is two loop, because this is very important. I want to recap in a very constructive manner that when we analyze price trend, all right, when we analyze price trend, we need at least two line that it move into the same direction. All right, it's two line and line number 2. All right, we need these two line in order for us to identify price trend. But for power, we need more than 3 lines for us to identify an equity have power to go up or not. All right, so we need buyer line, we need seller line, we need buyer line, and we need seller line. All right, so we need double demand and supply line. All right, double demand and supply line. So actually this is what we call as loop number 1, and this is what we call as loop number 2. All right, and from this we are able to determine either an equity have power or not. Now for our first learning, I will show you what I mean by no power. Right, what is no power? We'll see some example of no power and have power. Now we start first with no power. Okay, now we need at least 2 loop to identify power. Okay. Now we can see that through this line equity. All right, you can see that there is loop number 1 and there is loop number 2. All right, there is loop number 2. So you can see that, right, this is demand number 1, supply number 1, and supply number 2. All right, and you can see that this demand number 1 goes to up to this point, the resistance line, and the supply line goes at the support level again. All right, at the beginning point of demand line. And this same goes happening to the second loop. All right, where the demand line number 2 goes to the resistance and rebound back to the origin of demand line number 2. Right, what we conclude from this line is that it has no power. All right, no power, because it does not make any difference. It's the aggressiveness of buyer and seller in the market are still the same for both demand and supply line for this first scenario. And we go to the second scenario, which is which is quite the same, but actually for at this time, it does not, loop number 2 does not goes way up above and hit the resistance line. Okay, but what we could see here is demand number 1, this is supply number 1, this is demand number 2, and supply number 2. What we could see here is that for loop number 1, the ratio of demand and supply is the same. All right, and when the demand line reach the resistance line and the seller lines goes back to its original point of the beginning point of price point of demand line. All right, and this same goes to loop number 2, where the demand line, it goes up, and at certain price point it reverse and goes back to the beginning point of demand line number 2. All right, now we could see that both ratio is 1 and 1. All right, 1 and 1. Thus we could conclude that this scenario, second scenario, has no power. All right, has no power. Right, is what we just did just now. All right, and this is, both of these are an equity that has no potential to go up. All right, now we continue on this, our third scenario. Right, our third scenario is that, right, now do you notice what is the difference? Okay, what you can see that loop number 1 has no difference from previous example, where the demand line goes up to resistance and it goes back to the it goes back to the origin of the demand line number 1. And what you can see that the demand number 2 rebound back and hit the resistance, and this time you can see that the seller line number 2 goes beyond the support level. Alright, the support level, and you can see that this actually has no power. Now, why it has no power? This seller line is getting longer than seller line number 1. Thus, we can conclude that the seller become more aggressive, and right, and after it rebound, it may rebound back. After it rebound, it may rebound to the previous support, which is now it resistance, and it goes continue to move upward. Now, later we will do some calculations to verify this, and we could see even clearer what we mean by and how does it become in resulting a line that has no power up. All right, and this is something that we don't want to invest in. We don't want to invest in a stock that is moved down in price unless we go short for it. All right, now some assumption that in this course we will always talk about a bullish trend. All right, we are always talk about the bullish trend, and the rule is a mirroring when you go for downward movement. All right, or you go for shorting. It is mirroring to what we learn, and generally when we learn, it's all about we are take consideration that we are try to buy low and sell high. All right, now the fourth situation is that, all right, this is demand line number 1, and this is seller line. All right, now this is loop number 1, and this is loop number 2. All right, what we can see here is the demand line number 1 goes from below support level to the resistance level, to the resistance lines, and after it hit the resistance line and achieve this resistance line, it rebound and goes back at the support level. Right, it hit but this time it is not hitting the origin of demand line number 1. It stopped way above the origin of demand line number 1, and after that it rebound back to the resistance. But now you can see that again it goes beyond the support level. All right, goes beyond the support level, and for this scenario you could say that this situation has no power. Why does it resulting in has no power? It because you can see that the demand line getting shorter. All right, demand line getting shorter from demand line number 1 and 2 is is longer to shorter, and you can see that the seller line become longer. All right, become longer, and this is why did the line, this 2 loop has no power. Now, what we mean by no power is that when it rebound, it has no power to go over the previous high. All right, previous high. Now, if it goes up here, it has potential to goes up here, but it can be rebound. Right, but it has no potential to go up until here, right? Because this line has no power. But you remember this, if an equity of the two loop doesn't have power, it means that it does not have power to go up more than its previous high. But if it goes up more than its previous high, that is time that you have to realize that it is not a real movement, and maybe it is a speculation movement that you want to. If you are holding on the equity, you might want to sell the equity when it goes beyond previous high. All right. And this is the situation that we just drawn just now. This is right. No power situation. You can see that from this scenario number 4, you can see that for this loop number 1, you can see the buyer are more aggressive, right? And the second line, the seller are more aggressive. It's changing hand, right? It's changing from buyer to seller aggressive. Thus, it become no power. Now again, price has low chance to move higher than previous high, right? But in a rare condition, if they move higher than previous high, what we should do is you should sell, right? You should sell. Now, after we talk about no power up, right? Now we are talking about how does the pattern look like if it has power up, right? Now we go to power up. Now this is getting interesting. It's getting interesting, but can you guess how it looks like for power up pattern? All right. Now you can notice that this pattern is very easy to use, and you can use in a very specific time frame. It's very small time frame to the very big time frame. All right. And because it's minimal requirement, it's only required 2 loops, then you can predict what will happen to the stocks in the next line, or in the next demand line. All right, either it will go up or it will go down. All right. Now, right, you can see here power up. Can you tell me either this equity has power up or not? All right. Can you give your opinion? Right. Now, can you see and determine the demand and supply line? All right. So we can see that this is the demand line number 1, and this is supply line number 1, and this is demand line number 2, and this is supply line number 2. All right. So what you can see here, all right, what you can see in the picture, you can see that demand line and supply line is the same. The ratio is still the same because the supply line goes back at the beginning point of demand line. All right. Now we could say that the demand and seller is neutral. Now for the second loop, what do you notice is that the demand line get back to the resistance, and then but what happened, the difference happened here is that the supply or the seller is not as aggressive as before, right? It's not as aggressive as before. And what do it tell us is that in this line the buyer become more aggressive, right? The buyer become more aggressive, or in a simple single loop, it telling us that the buyer become more aggressive compared to the previous loop, right? This is what it tells us. And when a stocks or certain equity have power up, right, what do it tells us is that when it, can you guess what it tells us? Right, if previously there is no power up, it can't break previous high. Then if it has power up, it means that it can goes beyond high high. All right, it can goes beyond high high. And this is what we're trying to do here is we try to determine whether it is good to go for an entry at this level. And now when we are talking about all the strategies in this advanced chartist, is that what we are trying to do is that we're trying to get at the retracement. All right, because we want the minimum and minimum entry. We want the lowest entry, lowest price entry, so that we can maximize our profit. And then we are more safe because we are nearer to our stop loss compared to if we buy at the upper back route, which is the conventional. Most of people are doing this, but in order for us to get to a very accurate price, we have to buy at the entry. All right, we have to buy at the retracement. And then now you can see that this is what we are looking for. Try to get at this buy region when it shows any potential candlestick reversal. All right, this is what we want to do. This is what we want to try to analyze. This is what we try to monitor. If it retraces less, we are trying to looking up for potential reversal and goes and get into the trade and ride along the profit. Now, how do we entry at this particular point? We will cover at the very in the next chapter, or for subsequent chapter. We will tell you on how we could get into a specific entry at this buy region. All right, this is very interesting because you can buy at a very lower price, perhaps the lowest price, if you could predict and you have more skill and experience about what will happen in this retracement. All right, now for the second scenario, you can see that this is the loop number 1 is loop number 2. All right, you can see the demand line and the supply line. All right, now if you understand what had been mentioned in the scenario number 1, you can immediately get the scenario number 2. All right, it's not that complicated. By observation, you know that what will happen to the scenario number 2. All right, what will happen to the scenario number 2 is that, okay, now you have to analyze first loop number 1. What happened in the loop number 1? You can see that as usual, the demand line goes up and the seller line goes back to the origin point of the demand line. So we can say that, we can assume that the demand and supply in this loop is natural. All right, it's balancing towards each other. But we can see that for the loop number 2, we can see that the demand line number 2 is longer than the retracement. Right now, if it reverse here, right, it goes up. If it goes up, right, what does it means is that it has potential to go up higher than previous high. Now, higher than previous high, we are not looking at this level, we are looking at this level. All right, has potential to pass beyond this resistance at least. All right, at least when you're looking for this entry, you are looking for to get entry here and let it at least goes beyond this previous high. Right, now later on when we learn about Fibonacci, we will learn how to measure our target, and this is our first target and Fibonacci is our second target. Right, it's quite a little bit far above, not that far, quite above this previous high resistance line. And then or if it has shown a very strong upwards, all right, we can use Dow theory, all right, which is when it make high, that it means that it is in an uptrend. All right, now for Dow theory, you use that knowledge to let the profit run. Right, you care less about the power and trend, but rather if satisfy Dow theory, it makes high and high low, you use a simple strategy for this to let your profit run. All right, and you doesn't care about how much times that you need to invest in a particular stock. You can invest forever as long as it goes high and high low. Am I right? So you can maximize your profits. But if you go for short term and medium term, you can use this strategy that if the equity or stocks have power, then at least it go higher than previous high. All right, or later on we will learn about Fibonacci on how to measure your profit target point. All right, now we go to the third scenario. Can tell me either this scenario has power or not. Right, now first we have to identify which one is the demand and supply line. All right, so this is the demand line and this is supply line number 1. This is demand line number 2 and this is supply line number 2. Right, so what you can see here is that at this loop number 1, you can see the seller is more aggressive than demand number 1. It's more dominant. All right, it's more dominant than demand line number 1. So but as time goes, you can see that this changes. All right, the buyer and seller in the market changing hands. Thus you can see in the second loop what has happened. Right, you can see that for demand number 2, it goes back to the resistance line, and you can see that the supply line number 2, it's reached at this point. And you can see that the buyer are dominating at this loop number 2 rate if compared to the loop number 1. All right, and you can see that the seller become less aggressive in this loop. And what we can say is that this line has power up. When it has power up, what it means by it has power, right? Now when it rebound, right, it shows a potential candle reversal here. When it rebound, right, it has potential to go beyond this previous high, right, Now we go to the fourth scenario. Right? Can you tell me either these have power or not? Now first you have to determine which one is the demand number 1, which one is the supply number 1, demand number 2 and supply number 2. Alright, you can see that this is loop number 1 and this is loop number 2. Alright, what you're trying to see is that the demand line after it hit the resistance, goes beyond the beginning point of demand line number 1, goes beyond this level, and you can see that the demand line number 2, it goes up, but it's not reaching the resistance level, and the seller coming in, it retraces to this up to this level. All right, so what it tells you either this has power or not. Now when we trying to measure power, we're trying to analyze power in an equity in the two loops, what we're trying to do is that we want to measure the second loop, the difference of second loop and the first loop. Alright, if now it has more power up, the buyer become more aggressive or the seller become less aggressive, that's mean it has power, right? And we are trying to compare the second loop to the first loop. If the buyer become more aggressive and the seller become less aggressive, after the finish retracement of the seller line number 2, it means that it has potential to go and reach beyond its previous high. This is what it means. Alright, now when we talk about previous high, it's not about loop number 1 previous high. We are talking about the most current previous high, which is the second loop high. Right, now you can see that this has power up, right? Because we can see that if compare the second loop to the first loop, you can see that the second loop definitely has power. Thus, what it will do next, what is high probability will be doing, the next line, the demand line, it will goes up. Right, it goes up beyond the previous high. At least it will reach here. So what you want to do is you want to get an entry at this point. Alright, now if you realize that this is right, this is bottom, double head and shoulder, invert head and shoulder at the bottom. Alright, so you know now why does this pattern goes up. After it finish this pattern, it will go up, right? Because of, you can see that the buyer become more aggressive than the seller compared to the previous loop. Alright, that's why it has high chance to go, at least go higher than previous high, but most of the time it goes far way beyond. Alright, because this is some particular, when this happen at the bottom, right, at the bottom stock market, it has high chance that the market has chance for big reversal. Alright, and big reversal. When you get at the price, you can let your profit run. You can have a lot of profits if you let it profit run and not simply taking profits for short term. Right, but if your objective is for short or medium period of time, then you can take the profit, alright, to secure your profits. Alright, but in another strategy, what you can do is that you can take some of your profits, 1/3 or half of your profits, to secure your profits. Alright, and some of people use this strategy to let their profit run, and they take some of the profits and they let 2/3 or half of the remaining balance of their positions run and maximize their profit. Right, this is the good strategy because you have balance between taking profits and let the profit run. Alright, you are averaging the market, and this is a very good strategy. I believe in the long term, you have a balance between secure to take the profits and let the profit run. Right, this is what we had just learned, and we can see that second loop has more power than the first loop. Right, now what we try to define here is that when an equity have chance to move up, right, and it has power to move up, it means that it has chance to move higher than previous high. Alright, at least it will goes beyond the previous high. Right, and you have to remember this. And if an equity does not have power, again it does not have chance to go higher than previous high. Right. Now, when we doing analysis, right, for uptrend, we try to measure is there any power to move up or not. All right, and subsequently, this is mirroring activities when we go to the downside, where we want to see either there is power to move down or not for downtrend. All right, if it has power to move down, that's mean the line has no power. The line has no power, and all right, and if we do mirroring, we will see that the line has power to move down. Right, it just to measure either it is in a big downtrend or not. All right, we can determine the power down. All right, is that what it mean, right? And now I'll be showing you in terms of calculations. It's not easy, it's not hard. It's an easy calculation based on just merely simple ratio. Right? What we mean by have power? When does a situation where an equity or stocks have power? Right? Now we draw a line. We take an example of an equity have power. Right? Right. And we determine the demand line and the supply line for both. Now, definitely by observation, we know that this line has power if it tried to reverse upward here. Okay, in terms of calculation, what we're trying to do is we're trying to compare this the first loop and the second loop. Right? If the buyer have progression, then it means that it has power. Now we're doing the calculations. Right? What you mean by that is that when we divide, right? When we divide, right? When we divide D1 and S1 is equal to 1, right? And for the second loop, we divide D2, right, to S2, right, equal to, if this, right, D2 divide by S2, it yield a result more than 1. It's what we call have power. Right? We are comparing between loop 1 and loop 2. Is loop 2 bigger than loop 1? That's mean it has power. That's what it means. Alright, that's what it means. Now we look at the, right, this is what we are talking about. It has if it has power, then it has potential to go up because of loop number 2 here is the ratio is bigger than loop number 1, right? Now we take an example of second example, right? Take a second example. You can see that what we means by have power, right? Have power. Now we determine the demand line and the supply line, and this is the supply line number 2, right? Now we do the calculation again. We determine which loop number 1 and loop number 2, right? And this is a loop number 2, and right, could see that this loop, when we divide, right, when we divide this demand 1 and the supply line, we will get, right, a number that is, I believe, less than 1, right, less than 1. And if we divide the demand number 2 with supply line number 2, we will get a number that more than 1. Alright, now take an example of, if you want to make it clear, this is 0.3, this is 1, this is 1, this is 0.3. Alright, now if demand line 0.3 divide by 1, so we will get, right, so what do we get is that 0.3 divide by 1, right, we get I believe that 0.3, right, 0.3 divide by 1, we get 0.3, right, which is less than 1. And then when we divide this demand line 2 with second line, it will yield a result 3.33. So comparing this number, right, you can see that the second loop yield a higher results than the first loop. Thus we can conclude that this loop has power, right, power. And what it means by having power again is that after we complete its retracement, that's mean it has high chance. When it reverse, has high chance to go higher than previous high. Right. Now this is what we had just did just now, right? You could see that this trend line have power, right? By observation, we knew it already. Because we could see that the seller line is become less aggressive, right? Thus it has power to move up, right? Or we can done it by calculation if you want to. I think that's all for the topic. Now I would like for you guys, alright, to, before we end up these sessions, I would like for you guys to determine either each of this line have power or not, right? I have given you the clue. I've given the clue there, and I hope that you can see which one does have power and have no power to move up. Alright, see you guys in the next topic. So now guys, we are still in power analysis topic, and now I will give you an answer for each of this situation, each of these market conditions where all of these shown two loops. Alright, all of these shows a two loop, and what we are trying to do is that we try to analyze power of each pattern. Alright, if each pattern either it has power or have no power up. Right, now we go to the first pattern. Alright, we go to the first pattern. Now we want to see either it has power or not. Alright, either it has power or not. Now you could see that, alright, I like to use yellow for this one because it is more clearer, and you see that for the first pattern, this, alright. So what can you see from this pattern is that from the eye observation, definitely, right, definitely. Okay, now this is a demand line, This is supply line, and this is demand line number 2. This is supply line number 2. So what we can see here is that the seller for the loop number 1 is higher. Alright, it's become aggressive, if more aggressive than the demand line number 1. Thus the seller in loop number 1 is more dominant. Now by time this changes, right, when you look at the second loop, we can see that the demand line is longer than the seller line or the supply line. So what it tells us, right, what it tells us is that this loop number 1 has changed from seller dominant to buyer dominant. Alright, that's what it tells us. Alright, and from this, from observation, we can say that this line has at least has power up, and when we say has power up, has high chance to go higher than previous high. Okay, and alright, and when it doing the retracement here, this is where we want to get ourselves into some position in this equity. Alright, so it goes to second situation, second scenario, where second situation where the demand line and the supply line goes beyond the demand line, it goes up, right, it goes right. Now we can see that, right, this is one line, same, right, and when we analyze this loop, alright, this is demand line number 1, this is supply line number 1, this is demand line number 2, and this is supply line number 2. Alright, and what we can see is that for the loop number 1, the seller is aggressive. Alright, the seller is aggressive compared to it buyer, so we can say the seller is more dominant. But for the second loop, now is quite special. Alright, now you can guess what is happening now, and either this second loop have power or not for the upside potential. Right, can you guess, does it has power or not? As we can see that the demand line goes up to a certain level, and the supply line or the seller goes back to the origin point of the demand line, right? And what we can say here is that now we can see that there is improvement of seller. Am I right? Improvement of seller if we compare this both loop. Alright, we can see that the seller become less aggressive. Alright, now, and there is improvement of in terms of buyer and seller. Previously we can see obviously the seller is more dominant, but now we see that both buyer and seller are equal. So for this case we are saying that this line, can you guess? Right, actually this line, right, we can conclude that this line has after it reverse upward, right, that's the stock market behavior, that we go down and up. When it goes up, it has high potential to go higher than previous high. Alright, because we can see that by time loop number 1 and 2 it makes improvements, so after it retraces, it has high chance to go higher than previous high. And this is proven if we do the mathematical approach. Alright, this is proven to be, if you take an example of any numbers of both demand and supply line, you can see that by time it will yield a result that loop number 2 produce a greater numbers than loop number 1. Alright, then hence it shows that after it will reverse. When it reverse, it has high chance to go higher than previous high. That's mean this loop has power. Alright, this is scenario number 2. Now we go to the scenario number 3. Alright, scenario number 3. What you can tell about this? Can you guess? Alright. For the one who's already understand what we are talking about, understand the concept of power, then you could realize that you could immediately see that either it has potential to go up or not. Right? You can see that the demand line for number 1, demand line number 1, and supply line number 1, and demand line number 2 and supply line number 2. What we can see here is that, alright, given that the demand line start from this point up to this point, and the supply line comes to the origin point of demand line number 1. But for the second loop, alright, for the second loop, we could see that this seller is just small. Alright, there is only small seller, and we make a small retracement downward, alright, or correction downward. Then we can see that obviously that the buyer are dominating the marketplace. Alright, it's not normal dominating, but rather it's really buyer dominance, or buyer become aggressive in this line. Alright, compared to it retracement, because the most people want to own this stock and less people want to let go of this equity or stocks. Alright, that has resulted that the stocks has potential to go up in the future. Alright, this is the beauty of supply and demand, if you understand, because it's easy to see supply and demand. Alright, and if it has power, it has potential to go higher than previous high. Right, for this case number 3 is that it has power to go up. Alright, now we go to the analysis of number 4. Alright, number 4. See the number 4. Right, you see that now. Can anyone tell me either this have power or not? Alright, now you can see that the demand line for number 1 and supply line number 1, demand line number 2 and supply line number 2. Right, now we can see that the demand, the same situation goes to loop number 1, right, where the supply line goes up back to the origin point of the demand line. So we could say that at this what would happen here is that the buyer and seller is the same. Alright, the buyer and seller is quite equal and balanced. But for the second loop, alright, we could see that the buyer is although it takes time for the buyer to reach at this point, this is not a good indication, but we talk about it later about time component. Actually, when we talk about power analysis, this has power to move up, because of, if we compare the demand line to the seller, we could say that this buyer are more aggressive than the seller. Alright, and hence after it try to retrace back, it has high chance to go higher than previous high. Alright, because it has power. Now we move to the fifth scenario, where we analyze the fifth scenario, which is, so far all are the example of a two loop having power. Now we go to the fifth example, right? Now we could see that the demand line, this is the supply line, this is demand line, and this is supply line, right? What we could see that the demand line goes up to this level and retrace, all right? And obviously that this line is buyer dominated, and as a result it goes up, but then it goes down again, and we could see that the seller are dominated because it's longer than the demand line number 2, all right? So the progression is from buyer dominating to seller dominating, all right? And this has resulted that in our power analysis that we can conclude that these two loops does not have power, right? That's mean if it retraces, all right, when it retraces upward, rebound, it does not have capability to go up, all right? It might retrace until this price point and go resume its movement upward, right? Now we go to the sample number 5, right? Go to the example number 5. Either it has power or not. We want to determine either it has power or not, all right? So can anybody share their, all right, what their opinion of either this loop has power or not? What you can see here is that this first demand line and supply line, and this is second demand line and supply line. What you can see for loop number 1, it goes back again to the original point of demand line number 1. But again, when demand line commences upward, it goes up to this point higher than previous demand line, but does not concern us about either it's higher or less than previous demand line. Well, what we are interested is that the consequence line, which is the seller and until when it retraces, all right? Now we can see that the seller line number 2 retraces beyond the support level of this line, beyond the support level of this line. So alright, so we can conclude that this line, alright, the seller become more aggressive compared to the seller from the first loop, alright, for the first loop. Now although we can see that the demand is become higher, but we doesn't not interested in that. We does not interested in either the demand or seller become more aggressive or less aggressive, although it can help us in determining which one is more power, but rather we want to see we want to compare the current loop with previous loop. All right, now the seller become more aggressive compared to the first loop, which is from what we can see is that from the first loop it is balanced between buyer and seller, but for the second loop the seller become more aggressive. Then we could see that, and we can conclude that this second loop does not have power to move up, right? Does not have power to move up. What we mean by does not have power to move up is that it does not has power to move up beyond here, right? Beyond previous high, right? When it reach the support level, it may be going back again, right? Going back to the downside, right? I think enough for that example. I hope you guys understand and you are able to do you are able to analyze power analysis correctly, because this is our first priority and it is very powerful and quite accurate, and it helps you in reading the chart effectively. How does it help me in determining either the next trend gonna go up or the next trend have chance to go up or not? All right, In the next session, we will go to an analysis of we will see on the real charts on power analysis. All right. Hi there, guys. So we will start to analyze our few charts, a few selected charts, and we try to implement our chart analysis based on power analysis. All right. So this is Tesla Incorporated, and you can see here this is a daily time frame, right? This is daily time frame. So what you can see first when you open a chart, all right, you see either the chart is quite easy to interpret, or it is not quite easy to interpret. All right. So what I mean by easy and not easy interpret is that you see if there is a lot of noise, for example like this, all right, so you don't want to have this noise, right? You don't want to have this noise. So to do our power analysis correctly and increase the accuracy of our analysis, so what we want to do is we want to get rid of this noise. All right. So one way to get rid of this noise in order to get better results, better analysis, so we change it to weekly chart. All right, weekly chart, and this is normal when we are doing our analysis, right? This is normal because of what we need to do is to change to weekly chart so that we could do our analysis better, because the chart are clearly showing us where the trend is. All right. Now we want to do some back testing. All right, so you will be able to see the powerful of the knowledge that we just learned, that is power analysis. All right, now you can see from in 2013, right, from this previous from right 2011, perhaps 2010 until 2013, the stock doesn't go anywhere. All right, the stock is in sideways movement, and since just about 2013, in middle of 2013, there is volume getting in Tesla stocks, and people are getting into these stocks, they're buying into these stocks. All right, now because of, we can see the candle change, and we can see that this is indicate that the volume has changed. All right, now when we doing our analysis, we start from, usually we start from below. All right, from below, from the bottom part. All right, and then we assume that this is our beginning point, and we, all right, and all right, this is our first buyer line. All right, this is our buyer line, and this is our first very aggressive buyer line. Am I right? So what you can do is that you draw a line from peak to peak and peak to lower peak. All right, so if you can't see here, right, if it does not happen yet, so what you can see is that you can see it's making power. Am I right? It's making power, and most importantly, this is easy to recognize because of the volume has just come. Am I right? The volume has just come. You can see that the buyer are more aggressive than the seller. All right, then it start to go up. All right, and this is when you can enter the market, right? You can enter and buy Tesla stock. All right, so it goes up. All right, it goes up. What you can do here is that you just right, just pinpoint all the lines. Right, as you can see here is that as you can see here is big uptrend, all right, big uptrend, all right. As long as if you are in position, for example, as long as the line are making higher high, higher low, you can let the profit run, all right, you can let the profit run. Now you can see that can see here, right, you can see here, this is quite in an uptrend movement. It goes up, right, goes up, and now this line have power and this line does not have power up. So the result is, what you can see here is that when it goes up, it cannot goes above the previous high, all right, above the previous high. It managed to go up, you can see that it managed to go up, but it doesn't manage to go beyond this resistance line, right? So you can see this is one of the reasons that we have to understand power analysis, power knowledge, so you can see the effect right away, right? And you can then you draw the lines, all right, draw the line, and then you can see here again, this is has no power, and this line, right, for this loop and this loop has no power, am I right? Right. What you can see there is that there is no power because this seller become more aggressive. So when it goes up, it cannot goes beyond or higher than previous high, all right, higher than previous high, right? And this analysis is pretty accurate, right? Then you keep drawing the lines. You're not interested in getting in this stock for now because of it shows no power, thus it cannot break previous high. So now we have a change. We have a change here. We have a change of power analysis. For example, as you can see here, right, for these two lines, right, there is power. There is power up because of this loop number 1 and 2, all right. Loop number 1, right, loop number 1, it goes beyond, and loop number 2, you can see that the seller does not goes below the support level, which is right here, right. This is indicate that the power is in the making and it has potential to go up, am I right? This is according to our power analysis. So it goes above the previous high, all right, above the previous high. Now you can see the effect of this analysis, right? Can you see the effect of this analysis? After it goes up, what you can see, there is some retracement over here, right? And then after it goes up, it retraces and it's continue its movement upward. Continue its movement upward, right, way above this line. Now continue to current analysis, right? Continue to current analysis. You can see here, right? Now this is not a big time frame, right? This is a specific area that we are interested in currently, right? Now this is the information that we have. We just have to use the zigzag pattern that occurring in the time frame, right? Now goes here. Now what you can see is that this line, they are making lower low and lower high, all right, lower low and lower high. So this is, they are making the break through the previous high, but it's not close, above the resistance line, but the wick or the tail managed to go beyond the previous resistance. And for our analysis, we have to use all of it. Alright, we have to use all of it. And you can see that this is right, a sideways movement. Then right, this is a sideways movement. Then after sideways it goes up, right? But it does not have it does not reach beyond this resistance line. Am I right? Then it goes downward. So now currently we have no interested in Tesla Incorporated, because now you can see that it going downtrend, right? Going downtrend in a short period of time. Now we can monitor these stocks, and we can have interest in this stock, right? If it's making power here, right? It's making power here. Right? So if it's making power here, so the same situation as before, it has potential to go up. Alright, it has potential to go up. Now for current situation, it's getting worse, and it's getting where the seller getting more aggressive. So this is the time that we don't want to buy low and sell high of this Tesla Incorporated. Right, now we go to our second stocks for our power analysis. Right, so we see Twitter. Right, so we see Twitter. Now actually we had done this. Alright, we had done this for trend analysis, and we currently see the power. Right, we see the power. Right, you connect all the peak and lows. It's quite easy. Right, now in next few sessions, I will share with you on how you draw correctly the trend line, right? The line that I'm doing right now. So we will cover that topic in a special topic called trend line, right? In order for you to do all the analysis, you have to do the trend line correctly, right? Now what you can see about power here is that you can see that this is getting downward, right? And this is getting downward. This has power. Right? This is what we call a sideways. This is sideways, right? Now after this sideways, it goes down, and after this sideways, you can see that it making power. Now why this making power, right? You can see that I give a clear pattern for you so that you can see what I mean by have power in this Twitter, right? So you can see that previously the seller line goes beyond the support of demand line, and now it goes same level as the demand line. All right, the seller S2 goes the same level as demand line. So the result is, so what is the result? It goes beyond the previous high, right? So we can see the results, right, immediately. Now we see that this price trend is longer, and it has chance and to go up, because of we can see that the buyer become more aggressive, right? More aggressive, and the seller coming in, and it's making power up. Am I right? Because if we compare this loop and this loop, it has high chance to go higher than previous high. All right, this is power analysis. All right, and this is a very good stock because of it has both power and price trend analysis working together. All right, working together. Now we go to our third stock, which is Alibaba. All right, so now what you can see, right? What you can see, Alibaba. So it goes down here, goes up. Now when you choose the candle, you have to choose the first. If it's the same level, you have to choose the first, right? But if the first priority is you have to connect the line to the lowest peak, all right, and the highest peak. So now you can see that so what you can see here is this second loop making power compared to the first loop. So the result is it make power and the trend line are getting longer. So the result is goes up here. So it's a very long upward trend in 1 year movement. All right, so you just continue drawing the lines, continue doing the line, and so what you can see here is that it's still making power upward. Now you check with Fibonacci retracement, which one is have power or not. All right, so you can see here, and this one retraces at 0.618, and this one retraces above 0.618. right? It's the same situation, and you can see now actually Alibaba has still have power to go up. So this is a very good stock to buy for right now, and because it has power and the trend are getting longer, right? So in this topic, we will continue our learning session by combining price trend and power together, and we try to analyze stocks, we try to analyze equity, and with both price trend and power analysis, we have enough information regarding on the aggressiveness of buyer and seller in the market, and subsequently we are able to predict what will happen in the future. All right, now for the first component, we try to analyze one thing. Okay, try to analyze a trend, and I would like you to give an answer for this trend, maybe 1 to 10 seconds after I draw, and you have to give your opinion. Either it has power, and either it has strong trend for uptrend or weak trend for uptrend. All right, now what you can see here, all right, when we try to analyze by combining both analysis, price trend and power, first we have to recognize which one is the price trend component, and then we are able to predict the power. Remember that when we try to analyze power of an equity, we need at least 2 loops, but for price trend we need 2 main directions, 2 major line that progressing in a major direction. So we can see here it is the trend is an uptrend, so we can label this as price trend number 1 and price trend number 2. Okay, now we can see that by comparing, or in the chart you can drag this y2 to y1, and but now you can obviously see that price trend number 2 is longer than price trend number 1, and hence you can conclude that the buyer become more aggressive, thus after it retraces it will going upwards. Alright, now we want to analyze in terms of power. Although price trend is can give us clue what will happen in the next line, but the first priority we must go to power. We want to recognize either there is power up or no power up, because if there is power up, although the trend becomes shorter, it has high chance to go up because power is the first priority. Okay, now we can see that these 2 loop, alright, the first loop, the seller line retrace almost more than half of price trend number 1, but we can see that for the second loop, right, for the second loop, this is the first loop and this is the second loop. Okay, second loop, and this is first loop. Okay, and we can see that for the second loop the retracement is lower than the first one. Okay, we are comparing both of this line. If the first loop the seller retraces more than 50% of the demand line, which is the price trend 1, we can see that at the second loop the retracement is not more than 50% of demand line number 2. Thus, this component we can conclude that it has power, and it is in strong trend for uptrend. Alright, so in this condition it satisfies both of our analysis, and after this retracement, after the second retracement, we can conclude that it have high chance that it will go up. Alright, more than at least previous high. This is the first scenario. Now, for the second scenario, you have again 2 loop, and you can see that the retracement of the first loop is maybe around 30%, and the retracement of the second loop maybe around 15%. Let's say 15%, right? So when it retraces, it goes 30% of loop price trend number 1, and for the second loop, the seller, when it retraces, it cover almost 15% of the buyer demand line number 2. So in this case, when you try to analyze, you can see that Y2 is less than Y1. So what we conclude about this, is that the line is weak trend for uptrend. But in terms of power, because the second loop retraces less than the first loop, so what we conclude is that this line have power. Okay, this line have power. So what we can say about this is that because of when we analyze an equity, as per I said previously, in each topic we are looking into the power as the first priority. So after it retraces, it has high chance to move higher than previous high. Okay, it has high chance to move higher than previous high. It is because it has power to go up. Alright, it has power to go up. So in terms of Y1 longer than Y2, thus if the price goes up because of power, we are looking to sell after it break higher than previous high. Okay, this topic will include in Fibonacci topic, where we can see where our target to take profit from. Now we see second scenario. See the second scenario, and for this second scenario, I want you to give me your opinion about where the market goes. Okay, where the market goes. So you can see this is loop number 1, this is loop number 2. All right, this is price trend number 2, and this is price trend number 1. So can you tell me a little bit about what happened to the price trend first? Alright, so we can see that the price trend is higher than price trend number 1. So we can conclude that it is strong trend for uptrend. Alright, it is strong trend for uptrend. But in terms of power, so what we can see about power here, so what we can see about power here is that the first loop retraces less than the second loop. So, or the second loop retraces more than the first loop, because we can see that the seller line for the second loop almost going back to its beginning point of the first price trend. Right? So we can conclude that for this situation, the power is down. It has no power in going up in the future. So in this case, basically we don't want to get into this kind of trade, because we rather going into a trade that is have strong trend and have power, and that is a good combination of our analysis, that it has higher chance to go up in the future and you guys be profitable from the trade. Now let we see in the fourth situation. For the fourth situation, alright, again you can say to me either it has power, and you can give your opinion about what happened to the trend. Alright, now you can see that the price trend number 1 is longer than price trend number 2. So what can you conclude about this is that it is weak trend for uptrend. Right, this is weak trend for uptrend. And how about the power? You can see that the first loop, the seller retraced less, and this shows that it has power going up. It goes up, then after quite some time, the seller coming in, and it goes beyond support line of this retracement. So we can say that the seller become more aggressive, and what we can see from this is that it has no power up. Okay, has no power up, but rather it has power down, because the line getting longer downward. Right, as far as we can see that it has no power because of it, the second loop retraces more than the beginning point of demand line number 2. So in this case, we can say that after it may rebound. After it rebound, it cannot go higher than previous high, and for quite some time it will go down again. Right, goes down again. So this is something that we don't want to get into, unless you want to short your stocks, or if you want to do shorting, then this is the perfect place that you want to entry. When you see that there is no power and weak trend for the uptrend, you can wait for the rebound, and when the market reverse downward, you can get into the trade for shorting. This simple method to identify the aggressiveness of buyer and seller in the market, it is quite accurate and quite effective, and it's helping you in seeing where the next trend of the market. It involves a little bit of prediction in what you can do and how did you react when market tell you so. Right, thank you for this. And next we will, for the next topic, right, hi guys, congratulations up until now, and we move to a new topic regarding on candlestick. And in this topic, we will see how to see a reversal signal effectively through long Marubozu. Okay, in this topic we will learn about the significant signal that a long white or either black Marubozu tell us about the market trend. Okay, and it also tell us about the momentum of the market. All right, now when we use this Marubozu in this candlestick signal as an early warning for us. All right, when we have this Marubozu, we are able to see or predict what happened in the market beforehand. All right, and we will see how the reaction of market of people who are trade and invest in the market. So we can see later, and it's also indicate a reversal pattern where you can see the market try to reverse after some signal from Marubozu. Okay, and this is also an early warning sign for you to get in at the lowest price for bullish and to get out from the market when you see the long Marubozu at the highest level. Okay, what I mean by the lowest and highest level, we will see later on what I mean by this. And it's also as a confirmation pattern that when you use power and trend, when there is a long Marubozu candlestick appear, that it confirm that it will goes uptrend, then it helps in confirmation of your analysis of power and price trend. Okay, what I mean by this, later we will see some example. All right, how this coming in and how we use this as a confirmation pattern. Now, as an early warning, all right, candlestick will mention you that this move up will stop here and have chance in reversal in the future. All right, it acts as a trigger signal after you have checked first with trend and power. By meaning, it's also act as a confirmation signal to what had you been analyzed in the market previously regarding on price trend and power. All right, and see the last Y shorter or longer. All right, and then this is also an act of confirmation to what had been you analyzed. All right, and it will show you easy to move up, and either it can break previous high. All right, and what I mean by this is that when the long Marubozu appear in some certain level, so you can see that when it reverses, the long Marubozu can tell you that it can break previous high. All right, can break previous high or it can't break previous high. So it depends on the long Marubozu level. Okay, what I mean by this, we will learn on this shortly. And when we talk about Marubozu, there is two types of Marubozu. There is sell signal and buy signal. Okay, and both of this sell signal and buy signal is depend on which level does a long Marubozu, either white or black candlestick, appear. Okay, what I mean by this, consider in a retracement and in a retracement. So if a long white Marubozu appear at the first candlestick on a retracement, this is a level 3 long Marubozu, and it indicates a very strong momentum downward. When it's appear at the very first on the retracement, or it appear on the last of when we see that a long Marubozu, white Marubozu appear at the last point of a bullish rally, then we see this as an early signs that when it retraces, it will go down significantly, and perhaps it can go down previous high, previous low. All right. What I mean by this is that when the market goes up, when the market goes up, and this Marubozu white candle are at the last candle of this series of bullish trend. So this, when it rebound, it will rebound if we go to lower than previous low. All right, lower than previous low. And if it's in level 2 conditions, all right, in level 2 condition, this is we call it as a neutral. And if a long Marubozu appear at the very first of candle in a bullish trend, so this is the trend that we want to get in, and it indicates that the buyer are coming in and the momentum is very strong upward. All right, while this is the sell signal for the bullish trend, and this is the buy signal for the bullish trend. All right, and we continue with the black Marubozu. When the black Marubozu appear to be the last of in a retracement, it indicate the best buy signal that after it changed to a very strong trend upward, it has high chance to go higher than previous high. All right, for example, like in a bearish trend, in a bearish rally, what I mean by this is that in a bearish rally, when long Marubozu appear to be here, when the market try to reverse, when it appear to be a green candle or white Marubozu appear, it has high chance to break higher than previous high. All right, this is what we call as a buy signal from this long Marubozu at the very last trend of a bearish rally. All right, and later on we will go again about this so that you will understand what I mean by this. Okay, and after, for level 2, this is a natural signal. It does not indicate any significant signal, buy or sell signal, unless you compare it to the very last trend movement, and you see that the black Marubozu move from the very last trend, appear to be at the very last candle at the bearish trend, and it changed position to in the middle. So it indicate that the market is not really good, and we are not interested in this, buying this equity, for example. All right. And the last one, if a long Marubozu appear at the very first hand, so long Marubozu appear at the very first in every market bullish, this is a sell signal that you might want to sell your position, and when it goes drop down, it has chance to go higher than previous low. All right, hope you understand this, and we will go further into explain all of this Marubozu indicator. All right. So best buy signal when white long Marubozu appear in started of a bullish line. What I mean by a bullish line, as far as we know that the market move in a zigzag pattern. After some buying, and there will be selling. Okay, after some selling, there will be buying. All right. When the market reverse and this white Marubozu appear, so this is the best buy signal that we want in order for us to get into the trades. Okay, in order to get us to tell us there is an opportunity in the market that we want to ride along this movement. Okay, when it goes up, the Marubozu appear to be the first. Okay, to be the first at the bullish trend. Okay, and it indicates a strong momentum buyer coming in. All right, and this is where you want to get in. All right, and again, it is the worst buy signal when white Marubozu, long Marubozu at the end of bullish line, indicating highest point of momentum. So it's not the worst buy signal. What I mean is that it is the sell signal, all right, that we want to sell here, where you don't want to have an opportunity to have an equity here, because you see that the buyer are coming in at the maximum level before it change to seller. All right, before it changes, the market changes and the seller become aggressive. Okay, this is accuracy is almost 60%, and if you use with power and trend, price trend, it will be more powerful. All right, now recap that from previous, we can see that when the long Marubozu appear to be the first at the bullish line, it indicate a very strong momentum upwards. And if the long white Marubozu appear to be the last at the bullish trend, it indicate the highest point of momentum of buyer in the market, and the market is likely to reverse downward. Okay, this is where we don't want to be in. We don't want to be in position in the market. All right, and psychologically, this is where all the people are getting trapped in the market. All right, when they see this long Marubozu at the highest level of an uptrend, most people coming in to buy the equity. All right, most people try to get in the equity that they're thinking that the price gonna go further up, but rather this has been a good signal for people to sell the equity, to take care of the equity before the market going down. All right, Alright, and it goes to black Marubozu. When the market going down or retrace, when the black Marubozu appear to be at the last rally or the last candle appear, this is the best buy signal for us to get into the trades, because when it reverse, it has high chance to go higher than previous high. Okay, and this is where we want to get into the trades, okay, and take advantage of the movement of the trades. And this is the best sell signal. It's not the worst sign of sell signal. This is the best sign for sell signal, or the worst sign of buy signal. Alright, it's when black Marubozu appear is, pardon, yeah, this is not sell. This is should be buy signal. Right, where it's when black Marubozu appear at the first line of retracement. Okay, when the market going down, the market reverse, and there's appear of long Marubozu, black Marubozu at the retracement. So this is where we want to get out from the market, and this is a signal that the market has high chance to go beyond previous low. All right, and after it goes beyond previous low, it's usually going up again. Right, so this is the sell signal for us to sell our equity before it goes further down. Right, when you analyze, our first priority is power and our second priority is price trend. Alright, and this Marubozu is the last priority that we want to consider in order for us to analyze a trend. Okay, when there is appear black and white Marubozu accordingly, for example like this, we see this is bottom reversal pattern, and then before it goes up, the black Marubozu appears to be at the lowest below trend, and the white Marubozu appear to be at the first for the bullish trend. So this is a strong indicator for buying. Alright, this strong indicator for buying. So this is where we want to buy, where the accuracy of our analysis increase, because we know, okay, this is the bottom reversal pattern, and it confirmed by the appearance of black and white Marubozu or any single signal. All right, now by knowing this knowledge, we can use this to compare a movement in a trend. All right, the movement is easy up when Marubozu at level 1. Movement is difficult when Marubozu level 2. Compare with the preceding line, current and previous. What I mean by this is that at the first line, right? At the first line, you can see that the long Marubozu appear to be at the very low level, and this is a bullish signal. And for the second, all right, at the retracement, the white Marubozu move from the lowest position to the second position. All right. And now we can analyze the movement, the Marubozu movement, by comparing two of the movement in the same direction. For example, like when we see at the long Marubozu white candle at level 1, and for the next line it appeared to be at second level. So at this we know that it has high chance the market gonna going downwards further than previous low. And this is the same as for black Marubozu. Okay, for the white Marubozu, it moved from the lowest position, which is the best to buy, to the second position, which is it's getting worse from time for in a bullish trend. So we can conclude that the upward movement is getting difficult. Okay, and for black Marubozu, it appears to be from second level to the third level, which is a signal that is the line or the seller become more aggressive, and it goes from neutral or normal to a more severe seller in the market. So as far as we know that this indicator itself is not good when the long Marubozu appear to be the first at the retracement, but if we compare to this line and this line, we compare the movement of each Marubozu getting worse, then it has high chance of getting worse. All right, and it has high chance to move lower than previous low. Yeah, and vice versa, if the movement from higher level to a lower level, it indicate a good buy signal that it can confirm our power and price trend analysis, or even our pattern recognition. All right, this Marubozu is quite accurate. It is 60% accuracy, and we can use this for a confirmation signal that helps in our analysis. All right. When it is at the end of the trend, looking for the longest candlestick. All right. For example, like when there is downtrend, we are looking for a very long black Marubozu candlestick, and it has high chance when the market reverse for the next bullish trend, it has high chance to go higher than previous high. Okay, and when we use this, although it is a quite high accuracy with 60% accuracy, we cannot ignore the price patterns and power and also the price trend. All right, and if we use this together, it will increase our probability more than 70%. Right. Hello guys, and we will continue on the next topic, which is regarding on the Fibonacci. Okay, so Fibonacci is regarding on the collective of man behavior in investing. Actually, throughout the course, we will learn a basically introduction, and I will introduce with you on the origins of Fibonacci, a little bit origins on Fibonacci, and we will go through on how we can use Fibonacci in doing our technical analysis. Okay, Fibonacci has been proven to be really successful, really successful method in helping us doing our technical analysis for a quite number of high accuracy. All right, and before we go further, all right, with the function of Fibonacci, we go through briefly a little bit on the Fibonacci in case this is the first time that you hear about Fibonacci. Actually, it is founded it is a person name, real name is Leonardo Bonacci, and he's also known as Leonardo Fibonacci. It is where the Fibonacci analysis came from, and he was an Italian mathematician in the 12th century. He was considered the most talented Western mathematician of his time and one of the greatest of all time. Alright, that's what the history said. And although Fibonacci himself did not come up with what is now known as Fibonacci sequence, alright, he is not the one who come up with the Fibonacci sequence, and he is the one who responsible. He is the one that introduced the phenomenon, the Fibonacci findings to the West through his book, which is Liber Abaci. Okay, and because of this Fibonacci knowledge, it has been helping and has been used in wide area, including engineering, painting, music. It exists in nature, and also we use it in finance to determine our helping us in doing our technical analysis. So what is this Fibonacci functions? Okay, there are two popular functions of Fibonacci in chart reading. Okay, there are two. Number one is it is function as the retracement of seller. As far as we know that there are two lines, which is the demand line and the supply line. So Fibonacci can predict until which retracement, how many percentage of retracement, for example, did an equity reverse when they are doing pullback. Okay, and as a result of this, it is used to check price entry at the lowest. Okay, and this is what we want to do. We want to buy at the very low price, and we use Fibonacci in terms of helping us to predict or to assume at which level did the retracement will occur. And if we see that there is a reversal candle appear, and it coherence with our Fibonacci retracement, that is a very suitable time for us to buy. Okay, we are looking on buying at the retracement. Now remember, most of people saying that we had to buy on the breakout, but actually, as to buy at a very low risk, at a very low entry, we have to use Fibonacci to predict, so that we can enter at the lowest price as possible for buying. Okay, and besides of us helping us to do retracement assumptions, predictions, so actually Fibonacci helps us in predict our profit target. Okay, now it can help us predict our profit target by the Fibonacci extension. Okay, we use Fibonacci extension to measure our target. Okay, to measure our target, and it has been used as to measure trend and target. Okay, and target. And when you say about target, we mentioned about target is actually it helps us in measure our selling point. Okay, selling point if we want to sell in a short period of time. Okay, want to sell and we are not thinking about holding the stock for a very long time, we can use Fibonacci target to sell our stocks. All right, why is Fibonacci analysis is so popular in trading? Okay, now when we make retracement, in Fibonacci, and this is the same goes to the extensions, we are actually predicting the level of support and resistance of the stocks or any equities. Okay, we are predict the retracement so that we can buy at a very low price, and we predict at the extension that for our profit target, or it can be as our trend measuring. Okay, it doesn't necessarily for us to sell at our Fibonacci target, but if we doing analyze with we doing the analysis on our stocks, if it hit the Fibonacci target, when it retrace, after it retrace, it has high chance to go higher. All right, the price to go higher. And the Fibonacci target is an easy to use, and it is very appealing. It's easy to understand Fibonacci, is easy to use, and actually it is also yield a very high accuracy. Okay, very high accuracy results that can help us to see the market trend. All right, the market trend. So how to plot Fibonacci levels on the chart? All right, so how to use this Fibonacci in a chart? Okay, we will come to this later and very specific in a practical session, but for now, all right, you have to know that almost all trading platforms provided the technical tools or the interactive chart provide the Fibonacci as a part of their technical tools. Okay, we don't have to worry about this, and all trader has to do is to identify a distinct high and a distinct low. Okay, and later on we will show you on how to use Fibonacci and how to use to identify the distinct high and the distinct low, and we will help you in the plotting Fibonacci correctly. All right. For an upward trending market, it is drawn from the low to the high, and for a downtrend trending market, it is drawn from the high to the low. Okay, we will show you guys how to use Fibonacci correctly later. All right. And we will show you how to use Fibonacci as retracement. And when in a trend, traders naturally want to know how far the financial product is most likely to move in its new direction. Okay, this is we are talking about Fibonacci extension. All right. And Fibonacci retracement levels can help. Certain Fibonacci ratios are useful when you are trying to determine how far for a share price is going to retrace, okay, or move against a previous trends. Again, this is it helps us in determining the retracement level. All right, and this is how we can get into stocks at a very low price. And for this specific for this session, and regarding on advanced strategies, we are using 61.8% as our super strong power upward. All right, we're using this at least if the stocks are at 61.8% of level of retracement, the consequence rebound would have a strong power level upward. It means that it has high chance to go upward and reach its target. Okay, and if it goes to 50% medium level power for rebound, it means that it has medium level power. Okay, and if it goes to 38.2%, it has a weaker price retrace but still positive upward rebound. All right, if we determine and we see that the trend has power, so it can go higher. Okay, and 0%, that's mean that the line, the supply line or the seller going back to the origin of the demand line. All right, and we can conclude that when it retraced 61.8%, it retraced low and the seller is less aggressive. All right, and this again I want to mention to you guys that this Fibonacci retracement significant level is being used specific for this session, for this course, and usually people are looking at the 38.2% as the strong power level upward. Okay, but for our session, we use 61.8% as and above as our strong power level upward, and I will show with you special and specific how to use Fibonacci in terms of our analysis. Okay, in terms of our analysis, and we have to know that 70% of a retracement occur at 61.8% and 38.2%. all right, and for Fibonacci, we have to do it right, and it is very important to get an accurate result. Okay, if we are doing it wrong, mean if we are wrongly label the distinct high and the distinct low, and when we are doing the projection, we might get an inaccurate result. So doing the things right, as I'm gonna show you later, is very important and crucial. Okay, Fibonacci projection and target. All right, now as far as we know that trends never go straight up or down. Okay, trends move in one direction initially, then they pull back and move in the opposite direction for a while, and then turn around and resume moving in the previous direction. All right, this is a natural ebb and flow of a trend. So what we mean by this is actually the trend move in one direction, consider it's upwards, then it pull back, right, and move in the opposite direction for a while, when they turn around and resume, okay, this we are talking about the natural flow of stock market movement, and we have to know that by this natural flow or natural ebb and flow of a trend, we can predict the subsequent lines of buyer by using Fibonacci projection. Now we use this as our guideline, all right, as our guideline. If okay, now we see that this is the first line, second line of seller, all right, second line of seller. You can see that is A, right, this B, and this is the retracement C. Now, okay, now if T1 more than T2, all right, T1 more than T2 means like this is T1, the time taken for A to reach B, and T2 is the time taken for B to C. It is same as the number of candle inside, right? And T1 more than T2, if T1 more than T2, all right, and for this projection you have to remember that specific and rarely case for this course, we're using this point as 100% distinct high, and this is 0% as distinct low. All right, you have to remember this. Later we will show you, I will show you on how you can make the how you are doing the Fibonacci analysis, and how we use this Fibonacci projection correctly to project our profit target or to project our trend. All right, and now actually when we are doing we are measured trend using the Fibonacci, all right, when we measure trend using the Fibonacci, if we project the profit target and we hit or it's break above the target point, it means that after it retraces, it will continue its movement upward. If it is not hitting if you're not hitting its target point, that's mean it has chance for reversal. All right, you have to remember this. If we have target upsize, if the price hit exactly at the spot, and or it can be break above, so after it retraces, it can goes higher. So this is what actually means by is how we use Fibonacci as retracement. Okay, for example, like people are using Fibonacci to measure their next target, but sometimes they are using also using the Fibonacci to let the profit run. As long as it hit target ups and after it retraces, it has high chance to go high. All right, if it's not reach its target point, that's mean it has high chance for great reversal. All right, bound, it goes down again. So the accuracy of Fibonacci is really high, and we can say that it is almost highly as 90%, and this has been approved very long time ago. Right, now when Fibo hit or not hit target, okay, now we all right, if Fibo hit target, this is what we call hit, and the scenario B, it hit on the spot, and for the third one, it's not hitting the target point. All right, and why we are showing this, actually we are measuring the downtrend target. All right, and when we use Fibonacci as a trend reversal identification, we can see that at the first line of downtrend, it hit the Fibonacci target downtrend. The price goes below the target point, and then it becomes shorter and just hit at the end of the line, at the end of downtrend. If we measure the Fibonacci and it is not hitting its target, that's mean it has chance for reversal. Right? So if this in a major downtrend, right, this is a major downtrend, and we measure the Fibonacci target should be here. All right, and if we seeing that it is not hitting its target point, so after it goes up, right, it has high chance for reversal. All right, it has high chance for reversal. You can use this to predict and to buy at a very low price. Okay, now again, if it's not hit its target either up or down, it means it has high chance for reversal. All right, if it hit target, it means it is in a continuation progress. Okay, if retrace, then if you are not in the stocks, that means it is time for you to buy. We use Fibo to measure aggressiveness of buyer and seller of Y component trend to confirm. Okay, to confirm. Use the last two Fibo target to measure uptrend, downtrend, or sideways. And the sideways means that if the price break lower low, if Fibo sideways, it will make higher high. Y price retrace and have power to hit higher high. Okay, we will see this is what we call as speculation pattern, and we will show you guys what this is all mean about, and correlate to previous high and low, support and resistance. Okay, when we use Fibonacci, is usually if we measure a right Fibonacci, it always correlate to previous support and resistance. Okay, this is not new, and if you do it correctly, it will correlate to your support and resistance pretty accurate, right? And now if we measure up, right, and we hit our target, all right, and if we measure down our Fibonacci target and it's also hit our target, that's mean, all right, what I mean by this is that, right, what I mean by this is that if it goes up and it hit the target, and we measure, right, and we measure the target down, it hit target, so that means it will go sideways in the future, right? It will go sideways in the future. And if we measure the target Fibonacci up but it not hit, all right, it's not hit, and subsequently when we measure the Fibonacci target down, it hit, that's mean, all right, that's mean is in a downtrend movement. All right, is if we measure the Fibonacci target down, it is not hit. Okay, it is not hit. This is our Fibonacci target down, and it's reverse. And if we subsequently measured Fibonacci target up, it hit. All right, this again not hit, again hit. That's mean this is in the uptrend movement. All right, according to Dow Jones, we know that this is high and high low, so it will resulted in an uptrend movement. Okay, now if we measure the target up and it is not hit, all right, we measure target up here and it is not hit, all right, it is not hit, and subsequently we measured the target down, it is not hit, right, it is not hit, measure target down, it is not hit, again we measure the target up, it's not hit, right, measure target down, it's not hit. That's mean the market is in contracting, it is in sideways movement. Okay, but this is maybe in contracting, right, in expanding, it's expanding, this is contracting, and both of this is a sideways movement. Now when you use Fibonacci as trend measuring, and we want to identify how did the market start to reverse, for example at the bottom reversal, so we can use Fibonacci as our tools to measure either the reversal will happen or not. All right, so every time we measure target and it is easier to hit, and actually it means that the trend is very strong. All right, that's mean when we measure target, all right, downtrend, all right, first 1.618 is actually very far, and usually it does not hit target. All right, and when we measure using a Fibonacci trend and it hit our target, it retraced, and we measure again our target 1.1.0, and subsequently it hit again, and later on we measure again 0.618. Now we can see that our target is getting easier downward, so it means that it is strong. For this case, it is strong downtrend. All right, it is strong downtrend. Same goes to for uptrend. All right, it starts with 1.618 and then it's achieve its target and it becomes 1.0 and subsequently 0.618. Then we can say that it is a strong uptrend. All right, and we can use this as our potential reversal point, where when we measure target, it is for the first time the target is 0.618, then it becomes 1.0, then it becomes 1.618. That's mean the target is getting far away. Then it means that it's become harder to hit the target. That means it is we know that at that time the trend is become weaker. Yeah, it's become weaker because the target point is getting further away, and it has low chance for the price to hit the subsequent target. Okay, and then it's it can be an indication that the weak trend is in comments. Okay, it's in comments. Now what I'm saying by this is that you can see that for example, like if you measure target A, B, C, and the target is 1.618 is achieved, all right, and subsequently when you use the technique Fibonacci projection and it becomes 0.618, or usually it goes to 1.0 and it hit its target, then we can say that the trend is very strong uptrend. Okay, this is how we measure trend using Fibonacci. Now vice versa, when we measure the Fibonacci target, first the Fibonacci target is 0.618, then it become harder, sometimes it's not achieve its target, so that's where we can identify the trend is become weaker for uptrend. How about that? You guys getting all the knowledge on Fibonacci. It is pretty quite simple. It's not that hard actually, because what we need to do is to identify distinct high and distinct low pretty accurately. Then it is easier for us to measure the target using Fibonacci. Now again, 70% of stock price rebound to 61.8% and 38.2%. Alright, now, alright, when you use this, alright, when we see a line A, B, C in a bigger time frame, right? In a bigger time frame, we can see that line A, B, C here, point A, B, C, and we are interested in this part, right? We are interested in this part where we can use the Fibonacci. If the first Fibonacci hit its target, that means after it retraces, it has high chance to go lower, right? It has high chance to go lower. But if we measure, all right, there is a weak trend for downtrend at this particular part, and the Fibonacci target is not hitting its target, it start to reverse, then we know the reversal start to occur, and we know that the retracement is done and the reversal start to go up, all right, and hit its targets up, all right. And we can see that at this particular part, when it's going downward in this correction, all right, can see that it's probability that the target down is getting far, and it's not hitting its target, yeah, in the last line. So we know that the reversal point is secure, yeah, the reversal is secure, and start to hit its target up, right? And at this time, we started to realize that that the trend start to reverse, and it will reverse upwards. Okay, all right. So if we measure and we put this point A as a distinct high, and the start of the rally a distinct low, which is 0%, and when we measured this 0 to 100%, and we measured, this is the Fibonacci 61.8%. if this ABC, it is not hitting the 61.8%, that means it's easy target, but it cannot hit its target down. Thus, actually in a big time frame, we can see that it is not even touched the 61.8% retracement. So when it rebound upwards, and it has high chance to go really upwards, all right. Okay, and this is occur usually in a big time frame, right? In a big time frame where we want to see the bigger picture of the stocks. Okay, this is not a small time frame, and actually when you use this, we are able to buy at a very low price and let the profit run as far as you want to go. Okay, thank you. Hi there guys, so we try to implement our Fibonacci analysis on the chart, and we start with alright, these stocks. all right, called Tesla again. And before we do any analysis, what we must do is we have to draw the trend line. All right, this is from our previous plotting. You can see that this is the trend line. All right, this is demand, this is the supply line, this is demand, this is supply line. All right, this is demand and supply line. Now what we're trying to do is that we're trying to see the market in terms of power, and we will apply Fibonacci to see either there is power or not. All right, now if you want to use Fibonacci, right, you have in any platforms there is provided Fibonacci tools, and you have to look for it. And for example, like in this charting services, so it called a Fibonacci retracement. All right, Fibonacci retracement. Now you can see that there's a lot of types of Fibonacci, and what you want to do is you want to choose Fibonacci retracement. All right, so you want to do Fibonacci retracement analysis. And now, before I'm doing this, I want to mention to you guys that especially for our analysis, all right, especially for our analysis, now this is quite a little bit different from what you had learned or what being taught outside, all right, as far as I know. And what you want to do with Fibonacci analysis is that you want to take this level is a 0, a distinct low, and you want to take the next high to a distinct high, which is the 100%. Okay, I hope you get what I mean. You don't have to plot this, by the way, but I just want to mention to you that this is when you're doing the Fibonacci plotting. So this is the 0% and this is the 100%. All right, so what you can do is, for this Fibonacci tools, you can do is you just plot here, and right now what I mean by 100 is that it's always indicate 1 in Fibonacci analysis and 0 as 0 in Fibonacci analysis. All right, so what you can see here is that you can see all right, there is a line of retracement and line of demand line and line of the retracement, pardon me. And this is, you can see that the retracement goes up to 0.5. all right, 0.5. What it means is that the retracements goes at 0.5% or 50% of retracement demand line, and then it goes upward. All right, it goes upward. And now you can see that majority in this line is downward position, and you can see after it reached 0.5, it rebound upward and make a bullish trend. All right, now what I mean by it is different from another Fibonacci analysis is that we are usually using this as 0 point, and this is 100 point. All right, 100 point. Usually we use in normal condition we use this as 0, and this is 100. So it gonna be like this, right? It's gonna be like this. So you can see that this is 0. You can see that it still yield the same result because of the line reaches at 50% of demand line. All right, all right. What you want to do is that you put this 100% and you put this as a distinct low, which is 0%. all right, so what you're gonna do next is that you have to count the time it comes from this point to this point to the peak. So you have to measure the candles inside here. All right, you have to measure the candles inside here. So in my software I have this I can use these tools to count my bars or count the candle, which is actually the days of the candle from the distinct low and the distinct high. Alright, so you can see that automatically that this is 33 bars, right? From this point to this distinct low to distinct high is 33 bars. Alright, so from this point to this point is 8 bars. Alright, so what we're trying to do is that we're trying to measure the time component. Alright, we're trying to measure the time component between the bullish and the retracement. So now this is time component number 1. So this is time component number 2, right? So the time component number 1 is yield a result or yield a time of 231 days. Alright, and this bars is indicated of the weekend or the weekly bars, and it has 7 days in it. So on the time frame number 2 for the retracement, it took 56 days for it to goes up. Alright, now what I'm trying to show you is that and you have to remember this, if T1 more than T2, so the next Fibonacci target is 0.618, right? 0.618. So you have to remember this. This is the rules that you need to implement, right? Now what you need to implement is that now regarding on the retracement, there's nothing we can do about it. Alright, nothing we could do about it, and usually a retracement can usually retrace at 0.618, 0.5 and 0.382 of Fibonacci retracement. And this is most 70% of the one from the theoretical knowledge that we had learned before is that most of the time retracement goes to 0.618 and 0.382. Alright, and 0.5 is also considered to be quite normal. Alright, quite normal, but it's not as frequent as 0.618 and 0.382. Now regarding on the retracement, there's nothing we can do about it. In order to see there is a retracement, we have to see the candle reversal. Alright, we have to see the candle reversal, and we will tell you on how did you can be able to identify a reversal and get into the stock quite accurately in at the retracement. Alright, now we goes to this our topic first, which is the Fibonacci. Now what we're trying to do is that we're trying to measure our target. Try to measure our target, which is what we call as Fibonacci extension. Alright, now our rules is if T1 more than T2, the next Fibonacci target is 0.618. Now the next step that you must do is you have to drag this line, zero line, to this line. Alright, you have to move. Now you can see that the next Fibonacci target is 0.618. Alright, now you can see here you can see that now you can see that that we take this a simple thing. We take this just it hit its target, right? 0.618. Now you can see that it achieved its target. After it achieved its target, it start to retrace. Right? Start to retrace. Now for this line, the Fibonacci hit it target up. Right? It hit it target up. Now, right now, you can do, next you can do to measure the next target. Set this as distinct high, and this is the distinct low, which is 1, and this is 0, or this is 100, or this is 0. And then what you can do is that you have to identify, right, how much is this candle from here to the peak. Alright, now sometimes if you don't have this if you don't have this function to calculate your bars or candles, so sometimes you have to do it manually to see how much is the candles there. Right, so that you can see that it takes 91 days from this bottom to get to this distinct high, and it took 70 days to get from this bottom high to this bottom low. Now you can see that this rule is still applied. Alright, this rule is still applied, which is T1 more than T2. Right, so the next target should be 0.618. So you move this up, so what you can do, what you can see is that it hit its target. Right, it hit its target again. So after it retraced, what it means by this is that it will go up again. It will go up. Now, right now, you can see it hit its target up. Now we measure again. We measure Fibonacci target for the next line. Alright, Fibonacci target for the next line. So what we have to do is that here to here, 0, and again this is the distinct high and this is the distinct low. So you have to calculate how many candle here. Alright, how many candle here. So now you can see there is a difference in the trend line. Now you can see there is a changes in time of the candle. Right, there is changes in time candle for bullish candle and the total of bearish candle in this loop. Alright, if T1 less than T2, the Fibo target would be 1.618. Alright, 1.618. Now we can see previously is that the Fibo target previously is 0.618, which is quite easy to achieve for the first and the second line. and the second and the third demand line, and we want to measure either these have potential to achieve its target or not. Now we can see either it goes up or not. Alright, now what we can see is that the new Fibo target is 1.618 because of this T1 is less than T2. Right, now let's measure our target. Just move to this distinct low, and it is quite pretty close, and the new target is 1.618. Now you can see that the Fibonacci trend moved from 0.618 to 1.618, which is now is actually impossible, or it's getting harder for the buyer to achieve its Fibonacci target. And then when it goes to 1.618, it's normally not achieve its target. Alright, before it reaching the target, so it will retrace, and this is an indication that the buyer is exhaustive. Alright, so now our target is here, and our Fibonacci is up until this previous high, or the resistance line is start going downward. It start going downward. So Fibonacci analysis or the Fibonacci extension is quite accurate because it has been proven a long time ago, and you can see that if it's not achieve its targets, alright, if not achieve its target, then it has potential to reverse. Alright, then the next line, alright, the market has potential to go downward. Now we can see that this line going and achieve lower low than its previous low. Alright, its previous low. Now, right now, if we want to analyze Fibonacci as power analysis, then alright, if you see at this level, if we don't have to use power analysis in this if we don't have to use Fibonacci analysis, because Fibonacci is quite we have to identify the distinct high and distinct low and drag to measure the Fibonacci target or the extension. But if you have the knowledge regarding on power analysis, then you can see that, right, you can see that this line, right, this line is if compared with this loop, right, you can see that it's getting less power. Thus, when it does not have power, alright, now let me show you what I mean by that, which line it is. I hope you can get what I'm saying, and you are able to identify what I'm talking about. Which line do we which line do we are talking here? Alright, hold on a moment. So I'm looking for a rectangular shape of alright, now found it. Now if we are looking at this loop, alright, these two loops, alright, you can see that from this loop it has power to go up. Alright, this is still in an uptrend movement. Now you can see that at this loop, right, the second loop, you can see it retraced, the seller retraced back to the buyer line. It almost retraced back to the or the origin point of the buyer or the demand line, alright, compared to this loop. Alright, now it indicates that if it has no power, it has low chance to move higher than previous high for the next line. So you can see immediately the effect from this point to this point, it failed to reach the distinct high. Now how good is that? Alright, how good is that? So subsequently, alright, the Fibonacci target is not achieved. Now the power is also indicated that there is no power in the market. So what next is that you can see the market goes down below its lower low, and actually when it rebound here, you can see it making lower low and lower high. Right, now how did you want to measure the new target for your downward, for your downward? Now if you want to measure target for your downward movement for Fibonacci analysis, so what you can do here is that you can put this as AA, and right, I think this is supposed to be B, right, and this is supposed to be A, right, A, B and C line. So you need 3 points, right, in order to do Fibonacci analysis, right? So you analyze, you took the distinct high and the distinct low, right, and then you have to calculate the candle, right? You have to calculate the candle. So at this point it's 203 days. So this point is 119 days. So we can see that for this downward, T1 is more than T2, right? T1 right, this one is 119 days. So you can see that T1 is more than T2, right? Now compared to the upward market or bullish market, for downward market, if T1 less than T2, right, T1 more than T2, the Fibo target would be 1.618, right? So it's a mirroring of from the upward market, right? For you can see that this, if T1 more than T2, the Fibonacci target is 0.618 for the upward market, alright? But if we measure target down, if T1 more than T2, the next target supposed to be 1.618, alright, 1.618. Now what you can see is that, alright, now you make this is the distinct low for the downward market, and this is the distinct high for the downward market. Alright, now what you have to do is, right, can you guess what you need to do next? What we need to do next is we have to drag this Fibonacci to the new C line from A to C. Right, now we can see that the target 1.618 is far beyond, it's not achieve it target, right? This is, now you have to remember, not achieve Fibo target, right? right? This, that. Next, not achieve Fibo target. So what did you find here? What did our finding is that both upward and downward market is not achieved. Next, what it will do is that it try to go, all right, it try to go sideways, all right, because from what we can see is that for upward target is not achieved and downward target is not achieved, then it will go sideways, all right. It's not going downward, but rather it is go sideways. Now you have to remember, if it achieve a target 0.618 1.618 below this, after it retraces, it will go lower. But in this line we can see that it's not reaching its target downward, thus it will go sideways in the future. Sideways. Now we can see that it goes up to this point, right? It goes up to this point. Now what you can do is that you can change this. If you want to use Fibonacci as your analysis, right, you have to change this A, B, C, and we are now trying to measure our target up, right? We try to measure our target up. Try to measure our target up. Then what we are noticing here is that it took 119 days to go up and 203 days to go down, right? So what it means by this, if this is less than this, the next target would be, if T1 less than T2, the next target would be 1.618, alright, 1.618. Now from A, right, you move to C, alright, same goes to this line. Now we can see that 1.618 again is not achieved. It's not achieved, am I right? So what it means is that it's try to go sideways. Right? Now, previously the target not achieved downwards, and now the target not achieved upward. All right. Now we try to, and subsequently, let me finish this. We try to measure our target now. All right, our target now. Try to measure our target now. So we have identified which one is point A, B, C, and we use this as our distinct low for downward target, and this is a distinct high to measure our downward target, and this is point C. And now what you need to do is you have to identify the time needs from this point to this point. So what you can do is that what you can see is T1 is more than T2, right? If T1 more than T2, the Fibonacci target is 1.618. Now you measure here. What you can see is that point C, and what you can see is that, pardon me, sorry, right, 1.618 is way below here. Am I right? If T1, right, this T1 is more than T2, the Fibonacci target is 1.618 downward. So now we can see that it's getting inachievable. All right, it's too way far beyond this downward. So next, what it indicate, it will goes up. All right, it goes up. Now what you can do is that this one is A. You can next you measure the target up. So now what we are doing is actually we try to define the market trend. Try to define a market trend. All right. So what you can do is that A, B, C, the same process. Now you have to identify this candle, which is obviously this candle is longer than, is far more a lot compared to this. All right, now this is the distinct high and distinct low. All right, now the Fibonacci target up is getting easy, and when you move Fibonacci distinct low from A to C, you can see it achieve its target. When it achieves its target, it makes some small retracement here and goes up again. Now this is the powerful of Fibonacci target. All right, this is the very powerful analysis, the accuracy of Fibonacci analysis. When it goes, it achieves its target, when it retrace and it goes up again. All right. Now I hope that from this section you learn a lot on how to determine Fibonacci target. And again, if you can see from this, all right, if you can see from this line, these two loops are making power. All right, these two loops are making power upward, and thus after it finish its retracement here, it will go upward. All right, power is simple and powerful, but if you want to confirm the trend line, all right, to confirm the upward or downward market, you can use Fibonacci, because Fibonacci yield a clear and confirm the trend, either the trend is going upward or downward. All right, I hope you can see that there is a lot of advantage of Fibonacci analysis. And we will go to the next stocks. All right, we could go to another stocks in the next section. Thank you, guys.
All right, hi there, guys. We will continue our learning on analyzing a chart that is based on power and Fibonacci analysis. All right, and we try to see also in terms of price trends. And so far we had covered those three topics, and hence we want to include those criteria in our analysis in determining where did the price or the stock price gonna headed in the future. All right, I'm gonna show you on how you can use that three analysis, all right, and make an impact, a big impact, and forecast, all right, future, where did the price will potentially go. All right, and when you know when you do forecasting and you know what is the probability that happen in the future, it will be easier for you to trade and with more confidence and get into the trade and set up your entry and also set up your stop loss. All right, for if the position goes against you. Now we try to analyze a stock, all right, named Twitter, right? Twitter Incorporated. We take this an example, all right? We take this an example. Now, when you analyze a stock, I'm going to reveal to you, if you analyze a stock, when you see a stock like this, one of the things that you need to do is that you need to reduce the noise, all right? What I mean by the noise is that you see a lot of sideways movement going on, and there is unclear pattern appear in the market, all right, in the stock. So what you want to try to do next, in order for you to do a better analysis, a better clear picture on which direction that the price go, uh, or in helping you drawing the price trend lines. So you want to change this daily charts. Okay, this is the daily charts of Twitter. This is quite common. So when you open a chart, then it will be appear daily chart. Then if you see this kind of movement, you want to try to switch it to a bigger movement so that it will be a clear movement or price trend line. All right. So it's not 1 hour, but we change it to 1 week. All right. So what is the difference between daily and weekly? So you can see daily and bigger time frame chart. You can see it is more clear chart. Am I right? So you can see that it is easier to draw a price trend line chart compared to the daily, because you can see clearly where is the direction of the price. All right, now we start to do plotting in the chart. So what you can do is that you can start from here, or you can start from here. Doesn't matter, because this is something in the past. So all right, for the sake of showing you on how this can be done, is that you can start from here, from the lowest point, take from the lowest point and draw it to the peak, and then you continue drawing to the next peak. All right, and then you continue drawing it until you see the next peak. All right, continue to the next peak. Now when you are drawing peak to peak, make sure you are drawing it very accurate. All right, if it's you are not drawing it accurately, then your result might not be accurate. All right, it's easy as that. All right, so you can see the market are going sideways in this area. All right, you can, but actually in a major time frame, it is actually in a downward movement. So this is not a major retracement, it is small compared to this retracement. So what you want to do is that you just pick the next peak downwards. So you can see is that in this area is actually it is a sideways movement. It is a sideways movement, right? And so actually when you get entry here, if the line break down, so this is the price where you want to get out. Okay, just an extra knowledge for you. And so we continue plotting this graph. So what you need to do is next you just continue plotting peak to peak, peak to peak, and draw it pretty accurately. All right, and you can see, so the next peak is this peak. All right, so the next line, so you can see there is some finish retracement here, there is some rebound upward here, so you can consider this is the retracement. All right, for the time being, because when you do analyze the chart, you have to use current information. So this is the information that we have. So although this has potential to go downward or even further into corrections, all right, either upward or upwards or sideways movement. So what you want to do is that you try to connect this line to this line. All right, and what you can see here is that this is, all right, this is downtrend. It's not a long time for you to see that this is a downtrend. All right, so this is the place where you don't want to trade. All right, you don't want to get into the market in this area. All right, this area. All right, in this area it is in a major downtrend market. So you don't want to get into any position on Twitter at this time. So this is on the middle of 2016. So in the last quarter of 2016, the stock rebound and it goes downwards, it's continue its movement downward, but you can notice that at this time it is not going further below than the previous low. Right, it's not further go below than previous low. So you can see this. All right, so what we can see from this sign is that this is maybe a patency. It is possible a patency. When this happen, we doesn't know. All right, when this happen, it doesn't know. When the market reverse at this area, the earliest possible the earliest possible uh, price that you can see that the price going upward is this area. All right, but it do some trick for you that it goes downward a little bit and it presume going upward. I hope you understand what I mean here, but you can see that the seller become less aggressive. All right, the seller become less aggressive at this price compared to this line. All right, at this line, supply line, and this supply line, this is become shorter. And what's most important is that you can see the power. The power is from no power, all right, from this no power to have power, all right, because it retraces less compared to the previous loop. All right, so this line shows that it has power. All right, so we have, by knowing this power information, and power is our first priority, and you can see this is a signal and a sign that we can use to analyze or to see the market is start to reverse upward. All right, it is not hard. Yeah, it is easy. You can see that you can use this information to see the market reverse, because you can see the power, it is no power down and it has power up, and the seller become less aggressive. All right, and when this marubuzu bullish coming in, so you can presume that this is the pattern C, which is the most bottom pattern. All right, where you are expected to see a reversal occur in the next demand line. All right, or the next rally. Right, this is the area of earliest you can notice that the buyer are coming in. All right, the buyer are coming in, and then you can see it goes upwards since in 2017, right? In 2017, in the middle uh, until March 2018, it is in a rally mode on a weekly basis. So this is a good sign for entry. All right, in weekly time frame or a major time frame, it has power up. So this is the time that we want to be in position with Twitter. All right, this is the latest. By the way, this is the latest analysis at the current time. So you can see that this make power, and this even make more power, is make more power upward. All right, so what you can see is that after it has power and the trend line, the buyer line or the demand line become longer, you can conclude that the buyer become more aggressive, and that is strong trend for uptrend, right? Have power. All right. After this is going downward and retracement. So, all right, what you can do is that you have to wait for retracement again and enter during retracement. Right? So you are waiting. You are waiting for the price to go down and complete its retracement, and you want to get into the retracement, right, for the lowest price as possible. And this is where the stock has a confirmation that it has reversed upward. All right, So by using Fibonacci, all right? Hence, by using Fibonacci retracement, so this is 0% and this is 0%, 100 and this is 0%. You can see where is your projected target price. Next is, all right, when T1 more than T2, Fibonacci target next is 0.618. So this is our next target for this movement. All right, so this is our next target for this movement. And hopefully from this analysis you get a little bit knowledge on how we do analysis, and this is quite pretty accurate. Right, what we can do is that you enter the price at this level or this low or this end of retracement. When it shows a reversal upward, you want to get into the trade. And there is two possibilities. All right, there's two possibilities that I want to tell you. If you're gonna trade here, it has potential at least to go to this price level. All right, of course you have to trade with probability. It has goes until this, or it can goes beyond. All right, so what you want to do is that if it goes at this price level and it shows a very strong reversal downward, you want to take your position up. All right, you want to take your position up, and that's the useful of candlestick reversal at this expected point that you want to take your money out. All right, you take your money out for secure. And if you want to let your profit run, you want to try let this at this level, right, to let it commence. And you don't have to think about your trade, because most this is, all right, you can expect it. You can expect it. You can see, right, you can see that this is, right, this is cup pattern are in formation, right? Cup pattern are in formation. All right, I hope this sharing beneficial for you, this analysis beneficial for you. We had included our power analysis, we had see the trend analysis, and we had see Fibonacci for our extension or projection or profit target, take profits target, right? Right, thank you. See you in the next section, and where I will analyze more stocks. All right.
Right, guys, so we move on to the next chart analysis, and throughout all this analysis we are trying to include all of what we had learned before, of all the elements that we had learned, whichever we notice it, and we try to analyze according to the power analysis, we try to analyze according to the price trend analysis, and also we try to analyze according to Fibonacci analysis. All right, and in the next topic we're trying to analyze a stock called Alibaba Group, and this, all right, we will analyze. This is randomly, and this pattern are obvious, so you can see, and it's easy for us to analyze, and you can make good example in your chart analysis. All right, and first thing first, when you open a chart, all right, when first thing first, and you have to remember this, right? For example, like if your chart is in a daily chart, all right, so what you can see here is that in a normal chart, when you open a chart, you will be seeing a chart like this, all right, in a daily chart. So what you can see is that there is a lot of gaps, there's a lot of unclear patterns. All right, there's no continuation patterns, it is unclear, so it is very hard for us to make analysis on the stock. Right, for example, this Alibaba Group, right, it has no patterns. All right, it has no unclear patterns, unless you have to make it a weekly chart. All right, make it a weekly chart. So this is something you don't want to see when you're doing analyze, right? This is not pretty a good stocks actually, but unless you open it in a weekly chart, you change it, you switch it to the weekly chart, you are able to see a very clear pattern, a very good pattern that the stock price of Alibaba Group is making progression, rallying upwards. All right. So now we are start to analyzing because the trend are clearer, so we can do analyzing. We can analyze the stock. All right. So start from the left. So this is where the stock price from 2015. You can see that the initial IPO is in 2014. All right. So what you can do is that because the stock price dropping since the IPO to this middle of 2015, so what you can do is you have to pick up the most upper peak. So you connect it to the lowest peak, just like usual. All right, just like usual. So you connect all the lows and the highest. All right, all the lows and the highest. So drawing this price trend line is really crucial, really important, because all of our analysis depends on the accuracy of this plotting. All right, this plotting. So what we can see here is that we can see that before it going and reverse upward, you can see that the seller line become smaller in time. All right, and what I mean in time is that it takes several, maybe 1.5 years or 2 years to see these results. But what I mean is you can see better and quicker results in other stock analysis charts or in other companies. But for this Alibaba Group, we could see that the seller become less aggressive after about at the retracement. All right, so it occurs in maybe 2 years of time frame. So whatever the result is, you want to try to see either the seller become less aggressive and vice versa, the buyer become more aggressive. Then that is the signal, a good signal for you to get into any companies. All right, and all right, so what you're trying to do is that you're trying to analyze these charts before it goes upward. You can see that in terms of power, all right, we can't do power analysis at this price, right? We can do power analysis at this price because we are, in terms of bullish markets, we need to start from the demand line and supply line number one, demand line and supply line number two. All right, so this is how we did our analysis. All right, and you can see that the demand line and supply line, you can see the supply line going back to the original price point of the demand line number one. All right, this is number one, this is number two. So after quite some time, all right, being at the bottom, so the price going up, railing, all right, railing, and it retraces far less if compared to the previous loop. All right, so what could we see here is that in terms of Fibonacci, all right, in terms of Fibonacci analysis, so you could also use power analysis. And in this chart analysis, it is obvious that this second loop, all right, have power upward, right, have power upward. And this is the single most important signs that we could retrieve from this chart analysis, that it has power upward. All right, now what you can do is you can draw a rectangular at this price point, right? And I will teach you on how to get entry to a stock later. And what you can do is you can do a rectangular to the highest point at this and enter when it's breakout, and you are still considered to get entry at the retracement, because you are know now that the price is started to advance in upward movement. All right, so what you can see, the price trend of buyer become longer and the seller become less aggressive, the power have power up. So we could see that in terms of power analysis we are positive, in terms of price trend analysis we are positive. All right, in terms of Fibonacci analysis we are much very positive, right? So if you are getting into the trade, so you might want to see where is the Fibonacci target is, and it is 0.618 here, and after it reached it, after it hit its Fibonacci target 0.618, it looks like it's rallying crazily upward. All right, until from it's supposed to retrace a little bit on at 118, but the stocks are really great. It keep rallying until 183. If you are want to secure your profits, that you might want to take profits here, either full or partially. All right, it's all according to your own plan, right? But if you want to let your profit run, so this is the advantage of letting your profit run, where the stock price can go up until the sky is the limit. All right, so what you can do here is that you can see, you can analyze the stock price now. Is it either it's an opportunity for us to get into the trade. All right, so you can see the price trend is become longer. All right, the demand line become longer, and now we are come into the Fibonacci analysis. Right, you can see that the stock price retrace to 0.618, and you want to compare to these lines. So this is also at these lines also it retraced until 0.618. It doesn't touch 0.618, and the same goes to this level. All right, it doesn't touch 0.618, and we can say that the line, the buyer is still aggressive in the market. All right, it's still aggressive, and we see this as an opportunity for us to get into the trade. All right, so you can either buy here, or you can either buy at the breakout. All right, so if you buy at the retracement, so that's mean you have a low risk and high potential reward, because of the stock rebound at 0.618. All right, it rebound at 0.618. So what your next target is, you move this Fibonacci analysis to this price, to this new point, and you can see the new target is 222, right? And this is an easy target. All right, this is an easy target, right? It can goes again, repeating the same behavior before it can goes beyond to this point. But because it has been rallying quite for some time, but please make sure that it might not reaching this target, or if it reach its target, it might reverse downward, and you might want to take some profits and be careful throughout this line, because although the buyer is still aggressive in the market, but there are too much buyer, the market has to balance itself to seller. Okay, for quite some time it has to balance itself to seller. All right, because there is no such thing as a straight line upwards of stock market movement in a natural stock market movement. And I hope that from this analysis you will learn something, and you can see that this Alibaba group is still from what we see, from what we analyze, it has strong power upward. The power trend is still strong upward, and the buyer is still dominating the gameplay, and you might want to enter, and you might want to take advantage of the current situation. All right, I hope this analysis benefits you, and right, we will analyze more stocks in the future. All right, continue our learning on recognizing our first learning pattern, which is the bottom reversal pattern. And this is a pattern that really important at some area where you are able to recognize where is the bottom reversal patterns. We can see there is signs of weakness of seller in the market, and you are eyeing for an entry so that you can get the lowest entry, lowest price as possible. All right, and our objective in this bottom reversal pattern is to search for reversal potential price points that are in the process of making a great bearish to bullish market. All right, and our rule to this bottom reversal pattern, the equity must be in a major downward progress where current trend is actually downtrend, a major downtrend, and we are looking forward any signs of weakness, seller weakness in the market that enable us to get entry to the position when we see opportunity to get into. All right, and this pattern shows a potential reversal. All right, potential reversal. All right, for bottom reversal patterns, it's actually we are looking again a stock that is going downward. All right, strong trend for downtrend, and we are looking for potential reversal. All right, we are looking for potential reversal. So how are we able to recognize this potential reversal is that if you can see in terms of trend and power, all right, this pattern it has longer trend, it has a longer price trend, and it has power to go down. But after quite some time, right, stock when it's going down, it has to go up. All right, it has to reverse up because that is the behavior of a stock market. It's not going downward for all the time. Vice versa, when market goes up all the time, there will be downward, there will be correction, there will be reversal. Same goes to the for the stock that going major downward, is not gonna goes downward all the time forever. It will try to reverse and make a reversal. So our objective is to find this reversal sign so that we can get into the trade, okay, into the stock. Now for the bottom reversal pattern, we can see that actually first must be the trend of the stock must be in a major downward, but after quite some time, the power loss, right, the power loss. You can see that Fibonacci retracement downward, Fibonacci retracement for this downward movement is really small, right, really small. This indicate a major downward movement, but after quite some time we can see that the retracement for downward movement is less. All right, is not less, is more. That it's, for example, like for this, we can see that the line getting back to the origin, right? Getting back to the origin, right? So it can be like this, right? You can see that in terms of power, it has no power down, and the line downward are getting smaller. So you can see that there is no power downward, and there is shorter trend downward that indicate weak trend for downtrend. Okay, now subsequent line, we can see that it start to make power. Alright, it start to make power. And then after this a small retracement, it goes up, and this tell us that it makes power. Alright, it makes power. So how do we recognize this pattern? Alright, our point of interest is at this part, right? Before it commences upwards, we are interested in determining the potential reversal pattern. All right, so this is the illustration that I just did just now, right? So our interest is at this area where we see any sign of weak trend for downtrend, and there is power and trending up. All right, so now bottom reversal pattern must be at the lowest bottom. Okay, you have to remember that it must be at the lowest bottom, and no other pattern should be lower than pattern. All right, this pattern, and above support, right? The first bottom reversal patterns, we can see that this, right? You can see that when it's going downward, the buyer coming in, and there is seller coming in. All right, but the seller does not aggressive enough, and it does not end at lower than its the demand line beginning point. All right, it end up at the higher point. All right, so if we notice notice this pattern, is actually it makes power up. All right, it's easy, it makes power up. And we have to know that the time A taken to achieve this upward movement is less than the time taken that the seller need to go down. All right, it's more, but time B needs more, seller needs more to end up its movement, but yet it does not goes beyond of this support. All right, it shows a potential reversal. All right, again, this is above support, and time A is less than time B. So what can we notice about this is that when time A is less, that's mean that the buyer become more aggressive, because at that point we can see that it takes less time for the buyer to get into the peak of the price. Yeah, peak of the price, and it takes time for the seller to end up its supply line. All right, and this resulted that line A, right, these lines are steeper than line B. Right, these are steeper than line B. All right, they are steeper than line B. So we can say that the buyer is aggressive, but the seller become less aggressive. All right, it's become less aggressive. and hence subsequently after it end its retracement, it has a potential to go up, right? You have to realize that it is the bottom part of pattern, the most bottom part of pattern. There is no pattern that is lower than bottom reversal pattern. So the second type of bottom reversal pattern is that the seller finish at the support level, all right, at the support level, all right. So why this a potential reversal upward, all right? Can you think about it? All right, it is because of course it is does not make any power downward, all right? It does not make any power downward. Hence, last movement could be like this, but this part, it makes the seller become less aggressive, and again the buyer become more aggressive. And the most important part is that the seller take a long time to go to this to end its retracement, all right. And hence after finish up at the support, the price goes up, all right. And at the basis that why did it has the potential to reverse up is because now we learned about power. This is power, this is half power, and this line does not have power, right? What do you mean by does not have power? It does not have power to go downwards, to go down, but it has power to go up, right? It's shown a potential reversal point, right? And the third type of bottom reversal pattern, all right, and the third type of bottom reversal pattern is the overthrow, all right. It goes beyond support level, but again you can see the seller become less aggressive, and it really takes a very long time for the line to end its retracement, all right, compared to the buyer here, all right. And as a result, it has the potential to goes up, right? It has potential to goes up. Okay, when market move down, all right, when the market move down, it's actually they move sideways and then they move uptrend, all right. And there is a possibility that on the way it's on its downtrend movement, and it reach its bottom and it start to reverse, all right. And before it start to reverse, it shows a very weak trend for downtrend, right? And pattern bottom reversal join together and appear, all right. There's a huge potential indication that the bottom has been reached and it start to reverse upward, all right. And again, there's no pattern lower than any bottom reversal pattern, all right. Now this is seller behavior on the three types of bottom reversal pattern. Number one is exponential. We can see the candlestick makes this kind of movement, all right, parabolic movement. Now, all right, this is the best indication, all right. It's portray the best sign of seller become less aggressive in the market and potential reversal, right. It doesn't care it's appear in both three types of bottom reversal pattern, right. Both three reversal pattern, but if it's appear to be exponential or parabolic, all right, it has high chance that the seller become really less aggressive, all right, and this has been proven a lot in the pattern, all right. You can see the second type is the seller. The second type is seller, and this portray the second best sign of seller become less aggressive, all right. This is second best. You have to remember that the best sign is parabolic pattern, all right, parabolic pattern, and this is the least best, all right, least favor of sign of potential reversal, all right. We don't want, we are less favor on these patterns because this is a strong pattern for downward, but hence it actually has the potential to reverse upward, all right. And why do we need to know this reversal patterns? And this reversal pattern is quite useful when it comes to cup and handle pattern, all right. Any cup base, all right, of cup on handle pattern base, all right. And what we want to do is actually you want to determine the most bottom cup and handle pattern, all right. And as you can see that most people in a conventional way, we are using this method to identify to buy. Is actually buy point is here according to a lot of legendary investor. When he making a handle, then maybe there is time for us to buy, all right. Well, this is true, but when you learn about this bottom reversal patterns, when you start to make a parabolic movement here and it shows weak trend for downtrend, less power, and there is bottom reversal pattern, then you can make an entry here, all right. This is your buy point, all right. Now compared to the conventional advice that we need to buy at the handle, I'm afraid that, all right, we will buy at a higher price here and it make a fake background, then we are trapped into the market. But when we are able to buy at the bottom, then we can gain more profits, way more profits, all right, way more profits. With bottom reversal pattern recognition ability, we can buy at this price, all right. Hi guys, we will continue on our discovery on our second pattern, interesting pattern, which is what we call as a continuation pattern. As it names, continuation patterns is actually a continuation pattern of bottom reversal. We want to identify either bottom reversal pattern has a potential to go even further up or not, all right. So we see what is this continuation pattern is all about, all right. Now before this we had learned about the bottom reversal. So after this bottom reversal, all right, we want to see either the movement has the power to move up or not, all right. So what we do is there is a target, and if T1, all right, this is the requirement of continuation patterns rules. If that it must time frame for 1 is less than time frame for 2, all right. The demand line, it must be higher than the seller line or the supply line, all right. If this happened, or if we see from this bottom reversal pattern, then we can make a new target for pattern C, all right, for pattern C. Now target of pattern bottom reversal, the new line should be actually at least y1 plus times 1.618. Alright, what I mean by that, we consider this is as our y1. So actually y2, the new target must be at least 1.618 of y1. Alright, so this new target is actually, alright, is actually 0.618 higher. Alright, so if hit the new target, it has chance to be pattern C. Alright, it has chance to be pattern C. That retrace should not be lower than 61.8. Alright, 61.8%. Alright, and what I mean by this is that after it hit target, it can have potential to retrace at 61.8% of, right, 61.8% of y2. Okay, and our objective for this continuation pattern is, obviously we want to see either the trend it will be continue upwards or not. So if we are able to see the trend would continue to go up, what it means? So guess what it means? All right, so we can let the profit run. So the rule for this to happen is that the pattern must shows potential reversal. All right, must shows potential reversal. That is, pattern bottom reversal had been occurred, and then we measure the new target for the next loop for the demand line, which is y2 equal to 1.618 times y1. Alright, it's that easy, it's not that complicated, and you can immediately predict what will happen next. Alright, now we know that, right, pattern, this is a pattern bottom reversal, right? We illustrate again for you so that you guys can have more understanding on these patterns. So basically what we're trying to do is that we want to see this new target reaching 1.618 of Fibonacci of y1. All right, so how did we want to analyze this? All right, is it has potential to go 1.618? All right, now if does it has potential to go 1.618, we doesn't know about this. All right, we have to wait for the stock to move by itself upward by after the bottom reversal. So we are looking forward to this pattern. Either for buying opportunity, or we can let our profit run. All right, so actually you must have pattern bottom reversal, okay, and y2 must be equal 1.618 of y1. Again, this is the third time we recap on this, and if it happen, that is mean when retrace, all right, if y2 retrace, it has high chance to retrace 61.8% of Fibonacci proportion of wave. Right, what we mean by this is that if it hit target, all right, this is pattern bottom reversal, and there is a continuation pattern, and we can see that at least the new target must move equal or higher than y1 times 1.618 of Fibonacci proportion. Right, what we mean by this is that this line, when we drag our Fibonacci and then make it to a distinct high and distinct low, right, this is 100% and this 0%. Now, all right, we can see that this line retrace at 61.8% of Fibonacci proportion. All right, Fibonacci proportion. Now we know that after this pattern commence, all right, we know that the next movement would be aggressively upward. So now we don't want to be rushing in selling our equity when it goes down, but rather if we want to let our profit run, and that's what we want to do when we are trading in any financial equities. We want our profit to be big as possible and our loss small as possible. So you must let your profit run. All right. How did you let your profit run? Is that must be patient. You must be patient, and you must let it retrace for a while. And then if it comply to the rules and guidelines, it will retrace at 61.8% of Fibonacci proportion of Y2. And after it shows a sign of reversal at 61.8%, all right, after it shows a potential reversal, which is the candlestick reversal. So it will goes up. All right, and it will not only ordinary goes up, but it will aggressively goes up. All right, but you have to remember that Y2 must be 1.618 of Y1. All right. Now, pattern bottom reversal and continuation pattern to confirm is it real bottom or not bottom. All right. Basically, this bottom reversal already confirmed that the bottom has been achieved, and if continuation pattern appear, it's double confirm and reaffirm that the market has been reversed upward. All right, especially when at some certain scenario in certain patterns, for example, like cup and handle patterns, you can see these patterns at the most bottom part of the cup pattern. All right, and you can be able to identify the reversal, the bottom, and subsequently reversal, and you are looking forward for an entry at this point. All right, at the most bottom part of the cup pattern. And what you must do is that you have to monitor for bottom reversal and continuation. If you manage to get into the trade, all right, you must let your profit run. If it achieve continuation pattern rules, it is advisable that you let your profit run thereafter and use Fibonacci to measure your new target. All right. And why this is very important is that you're not too rushing at selling your equity down, but rather you let it profit run. All right. And if you understand about these patterns of both this pattern bottom reversal and continuation, and you'll be able to make a lot of money in the market. All right. But this pattern, from my own experience, is quite a long time frame pattern. But you must have patience to wait for it to go up sometimes, right? And but it's worthwhile, right? It's worth a while because you buy at the very bottom part and you can let it run, or you doesn't even care about what happened next, and you can let the profit run as far as it can goes up in the sky. All right, and you can enter from bottom reversal patterns, but again monitor for pattern continuation thereafter. If pattern C shows, again let the profit run. Right, this is what we are talking about just now. Do not rushingly at selling your equities down. If there is continuation pattern, all right, reaffirm the line or the patterns, then you can let the profit run for a bigger profit in the future. All right, if this pattern C does not appear, so what you're gonna do, what you have to do is that you rather plan to sell it because there's might not be chance for the pattern to continue upward. All right, maybe it will retrace more than 61.8%. all right, then you don't want to miss out these profits at this time. If it retraces more, you want to sell it, and you are looking forward to buy it again in the future, because it goes lower than 61.8% and it has no chance of in moving up. All right. Now, if after pattern continuation not hit 1.618 and luckily it goes up right after the retracement, it is the result of market fluctuation. It is not the real move up, right? It is not the real move up. But if you have still you have still have the positions, so you are looking forward to sell it. All right, take this opportunity that the market want to give you money, extra money, then because of this is not comply to our rule, and you are looking forward to sell it when it's move up, because it is an opportunity for you to sell at higher price, and again it is not real move up. Hi there guys, so we will continue on our next pattern, which is a speculation pattern. Now in this pattern, all right, it's not for a long-term pattern, but it's rather for a short position pattern, where we are trying to look at we're trying to get into the trade and speculate and right into the profits when the opportunity comes. All right, now what is this speculation pattern? All right, so before we go further into our speculation patterns, now we need to understand a few of things. Now we need to recap a little bit of things about in understanding a direction, in understanding a market trend. So the first thing that you need to know is market move in uptrend, downtrend, or sideways. Okay, they move in either these three movement. All right, market cannot move in any other way. All right, it has to be uptrend or downtrend, or it is sideways. All right, now we have to understand before, when market move in an uptrend, all right, it is making higher high and higher low each single time. All right, when the times come, we are looking that the stock or the shares price or any financial equity make higher high, all right, higher high and higher low. That's mean the market have trend. So when the market have trend, when it makes higher high and higher low, it means it goes to upside trend. All right, it is in an uptrend. All right, so now in an uptrend, we see that Fibonacci target down is always not hitting. All right, you have to remember this, and you have to know this. The Fibonacci target down is always not hitting. All right, because it's always hit it up. Thus, the market move in trend according to the Fibonacci analysis. All right, and Fibonacci target up is always hit. All right, if you doing Fibonacci, then you will find that this is true. All right, when an equity or stocks always hit target up, so we say that through that Fibonacci, we know that the market move in an uptrend. All right, now same goes to downtrend. All right, vice versa. When market move lower high and lower low every time, all right, it means it is in an uptrend movement. All right, higher lower high and lower low, that's mean it is in a downtrend movement. Now in the downtrend movement, we should know that we have a direction, all right, which is on the downside. All right, we have the trend, and from Fibonacci analysis, right, Fibonacci target up is always not hitting. All right, it's always not hitting, and Fibonacci target down is always hit. That's mean when it's easier and it hit it target down, it means that the market is moving down. It's moving down, and it is in the downtrend movement. Okay, now we understand one movement that is less talk about, that is sideways movement. All right, there are a few rules govern in a sideways movement. All right, there is no exact direction in a sideways movement. There is no trend. Thus, all right, the shares, the stock price doesn't go anywhere. All right, it doesn't go anywhere. It's in a sideways movement. All right, and Fibonacci target always misses both. Always misses both target up and target down. All right, or it always hitting target up and target down. Right, when this happen, is indicate next line that it has a really high potential that the market is in the sideways movement. Right, now basically sideways movement does not have direction, means that it didn't go either up or down. All right, now we learned that there are two movements for sideways. All right, there are two movements for sideways, which is the first one is contracting, and the second one is the expanding. All right, now we go first analyze what is a contracting sideways. Right, contracting sideways. Now a contracting sideways, all right, it's always making lower high and higher low. Right, it's always making lower high and higher low. All right, now I believe that you could understand better with this figure that it does not have any trend. It does not go up or it does not go down. All right, it's in a sideways movement. Now we could see that there is no trend, there's no uptrend or downtrend. And one more thing is about the Fibonacci target. Yeah, it is not hitting for both up and down direction. All right, now we can see that, for example, that this is upper side target for Fibonacci, and this is lower side of Fibonacci target. Both target does not hit. All right, and it gives us an indication that it is in a sideways movement. So when we measure the Fibonacci target for the next line, we could see that it's still not hitting a target. All right, it's still not hitting a target. Now for the lower side target Fibonacci, then target is still not hitting. All right, it's still on a sideways movement until at one particular time it hit one of the target, either up or down. It means that it will continue into that direction. All right, you have to understand this. All right, now we go to the expanding sideways, which is expanding sideways is rather different from contracting, where you can see that the line diverge. Right, the line diverge and getting bigger when times come. Right, so you can see that the pattern, it making high high and lower low every time. All right, high high and lower low every time. Now you can see the Fibonacci target. All right, it's always hitting. It's always hitting. Now target up is hit, and target down is hit again, and target up is hit, and target down is hit again. All right, this is what we call as sideways. All right, sideways expanding market. Now again, we could see that there is no trend in a sideways market, and Fibonacci target hit for both direction. All right, now it comes to our pattern that we want to analyze, the speculation pattern. Now, all right, how did we want to take advantage of this sideways movement? All right, sideways movement. All right, now after quite some time, all right, after the market have a bullish rally up, all right, it comes to a moment that it finish up its rally, or the weak trend for strong trend for uptrend has shown, so it becomes, the trend become weaker by time, and we are eyeing an opportunity to speculate the movement, because of it has high chance that after the bullish market coming in, it will go sideways. All right, as far as we know, that we learn about the P trend, price trend, right? If it's become weaker, then after sideways it goes down, right? And in that sideways movement, we want to take advantage and try to speculate during the sideways movement. All right, now after a major direction upwards, it's making the line making high high and high low. All right, there is time where the market move in a sideways movement. All right, when this line, all right, when this line, you can see that when it make a high and out of sudden it makes lower low, than the previous low. That's mean this target is hit, this target Fibonacci target up is hitting, and Fibonacci target down is hitting. Right, subsequently, what it needs to do in order to rebalance everything, so this line, the new line, will go upwards. All right, it will continue, it will go upward. All right, so now how do we speculate? Right, how do we speculate? We speculate when it reach lower low than previous, so we know that this is a sideways movement. So next probability that it will go sideways, we want to looking to buy at this point. Right, this is what we call as buy region. Right, and this is not for a long term. All right, remember, this is only for speculate. Right, at least it will goes beyond this point. All right, at least, and it can goes beyond, right, beyond this point. Now after it reach here, reach this area, we are looking to sell, we are looking forward to sell the equity. All right, for speculation. Right, and this is our target. Right, and this is S pattern. Now requirement for S pattern is actually we need two loop to identify S patterns. Right, and if price move lower than previous low, we buy. All right, we buy for speculation. Means speculation, we sell only, we buy only for a short period of time, and we are looking at any time soon to sell the equity, to sell the stocks. All right, again, all right, is how it's making lower low, then we are looking at buying at this point. All right, at this point we are looking for buy and ride along with the profit for a while. All right, after it hit our target, mean like at the middle, then we are looking forward to sell. Okay, before the previous high. Right, before the previous high, and we can monitor for any signal here, for any marubuzu, that is confirm our analysis. All right, and now the market from major upward, it goes sideways. All right, from major uptrend, now we know that currently the market goes sideways. All right, this is S pattern, and we are looking forward to speculate in this S pattern, as far as we can see, that it will try to achieve and rebalance everything in the market and try to achieve its target before the high. Right? Thank you. Hi guys, we will continue our learning on the next pattern. It is what I call as complete patterns, where we can buy on the lowest point and let our profit run very high. All right, this does not necessarily for bottom reversal, but if it shows us this criteria, that means that it is the most great patterns that we want to get into and ride along the profits. All right, and for complete patterns, we have power, price strength, and time component work together, and it shows us that it has high potential to go really high in the future. All right, this is a pattern that we want to, right? We doesn't care either at the bottom or in the middle, but if we find this pattern work together, this is where we want to get into the trade stocks right along the profits and let the profit run, right? And you can see that from these patterns is can be a bottom reversal patterns. You can see that this time 1 is more than time 2. All right, or we can say that time 2 is more than time 1. All right, what it means by this is that for this second loop, it takes more time for the seller to go down, right? It takes more time the seller to go down if compared to the seller in the loop number 1, right? Thus, all right, besides power, as far as we can see that it makes power upwards, right? And we can see that the price trend is getting longer, right, in the second loop, and we want to see that T2, the seller aggressiveness is less than the seller aggressiveness in loop number 1, right? That's what it means. So when it goes up, it has high chance to go really high. All right, this is what we want to have. All right, this is what we want. This is where we want to get into the trades when it shows reversal upward. This is what we call as complete pattern, where power, price trend, and time component work together, right?
We will continue on our next topic, which is regarding on management. This is a very essential topic that we need to cover, because if we doesn't manage our risks, we will exposing our portfolio to a very great risk. And a lot of people who are, especially traders, who are beginners, they doesn't know, and there's sometimes ignorance regarding on risk management. And at the end of the day, all right, it's not take a long time for their account to be wiped off, because of they have no risk management in place. All right, if you think about trading, right, if you get into trading, risk management is one of the essential knowledge that you need to learn, that you need to practice. All right, making money in the stock market is not easy. All right, it's not easy. Although we have a very high probability trading strategy, but if we can make money with consistency, all right, yearly by yearly or monthly by monthly, with consistency, all right, it's more than enough, all right, if we could not really too attached with our trades, all right. Most of people, if they most of people, when they are trading, they doesn't have risk management in place, and because of this they have really uh, emotional attachment on their trades, and this resulting that they could not make proper decision in the market, all right. they are they have emotional attachment. The size is too big, so one bit or two bits movement of price make a lot of difference, not only in terms of reward, right, but in terms of the exposing of yourself to unnecessary risk, all right. So actually when you are trading, you want to expose your trades in equal risk with low risk as possible, all right. Most of people when they are trading, they have this risk management out. They want to get rich very quickly. By the end of the day, 90% of them, 99% of them get get broke quick, right? Get broke quick if you doesn't follow your risk management. So this risk management is really, really important, all right. And it is not really an interesting topic to discuss, but it is really necessary for traders. uh, and a lot of people pays a very expensive knowledge in trading because they doesn't put into practice on their risk management. Now, as far as we learned before that, risk management is second element that constitute to trading success. All right. The number one is the psychology. The second one is risk management. The third and the fourth one is regarding on fundamental on tech and technical analysis. And trading and risk management is the second element to master, all right, in trading and investing. You could not afford not to learn risk management, all right. What you want to do is you want to survive in the markets, all right. You're not gonna know when is the next bull runs. You're not gonna know when is the most bearish moment in your trades. So what you're gonna do is you want to have a system, have a risk management profile that help you uh, that can help you to make money in the good times, enhance and also protect you from any major downside, all right, during the bad times. So there is fixed amount of risk management that you can implement, all right. But today we will talk about how do you control your risk management, right? Con- Risk management is all about helping an individual to survive in the markets by not exposing your portfolio with too much unnecessary risk. All right. Your goal is to keep risk under control and to minimize losses and survive at the end of the day and survive with a total positive portfolio. When you talk about risk management, it's also about asset allocation. All right, it's all about asset allocation. How do you balance your risk portfolio within financial equities? Right, as far as we know that stock market is also a very volatile market, and there is also a very many vehicles that is more volatile, and there is also a vehicle that's considered to be safe to invest. All right. So what you're going to do is you want to balance your portfolio within these equities so that you are not expose your investment in unnecessarily big risk, or in unnecessary in only one investment vehicle, right? As far as we know, every financial equities have different volatility and risk profile. All right, you do not want to put everything in one particular vehicle. All right, especially when you have when you invest in a very large capital, you want to segregate your risk orderly so that you are not exposing to unnecessary risk. And at the end of the day, you know that you're going to make money. All right, so this is the objective of risk management. And when you talk about risk management, it's all about produce expectancy. All right, when you invest a portfolio and you are following through a kind of system or a kind of strategy that you know you're going to produce this kind amount of money during this some certain period of time. All right, when and you are already knows this because of you already knows what the strategy or the system are capable to do. All right, of course you're not gonna have same results every time, every year, but when you follow a certain system, you know you're gonna make money every year, right? And you are not exposing and you are not wiping out your portfolio in a single trade. All right, so you do not want this to happen. And many of traders again learn expensive experience because they have no risk management in place. All right, and when you talk about risk management, is also regarding on producing consistency, right? Result in the market. And although risk management topic um, right, consists of a large topic. So today we're going to talk about a little bit detail. In particular, we want to talk about your trades, right? How do you handle your trades, and when to get in, and also when to get out when you are wrong. All right, we are not talking in a big context, but we are talking based on your trades. All right, your trades. So this is very crucial. And risk management is actually also about how much the amount of shares to buy and sell. All right, and sell. What it means by this is that is about the position sizing. It's about the position sizing of your account on how much shares that you need to buy and how much shares that you need to sell. All right, if the trade's going again going with your direction, right? And risk management is also about stop loss, where to get out when you are wrong. So this is this action, all right? This action is very relatable to your strategy, right? If you don't have a very good strategy in place, so you actually uh, or less knowledge on where to get out. And this, when you have this less knowledge on where to get out, you have less confidence. You tend to be panic in your trades, and at the end of the day you not implement your risk management. So if you have a good strategy that will be discussed in this topic or have been discussed in this topic, you will know that where to get in and where to get out. All right, exactly. So that you didn't hesitate when to take action, when to get out. All right, from your trades if the stock price going against you. All right, everything you invest, all right, it comes with risk that is proportional to return that you are able to get. Right, you have to remember this is that before you invest, always got your you have to take responsibility of this, and you have to be aware that you always got you have to calculate and you have to know your trading amount that you are willing to risk. All right, simple to say, if the amount is losing is too big, all right, you are not allowed to put that amount. All right, if you are comfortable of losing $500, all right, put that amount as your risk profile. right? So this is something that you need to decide before you enter any trade. If you invest without knowing this, you'll be losing in the markets because you didn't know how to take action. You panic and target when the stock goes against your direction. And remember that we want to make money safely, and we want to be consistent. You want to be consistent in the market. That's how you make money over and over again. All right, and not be wiped off with with a single trade. All right, and I'm a former stockbroker, so I see a lot of traders, or I see a lot of beginners wipe off their account because of they didn't put the risk management in place. Either they know about it, or they just unknowledgeable about risk management. They think that the hunch is correct. They feel that the stock gonna be rally, right? And suddenly, right, the stock going in against their directions, and all right, they couldn't put action, right? They couldn't put any action on stopping out or minimize the loss accordingly. And all right, when you talk about risk management, you have to determine where to put your stop loss correct, right? And measure. It's not only about stop loss, but it's about measure hit target for uptrend and let your profit run. All right. So what I mean by this is you must have a take profit strategy accordingly, and while allowing this take profit uh, to be done from time to time, you want to let the profit run. You want to let your profit run from time to time. All right, so you don't want to take all of your money at once, but actually you want to let your profit run from time to time. So this is how you make money a lot in the market, by letting your profit run. All right, so if you have a strategy that is balanced between take profit and allow your trades, your profit to run, you will have an average amount of, for example, like losing and profits. All right. So at the end of the day, you might be break even, or you might be profitable a little bit. All right. At the end of the day, but the important thing is that you do not want to be losing in the market. All right. You want to have a strategy that minimize your loss accordingly. And when you implement a kind of strategy, you are, at the end of the day, you are able to make money from the market. Believe me, making money in the market is uh, is steady. Slow and steady is the best. All right, it's not the best way to make money in the market is not at any one particular trade and you lose more in the next trade. All right, so the best way to make money in the market is that you make money in and out of the market every year, uh, year by year. All right, so that's how you win the stock market game. So what you want to know is that when you trade safely, you want to trade within your budget. All right, you don't want to trade using any margins. All right, and I have been working as a stockbroker before, and I know a lot of people, they trades, they have their account wiped off because of, and not even wiped off, they are in debt because of they are using budget, they're using margin provided by the broker. If you are using margin from the broker, or uh, any cash help, make sure that you are able to pay it again, right? You are able to pay uh, the money if something happen. All right, so what I mean by this is that you must trade within your budget. All right, you do not uh, use any borrowings or debts to invest, right? So uh, this is something that is very crucial, because when mostly beginners, when they are starting their career in stock trading, they are delusional, all right? They are overconfident. They use all their guts, and they use more than they could suppose to use, and this making them uh, if making them losing money if they are uh, get into a wrong path, all right? If they do not put their risk management in place, so when the stock goes against them, they are unable to accept these losses, and hence they are unable to take action or implement their stop loss, all right? This is very crucial. And again, consistency is that you having a right you having a strategy that is producing positive results every month or every year, and then while you have this protection system, you have a strategy of winning big by letting your profit run, all right? And believe me, in 5 years of trading, all right, I'm also be once a beginner, so I want uh, win every time, and I want win big, and all right, and this has cost me, and for example, like a few years break even, all right? And if you have a strategy uh, and you implement it accordingly, and you have a positive portfolio, uh, maybe in between 3 to 4 months, it's good enough, all right? Don't try to make money too quick in the market, all right? Because when you make money too quick, you can lose too quick too, all right? You don't want this to happen. You want uh, at the end of the day, you have a very positive portfolio, all right? You can even have 30% or more than 50% of your total account equity compounded every year. So this is possible uh, if you are following uh, a system, a success system, and you are not greedy in the market by putting all your cash into one particular trade because of you want to win big at one time, all right? You don't want this to be happen. Hi guys, in this session I will show you on how to calculate a 1% rule and how to implement 1% rule risk management. By the way, this is risk management has been used by a lot of successful traders and bankers all around the world. They are using 1% rule risk management in their trading strategy. All right, when you are using 1% rule risk management, you are considered to be really, really conservative enough in order for you to cater risk in the market. All right, because of 1% is small. All right, if you get 10 straight loose, it it is quite impossible for you to diminish your account in although you have 10 straight losing, all right? So that's why this 1% rule risk management is created to protect you so that you have high chance of survival in the market, um, so that you have an opportunity to make money again and again, all right? So we'll continue for our calculations, right? For our 1% rule, but this is quite gonna be quite straightforward, where we have an entry at 0.9. All right, you identify a stock and you identify the entry is 0.9, and you have stop loss of 0.8, right? And you have a total capital of $20,000, right? So why did we implement 1% rule risk management? Is that our objective is to calculate how much shares that we need to invest on one certain stocks, all right? So that we do not overtrade, so that we have a protection in the market if the market or the stocks going against us. All right. So this is the criteria, right? And so we have $20,000 in capital, right? So how much shares that we need to buy? And then we have to calculate our total amount of risk, which is 1% of 220,000 is $200. All right, this is the amount that we are willing to risk, right? For 1% rule risk management. Although a definition of risk management is about the money that you are willing to lose, it doesn't necessarily to be 1% rule risk management, but this is the one that being used by successful traders and bankers. So what you need to do is you have to identify how much you want to lose in the market. All right, how much you are willing to lose. This is a very important questions that you need to answer, and you need to identify when you get into the market. This is the answer that only you can give this answer. All right, provide this answer on how much that you are willing to risk in the market. So if you are willing to risk 300, so um, it's maybe more than 1%. All right, but it's okay because it's depend on the individual trader how much that you are willing to risk. All right, so let's say you buy at 0.9 cents per share and your stop loss is 0.8 cent. All right, so how many shares that you need to buy uh, at 0.9 per share with $200 risk if the stocks or the stock price going against you, and you decide to stop loss at 0.8. And in this 1% rule risk management or any risk management technique, you have to identify your entry and you have to quickly identify where you're gonna be wrong and where you're gonna go out, right? Where you're gonna stop loss or sell out your position if you are wrong. All right. For example, like in this case, um, we going to decide our stop loss at 80 cents. All right. So how many shares that we need to buy? So this is the calculation of the 1% rule. Right. So first we need to calculate the difference between the share price and its stop loss price. All right. How to calculate the difference is just minus the higher, which is our entry, and minus the stop loss price, which is in this example is 80 cents. So 90 cents minus 80 cents is equal to 10 cents. So we are willing, in terms of the stock price, we are willing to risk 10 cents, right? We are willing to risk 10 cents. So by using ratio, right, 10 cents equal to $200, which is the difference between the current price and stop loss, and our and we equal that to how much what we are willing to risk, right? So in this case we are willing to risk 10 cents equal to 200. So what we need to do is that is cross over this. All right, just cross over, right? You can say 0.1, right? 0.1, right, equal to $200, right? And 0.9, so how much that we need to invest in the market with $200 risk. So what you need to do is simple, right? So you cross over this, cross over, So the one that meet up each other, you have to multiply, and you divide by the one that isolated here, right? So what you need to do is 200 times 0.9 divide by 0.1, right? So 200 times 0.9 is equal to, right? So you have to calculate it. So when you times this both of this and you divide by 0.1, it will a result of 1800. So this is the amount, this is not the amount of shares, but this is the amount that you're going to put in the market to buy the stock. All right, so next step is you want to calculate how many shares you want to buy. All right, so 1800 divided by 0.9 is equal to 2000 shares. So this is the shares, the number of shares that you need to buy in order to get in, all right, to get in at 0.9 with a stop loss at 0.8 by risking $200 of your total capital, which is 1% of your uh, total account. All right, so this is a very conservative strategy, while you are able to protect yourself from any downside, right? Downside of your total account equity, so that you could survive in time. You could survive and not destroying your account in a single trade. All right. So uh, for beginners and losers in the markets, they are usually ignorance, and sometimes even the experienced traders, they are not willing to implement this 1% rule, is because they see that it is too small and their profit potential is small. But rather, if we are seeing at, in terms of risk management, this 1% rule risk management is the most uh, conservative strategy that enable you to survive in the markets and make money again and again. All right. So, like what I'm sharing, if you are willing to risk more, but first, it's okay, but first you have to identify how much that you are willing to risk in the market, right? So I hope you learned something from this session about how to manage and how to calculate your risk, so that you can get your risk uh, in manage, right? In not in a disarray. And if you are not implement any risk management, actually you are exposing yourself from major losses, and you do not want to overtrade, because sometimes when you are too overtrade, and a lot of losing traders, they're losing the account in a single trade, all right, because of they do not implement their risk management properly. Right, this calculations, all right, now we get into the manual calculation. But in the next few sessions in videos in risk management, you're getting on risk management, I show you on how you can use journey trading journal template that I attach at the resource, so that you can use that as a automatic calculator on how much that shares that you need to buy in order for you to raise some certain amount of money in the market. Right? I hope this helps you. Enjoy trading. So what the advantages of this 1% rule? Of course, we had been discussed this before, that it has been used by all successful professional trader and investor all around the world. Okay, if let me think about this. All right, in real life, the professional trader and investor, all right, they have a lot of money. All right, they are big institutional investor, and they had to comply their trading rules by 1%. All right, but if you are willing to risk more than that, all right, maybe 1.5% or 2% of your total equity, that is acceptable. All right, as long as you can accept the losses in any single trade, and that's gonna be fine. All right, and what you had to make sure uh, is that the strategy that being used, this 1% rule, is a very low risk strategy over a long period of time. So this is something that you need to implement, that you need to be disciplined, that you implement 1% rule risk management, so that your account are protected over a long period of time, and you see, you'll be able to see that your account growing, all right, from time to time. And believe me, the fastest way to compound your wealth is is steadily growth. All right, is compounding growth. It's not you want win one time big and lose one time bigger. All right, you don't want to do this. What you want to do, what you want to see, is that your equity, your total cash being compounded steadily over a period of time. So this is something that you want to do by implementing this 1% rule. All right. And if you implement this 1% rule, you have a lot of chances to gain massive profits in the market. All right. Especially when you are a beginner. It is because if you implement 1% rule, just like you have a very massive shield for you to prevent yourself from getting rid out from the market. So this is something that you don't want to do, or want to happen to you. You want to reinvest your money over and over period of time. And one more important point is that you want to be steadily have a steadily psychology, have a great psychology, so that you are not panic when this market goes against your directions. Well, it is only 1%. You don't mind if you lose. So this is something that in an environment that you want to create. All right, when you use this 1% rule, and when you implement a low risk strategy, all right, you get, you not easily panic, and you are able to make a very good decision that is not based on your emotions. All right, so this is something that you want to do. You want to get rid of all of that unnecessary emotions from you. All right, believe me, over a long period of time, when you trade, all right, this is how my wealth compounded every year, by steadily growth my equity, all right, from time to time, not try to gain massive profits at only one time, because you cannot do that. All right, unless you see the opportunity coming in. When you get very experts in the market, you get a long experience in the market, you are able to predict better. You are more skillful at getting in, you are more skillful at getting out. So you are not emotionally attached to the trades, but you make unnecessarily decisions when it comes to make either to get into or sell your trade. All right, for profits. Now, how do you want to get an advantage in the market? All right, one, how do you take advantage of the market. So what you can do is that you can speculate, all right? You can speculate in between, you maintain a safe and profitable trading over a long period of time. So what I mean here is that you implement 1% rule, risk management rule, and what you want to do is that this is your first main account, which is for long term, but somehow in between, when you're getting expert at looking in the patterns in the markets, you are more confident and you are more skillful at getting in and getting out by not being emotionally attached to the trade, and you have high chance, all right, to get the profitable trades. And you can, why not, you can speculate the trade, mean like you can have a uh, short short positions. What I mean, short term positions over the long term position. All right. Whenever you see the opportunity coming in, all right. This is not for every time. When you see the opportunity is coming in, so you can speculate. But you have to bear in mind is that your long term investment, all right, is your main account. Right. This is something that you have to bear in mind. And what the beautiful things about this 1% rule is that it is suitable for all financial products. It is applicable to all financial products. Yeah, because we are talking about probability of a large trade that you make during your trades. Okay, it is same goes to the stocks. It is same goes to the option, and it is same goes to the futures. Thank you. Now, in this question, it is an interesting topic that we want to discuss is that how much capital that you need to use, all right? At any particular one time, how much capital that you can use, all right, in order for you to generate a sustainable income over a long period of time, all right? So now, there's a few types of traders in the market. All right, there's active trader, there's a long-term trader, there is an huge investor that hold their positions over a long period of times over the years. And all right, for an active trader, usually use 20% to 50% of their total capital at one particular time. Right? Why did you do this? Why this is a rational and a good number? All right. When you use 25% to 50% of your total capital at one particular time, this is because you can't predict the market. All right, you can't predict uh, when it's gonna be bull market, when it's gonna be the next bear market. All right. So what you're gonna do is that you want to use 25% to 50% of your total capital, depend on your preference. All right. You can use this amount at any one particular time in order for you to generate a good income in the market, all right, a steadily income in the market by implementing a good risk management. All right. So using all 100% of your capital, of course, this will expose you to unnecessary risk in the market. If the markets, you know, is going downturn and you invest in an economic crash. So this is something that you don't want to do. So you want to preserve your account. So what our main objective by investing, by trading and investing in the financial market is that we are able to make money over and over again. All right, all of great traders, right, they are talking about making money over and over again. All right, so uh, don't use all your initial capital. All right, be conservative, especially when you are just started your trades. Get a profitable trades first. Then, if you are able to generate more profitable trades, then you can, right, you can invest more, even more than 50% of your total capital when your initial trades, all right, when your initial trades produce good results and good profits. Right? You have to remember that making money over and over again and to protect our capital is our objective in the market. So the question arises, so how do we set our stop loss? All right, how do you set your stop loss correctly in order for you for not stopping out too quickly in the market? Because that is also one problem. If you put your stop loss near to your entry positions, you are easily to get stopped out. And rather than give, uh, and you should supposedly give your trades to fluctuate over some certain period of time. All right, this is common sense. When you put your money right in the market, it's not gonna rally immediately. So sometimes you have to give a moment for your trade price stocks to fluctuate a little bit. All right, this is acceptable. And how do you implement and setting your stop loss is that either there's a few strategies on this. All right, there's a few strategies on this. uh, Number one is that you can find the nearest horizontal support and resistances. All right. So what I mean by this is that we're going to discuss this later on, and or you can find under the three nearest support or resistance, or a previous support and resistance. And this is very good because you allow your trade to ranging a certain period of price. So, so three resistance is actually a very conservative strategy in order to put your stop loss. All right. So we'll see shortly on how do we put our support and resistance. And if you put your stop loss below the third support and resistances, which is really, really conservative, you can let go your trades, all right? Let go your trades. So this stop loss, all right, can be improved by learning an elite wave strategy that I'm gonna add to the course uh, for the fourth section, all right, during the at the course, in the course. So you're gonna learn that knowledge, so you are able to get better in setting your stop loss. But for now, if you put your stop loss in the nearest horizontal previous support and resistance, that is not conservative. All right, that is not conservative. Sometimes you are easily being stopped out. So what you want to do is that you want to seek the previous two or three support and previous resistances, so that you are allowing your trades to ranging. All right, this is common sense. So let we see how do we put our stop loss. So this is Amazon. All right, Amazon. So you can see that Amazon stock has been rally since, right, since 2016. So okay, this is, we are not interested in this. So what we are trying to learn here is that how do we put our stop loss, all right? How do we put our stop loss, and how do we recognize previous support and resistance? What I mean by that is actually, if you see here, all right, there after this rally, this is quite a major retracement, because there is no such retracement such long like that before. All right, when it is really unless this, but this is not really this deeper. So this is quite significant retracement for Amazon. So what you're going to do is that if you are planning to enter somewhere around here, you are planning to enter somewhere around here after it rebounds or it's going an upward movement, rebound here is confirmed it's rebound, so you enter here. So what you want to do is that, okay, you have to identify the previous support and resistance. All right, previous support and resistance, so you have to line up all the possibilities, all of the support, previous support and resistance. For example, like this is what we call as the nearest support, right? And this is the nearest, the second support, right, to your entry. And this is the third resistance, previous resistance, where it has possibility if goes beyond this support, right, both these support, it has high chance to go to this line, support line, and which is previously the resistance line, and rebound, right? So when you see at this Amazon stocks, you are able to see that the number one is what, right, as what I'm saying, it is too near to our entry, and we might get stopped out easily. So what you want to do is that you have to consider the next support and resistance, the previous support and resistance. All right, so this second support look quite nice, and this is too far beyond the second support, right? So we can neglect the third support and put the stop loss on the second previous support, right? So this is quite nice. So either than that, you can also make a inclination support, all right? So you can see that it rebound at this inclination support, it rebound up. So you can see that both of this line is actually a very strong support, right? But somehow you don't want to get stop out easily, all right? So you put your stop loss at your second support, all right? This is quite nice. This is not wrong. But if you want to put here, insist to put at the first support, you can put it here, right? You can put a little bit below, not just right below the wick or the candle. What you want to do is that what you want to do is that you don't want to put right below this. So what you want to do is that you put a little bit below, right? A little bit more below, so that you allowing your trades to ranging. What you can see here is that when you enter here, for example, right? So you can see the stock going down again, right? It's not immediately going up. So after this Marubozu red candle, so it's rebound upward, back upward, all right? So what you want to do is, what you want try to do is that you don't want to get stopped out very early, all right? So this is quite a pretty good support because of, actually, despite of this 1, 2, 3, there is also an inclination support that you can consider 1, 2, 3, right? So this is the 3. This is the perfect place for us to put our stop loss, right? Either here, if you want, I mean, like, if you want to be more considering to put it the second support, that you can consider here, or if you following your strategy, which is the nearest 3 resistance or support and resistance, you can put it at this price level. So this is a very, very conservative. It does not even touch the first support, and it goes upward. This is an example on how you put your stop loss, right? I hope you can see the market movement, so that you are able to make a right decision in the market, right? And you understand the market behavior, all right, so that you are not getting stopped very quickly. You give your stocks to ranging a certain price before it come back to its original rally, right? Before it goes with your prediction, right? So if you give enough room to your stocks, all right, this is something very important. If you give enough room and very conservative room for your stock price to ranging, this is signs is a very good that it has high chance the stocks going back into its original track and it rallying. I hope this you learn something, and if you implement this is quite good, right? In the next section, you will learn on how to put your stop loss, all right? How regarding on the, I think you had learned about the 1% rule risk management. So what you want to do is that the next few section you will learn on how to put this all data entry your stop loss into an Excel sheet, which is it will calculate immediately how many shares that you need to buy in order for you to implement your risk management accordingly. So the next knowledge that we're gonna learn is when to sell. All right. So not many knows that this is also a part of risk management knowledge that you need to learn or you need to discover in order for you to be success in your trading or investing. Right. So the question arises is about when to sell is actually not when to sell. All right. So you have to learn how to sell, right? How to sell your equities. All right. So when we have this answer of how to sell uh, our equity, we have an idea when to sell. All right. Know how to sell is very crucial in trading. Perhaps this is the most crucial part of your uh, trading success. All right, right here, right now, at this moment, you are learning it. All right, believe me, you are learning it because everyone can get into the same entry, and guess what? And in the end, no one had ever have the same results, right? No one have the same results. It is because not everyone gonna sell at the same price. So we have to learn a strategy, a selling strategy that is proven to be success in the market, and you are able, you are that that strategy enable you, all right, getting a profitable trade in a very long period of time. And believe me, all right, this is very important, and this is the way many profitable traders making money. And if you are implementing this knowledge in your trading and investing, believe me, you are on your way to success. All right. This is the knowledge, and what I need you guys to do is that you have to implement it and you have to take action of the knowledge. All right. When we buying an equity, all right, the question is always arise either we have to sell now or either we have to let our equity running. All right, this is the questions that always in the trader's mind. All right, this is something that always been an issue. Right, these two, either we have to sell now or we have to you know take the profit now, right? So what you must do after, all right, after thinking about this strategy, what you need to do is you had to have a strategy that is balanced. All right, balance between taking profits and you have to still allow your trade to run. or your profit to run. Now, you can sell by number one, by averaging, which is the partial selling, right? Or the second one is at the rebound. And we will go through this specifically in the next section, right? In the next slides, I think. So, how do we sell by averaging? Now, you have to remember, and every traders have to take note of this, is that to sell stocks at the top price every time is almost impossible, right? It is impossible for you guys to sell at the top every stocks that you buy, right? If you are, it happened that you sell your equity at the top, it might be just a lucky day, right? So what what we want to have is that we want to have a system, a strategy that enable us and to generate profits and protect us at the same time, right? So averaging allow traders to sell as closest at the right high price. What I mean by this is that you might sell at the top of the price, right? By this strategy, I'm going to reveal to you in a moment. And averaging allow you, average up the price, right? If you take unnecessarily selling action, all right, you're unable when the stock going down, rebound down, all right, reverse down, so you are unable and afraid to get up from the stock because you believe that the stock gonna go up again in the future, all right? So when we do averaging, we have chance to lock our initial profits, right? This is something that the most hardest single things that traders made in the market, right? Which is they do not have a strategy that enable us to lock the initial profits. While you are learning it now, you are one step ahead of any other traders, and you should implement it in the market. By having saying this, by having locked the initial profits, you must have room to allow your stocks or financial product profit to run. All right, you want as much as profit as you can. All right, so what you want to do is that again you have to be balanced between take your profits and let your profit run. And this averaging is the best method because it can prevent frustration, prevent, and it's also prevent emotional attachment to the trade. All right, because if stock going down after you lock initial profit, well, you get your initial profits in the first place, so you don't mind. All right, and this is a proven strategy in the long run. You are able to get more profits potential. So how to averaging? We are able to averaging by selling the stocks in two ways. Number one is one third strategy, which is the first third, then the another third, and the last third. And next strategy, the second strategy is by half selling. All right, half selling. So the first you are selling for the first half to take your initial profit, and the last one is another half. All right. So averaging is a great method for you to implement. All right, because it's really good at averaging your profits and not getting your at the end of the day you're not getting it's hard for you to get any losing positions, or if you have any losing positions, well, your initial profit taken has averaging up all the losses, right? So how did, all right, so I make an initial additional info here. So how did we sell our first third, second third, and the last third. So I will reveal this strategy in the next section. In this topic, I will show you on how to use the trading journal templates. And all right, as you can see here, this is the trading journal templates. You can see there is date, symbol, right? The account size, risk, how much risk that you take to get into a position in this trade, your entry price, your stop price, risk per share, and total risk amount, suggested shares of buying, and okay, assume that we are going long for all of the position. That's mean we are going for long term, and this is actual trade exits. How much do we exit? At what price do we exit? And this is the commissions of broker, and this is the trade results with commissions, and this is the estimated trade results. Okay, and this is all right. This is the before cost, and uh, we will see the result here, the total profits or unprofitable at this column, right? And I will show you on how to use this. All right. Uh, this is actually an automatic calculator, an Excel calculator. Has automatic formula in it for you to use it. What you have to do is that you just have to enter the date, symbol, right? The tickers, what stock did you buy, the account size, how much of your total equity, right? And how much total cash capital of your trading account. And this is risk, percentage of risk, how much risk that you are willing to risk in one particular trade. And usually we are seeking for 1% risk management, all right, in every trade that we take. This is our entry price and this is our stop price, all right. And this is the first 1, 2, 3, 4, 5, 6 data that you need to enter in order for you to calculate how much shares that you need to buy in order for you to get into this price. And if it's move against you and it hit the stop price, how much that you are willing to lose, all right? Is how much risk that you willing to take, all right? And it will be shown, the numbers will be shown here in total risk amount. Okay, and I'm gonna show, I will in a minute I will gonna show you how can we use this trading journal template, right? And we take an example of this Twitter uh, Twitter stocks. We assume that we want to get into these stocks, all right? And because this is based on our analyze before, this is a stock have trend and have power, and hence we are interested to get into this stock, right? And this is actually a few days after I'm doing the analysis, and you can see that this is the weekly chart, right? We use this weekly chart because of it's easy to see the price movement. You can use daily chart also. Usually we use daily chart in order for us to identify our entry, and the more small the time frame is, the more precise actually the chart can tell you where the exact price that you can get into, all right? Now we are not talking about that. We are trying to calculate and use our trading journal template right now. We'll show you on how to use, on what are the function of each time frame, all right, in order for you to do and to analyze the trade effectively. Okay, now for our trading journal template, right? For example, we had doing our weekly analyzing on this Twitter, and we are interested to get into this trade. All right, we are interested to get this trade. Remember, when we are interested to get into this trade, that's mean, right? The next question is at what price that we supposed to buy, right? Of course, one thing is that we want to buy at the price that lowest as possible, right? Lowest as possible. And assume that you can see that there is a retracement and the trend become longer and it has power compared to the previous trend, right? And what we trying to do is we want to get an entry at this position, right? Assume that we are seeking to entry at this point, right? At this point, we see we can see that there is there is a uh, reverse candlestick situation here. So we try to get into this position, right? So, right, upon seeing this rebound upward, we want to get at this position, for example, 31.5, right? Let's assume that our entry is 31.5, right? 31.5. Now our stop loss could be here. This is our immediate support, and it could be at this price, right? The previous resistance. And we are interested to get to allow our trade to fluctuate a little bit if in case that it's going downwards, so that all right, we are not panic, we are not sweating to be stopped out immediately if it touch this first support line. All right, we want to give our trade or price a room, enough room for it to fluctuate, so that we are not easily stopped out and lost in position, right? So you are thinking about entering at this price 31.5, and your stop loss we are assumed at this price 25.15, right? 25.15 stop loss, right? 31.15. Okay, sorry, 25.15, 31.1. So in considering to get into the trade at 31.5, and you are willing to stop loss, all right, where this is the moment you think that you are wrong, you want to get up from the trade, right? 25.1, because you has given enough room to it fluctuate, but still it's reached its point here. So you decide your stop loss would be 25.1, all right? And so what you want to do is you want to get this information in this trading journal template, right? So what we're going to do is that our date today is, for example, like this is 13th of May, and the symbol would be T, all right? Symbol would be here, TWTR. And what is your account size when you took the trade, right? Let's say you have 30,000 in account, right? 30,000 in account, and you risk 1% of your trade. So your entry price would be 31.5. So when you saying that you risk 1% of your total account size, that's mean you are willing to risk $300, right? 300 of your total account, right? Which is 1%. Right? This is actually but optional, and usually all the traders, successful traders and bankers all around the world are using 1% rule. Right? And you can, if you think that you are willing to risk 600, right, $600, so you can see 2%. So you are willing $600 for your risk if it hit your stop loss. All right, so entry price would be 31.5, and your stop loss would be 25.1. Right. So when you enter all of these informations, so what this Excel calculator do for you is that it automatically uh, calculate for you how many shares should you buy. All right, so it's is your process of calculating your uh, how many shares that you need to buy in order for you to risk certain amount of your money in the market, right? For example, like in order for you to get into a share price at 31.5 and stop out at 25.1, by a by willing to risk 2% of your total account equity, which is $600. So this is the amount of shares that you need to buy. So that's mean you are willing to put your money $2,835 in the market, which is same amount as 90 shares of this Twitter, right? So, right, this is what the calculator be able to provide you to ease your job in calculating how much shares that you need to buy in order for you to raise a certain amount of your account. So when you took your actual trade exit, for example, like 35, 33, 35, so you have 315 uh, and you 315 profits, and your commission would be $16. So you have $299 profits in this trade. All right, 315 before the cost, and right, this is R multiple. This is actually your risk management. For now, you can neglect this section, right? For what I'm gonna want to show to you is that how this trading journal templates is your work, all right, in calculating of amount of shares and what are your amount that you are willing to risk in a trade. All right, I hope this is very much helpful in doing your trading analysis. All right. So as you can see here, when you get into this trade, it's not immediately going up. It retraces a little bit, but it does not touch this stop loss, and yet it resumes its movement upward. So right now it's 33.4. So you can see, for example, like if currently this if you want to calculate your profit, you can see how much. So you have 155 of uh, profitable trades that you have, right? So I hope this is beneficial, and I will share with you more on how to use this trading journal templates on our second examples in the next video. Right? Thank you. Hi guys, we will continue our second example on how to use our trading journal templates. And for this second stocks, we use Alibaba stocks, where we had done our technical analysis on this previous in our previous session. So we use this, and as far as we know that this stock has potential power up it has potential to go further up. And when we analyze, it's just I think around here, and now it's already goes up towards its target. All right, but assume that the stock is still at this level, and we want to key in our entry. All right, I want to key in our entry, and now first we have to determine where is our stop loss. All right, so in order for us to determine our stop loss, we had to determine where is various support and resistance. All right, horizontal support and resistance. So this is the previous support. We don't want to, at this level, we don't want to get at a very sharp close here. We don't want, we again, we are as much as possible allowing our price to fluctuate a little bit. So we might put it a little bit lower here. All right, there is there is doesn't have, we don't have any rules, specific rules regarding on this, but as long as you put a little bit lower than a previous support, it would be fine, it would be fine. All right, and we don't want to put it at the sharp support because of this is too close to our previous support. We don't want to get to be stopped out too quick and immediately. Right? Remember, if we didn't get stopped out, and we will, as long as we didn't get stopped out, we will still in the game, and we consider not losing our position. All right. So consider we want to get in at 176. All right, we get in here 176, and we want to get out at this price. All right. So our entry would be entry would be 176.2. All right, and our stop loss, our stop loss would be down here. All right, our stop loss would be 154. All right, 154. Why did we put at the immediate support and allow it a little bit small range to fluctuate here? Is because if we consider previous resistance or support is too far way below, right? We don't want to get stop out too far way below down, because at this, if the price from this point and it goes down to this point, and we have to notice that we already wrong, right? We already wrong. Even if we stop out here, we get out from the trade here, we know we are losing position. We don't want to get our losses grow bigger, and we want to get stop out immediately, because if it reach down and break this support below, it has higher chance to go aggressively downward looking for its previous support or resistance. All right, that is the way it is. That is the way stock market works. All right, that is the way price actions price action progressing in the stock market, and that is the people behavior in the market. They're also looking at the previous support and resistance. So you don't have to put your stop too far way below here. Enough if you can, if you stop out here, that would be enough. Right, this is the region where you allow the stocks to fluctuate, and you want to put your stop loss at this region too, because this is where you are comfortable saying that, all right, I'm losing and I want to get out from the trade. Okay, you are entry 176.2. All right, we are entry here, and stop loss 154. So for our second, all right, second stocks, right, we are analyzing Alibaba Group, right? Alibaba, and account size again 30,000, and we are willing to risk 1.5%, for example, which is $450 of our money. So entry price would be 172. Is it 172? Yeah, our price would be 176,154. 176 and 154. Right? So you can see that our risk amount is 450 and our shares, the number of shares that we need to buy is 20 shares. All right. And what this supposed to mean is that if we are looking for entry at this price and we are looking to stop out, we are preparing ourselves to be stop out 154 if the stock price move against us, with account size of 30,000, which is again, this is the maximum total of our account. And we have a total risk amount of 450. So we need to buy 20 shares, all right, with 3,520 capital costs. All right. So now we are looking, if we get into the trade and we are looking our profit target, calculating. So you can see here the stock price go up and it goes down again. It gives us that kind of nerve that maybe at this price we are panic, but yet it doesn't touch our stop loss. Am I right? Right. That's why we need to give our stock price a fluctuating moment, right? Fluctuating price where we allow them to fluctuate, to play against us. All right. We doesn't want them to play too much, but we give them room to play against us in a certain price. All right, so that we doesn't too quickly or too quick being stopped out and losing in the market. All right. See what happened when we let the stock move. If we let the stock to move and we allow it to move fluctuating at a certain price, you can see that it goes back up again, right? When we determine power trend, and you can see it goes up again. So $200 now, we can see how much is our profits, for example. All right. So you can see we are profitable $480 up until now, right? So this is how you use uh, your trading journal template. And this is second example on Alibaba stocks. You can use to any stocks, right? In your own local market, you can use this journal template in order to make ease of your works, to calculate how much shares. And at the end of the day, you want to know of your total account, how much did you make? All right. Are you losing or are you making money at the end of the day? All right. And you want to know that your system is a good system, a good strategy. And if you are using the strategy that I'm telling you, you will be fine. But one thing that in trading, you have to fix yourself, fix your own psychology. You don't let your psychology ruin your trading activities, and so your psychology and your results regarding on yourself can be reflect from this journal template. That's why you need this journal template in order for you to reflect your training activities and hence improve yourself from time to time. At the end of the day, you have a good system, a fixed strategy that you can rely on when you get in the market. And you also want to see that how much trade that you need to do on average every year. All right, for example, every year. And all right, in order for you to get a profitable trade in total capital. And also you want to see how did you doing with your risk uh, risk uh, risk profile. All right, so I hope that when you are doing this, you get your risk management fixed in place so that you can see at the end of the day how much does it it can help you. right? How much does the suitable numbers of total risk amount and total risk percentage that you are comfortable with, and subsequently able to generate uh, a total profitable trades at the end of the year. All right. Thank you.